We are the fourth largest economy as I speak. India today is larger than Japan. What is being planned, what is being thought through, no matter of another 2.5 to 3 years, we would become the third largest economy.
Very good morning. You're watching India Market Open, and that was a pretty cool announcement over the weekend that India has now outpaced Japan to become the fourth largest economy in the world, and long time coming.
Yeah. And maybe some would argue that it's math. At some point of time, we will become the third largest as well. Yeah. 2042, maybe become the second largest. Who knows? I mean, so a lot of things. But yeah, it is a great thing.
At a time when investors globally are seeking better yields, they should consider India now.
I mean, about time. Which is why I think, which explains all of those inclusions in the global bond indices, so on and so forth, because people saw that it was not that India wanted to be a part of it. You need to make India a part of these indices because it's the largest economy, the fastest growing large economy, all of that, right? So comes into play.
So much happening over the weekend that we have to cover today. So you had this announcement, you had RBI dividend.
Which is tied to this as well, right? Because at a time when you have requirement funds, ultimately you have a considerable amount of money coming.
You have like a super piggy bank who has like the right amount of money which has come in, which is less than they could have given. I think that's the big one.
That
so
too.
2.7 lakh crore rupees was pretty much the dividend that the Reserve Bank of India gave. This is something that's going to cheer the street today.
It should, right? Because it kind of assuages any kind of fiscal slippage concerns that people may have had. So I think in that sense also, it kind of plugs in just the right, not holes really, but the, how do I say it, for lack of a better word, gaps.
And gloomy clouds.
So enough for capex, enough of a buffer for government expenditure as far as that's concerned. It's also another day of good news in terms of what's happening globally. It's a change of heart for Donald Trump. I don't know what else to call it. Change of heart for Donald Trump as far as the EU is concerned. So Trump has extended the deadline on EU tariffs. Remember, he had said he's going to get tariffs as high as 50% on the European Union. So he had a call with the European Union Commission chief and then decided to extend that deadline to July 9th. So you saw the Dow futures jumping 300 points after that extension. So US markets, which ended in the red on Friday, are going to be seeing a change of heart. That was the Friday numbers that you could see, about nearly 300 points down on the Dow Jones. But I want to see the futures, actually. That's what's more relevant right now. Look at the NASDAQ futures, about 1% up. Watch out for Indian IT stocks today. You've seen the Dow futures also up in the green. Here's what it started with. Ursula von der Leyen tweeted this out. She said it's a good call with POTUS, the European Union and the US share the world's most consequential and close trade relationship. Europe is ready to advance talks swiftly and decisively. To reach a good deal, we would need the time until July 9th. Trump follows with a with a post on Truth Social saying that he will postpone the planned tariffs on European Union goods, originally set for June 1st until July 9th. Listen in to what he said as well.
She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation because I've told you specifically, haven't I told anybody that would listen? They have to do that. And we had a very nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
Okay, so that has been a bit of a reversal, bit of relief as far as tariffs on EU are concerned from the US, but the other factor that has spooked markets continues. So in Friday's trade, for example, the Apple stock tumbled after Trump said that the iPhones not made in the United States will be charged 25% tariffs. That includes iPhones made in India. Of course, India and China is pretty much what is providing iPhones across the world. Bond yields have slid after Trump has raised the threat of tariffs once again. The 10-year was at 4.5%. Oil has risen, though, after that deadline has been extended with the European Union, Brent above the $65 mark. I want to just pull up Asian indices and see what's happening there. This morning, sort of a mixed trade is what you would expect. But let's get straight to our first guest this morning, who's joining us. I'm joined by Steve Englander, Global Head of G10 FX Research and North America Macro Strategy at Standard Chartered Bank. Steve, great to speak with you. Thank you so much for your time with us here at NDTV Profit. Let's talk about the tariff proposition. On now, off later, postponed for now. Do you think that that entire trade where you would expect tariffs not to be as harmful has now peaked? What are you going to be seeing in the next few days?
Well, I think that they're going to put an emphasis on trying to get to a deal with countries that are easier to work with than the EU. The EU problem is it's so big and it's such a complex set of issues that it's going to take a while for that to work. I think that what Trump was signaling last week was that he was dissatisfied with the offers that they had done, and you know, kind of some of them considered almost risible in terms of the priorities of the U.S. So I think that, you know, that now that's put aside, but I think that the U.S. priority will be trying to get some other countries, you know, perhaps Japan or Korea, even India, on board quickly, so that they start putting points up on the board and kind of put pressure on other countries to come to deals.
Yeah. Steve, the question is, though, is this going to be a stopgap arrangement? Because history has told us, even in the case of the India-UK free trade agreement or the trade agreement, bilateral trade agreement, it takes a while to get these details hashed out. And so you're talking about not months, but possibly years. Is that the right interpretation?
Well, I think it'll take years to get everything done, but I think that they're hoping that some general principles can be established quickly, and the years will be for the details to be ironed out. One of the things that we've seen is that the status quo from a revenue viewpoint isn't that bad from the U.S. We have a pretty good idea of what they collected in tariffs for May. And it's about, you know, more than 3 times what they did last year. And, you know, on a year-on-year basis, much higher than what they collected in April. So that 10% base tariff, as long as they keep that in place, it's actually kind of an okay outcome from a revenue side for the U.S. The issue, of course, is that it causes a lot of disruption and we don't know the magnitude, and it will have some inflationary impact. And we've not yet seen the magnitude. But in terms of kind of being able to tell Congress, look, we're going to collect a decent amount of money from tariffs, I think it's working their way.
Steve, good evening to you. Depending on how closely you track India individually, or if you think of flows from DM to EM, I wonder, what do you think the next 6 months or the second half of the year holds in store?
Well, you know, I was a bit surprised that that the U.S. sort of got, you know, raised the issue with Europe. I think for now, it's certainly for the next couple of months, they really are going to try and focus on getting the tariff deals done, which means a very friendly environment. Now, the problem for a country like India and for other countries is that U.S. rates keep creeping up, and they really haven't been able to reverse that. Much of that is risk premium because markets are still uncertain about the dimensions of policy. So I think in principle, it should be pretty good for EM if the U.S. is able to calm things down, which I think they see as being in their interest. But we have to see if they can accomplish that.
So I'm just wondering what your view is on the dollar. And we've been looking at, of course, the dollar index, but really, and this was pointed out by another guest that we had last week, a large part of that is effectively the euro and the dollar. But it has fallen in the recent past. The dollar has lost a little bit of strength. Do you see that continuing? Where do you see the dollar moving from this point?
Well, we see it gradually weakening, nothing very intense. I think that the market will wait to make a big decision on the dollar till after the tax bill is done and they see what U.S. growth is, what the implications are for the U.S. deficit over the medium term, and how the tariff deals go. So I don't think we're going to be in a high volatility dollar regime, but I think the tendency will be for it to weaken. Many asset managers, many reserve managers really haven't been, gotten around to reducing their dollar weightings, based on reports that one hears. And I think that's, I think there's going to be a drip, even though some of the headlines may end up being dollar positive from time to time. The drip of selling is going to be dollar negative, but not in a high vol way.
Steve, thanks so much as always for taking the time. Pleasure speaking with you.
Thank you.
All right, let's talk about what happened last week. At the end of the week, of course, you had foreign institutional investors and domestic institutions buying to the extent of about 2,000 crore or thereabouts on a cumulative basis. But let's take a look at the weekly move for the Indian equity markets. They ended a choppy week on a high note. You had the broader markets that outperformed over the course of the week. And take a look at the print for the week as a whole. The Nifty 50 losing about 0.7%, the mid-cap index to a lesser extent dropping about 0.4%, but the small-cap index actually ending with gains of about 0.8% or so. And some part of that, of course, was on account of Friday's move. The Nifty 50 was part of a pretty broad-based rally, but as many as 48 constituents of the Nifty 50 gaining ground on Friday. Sun Pharmaceuticals and Grasim were the exceptions to that and lost ground for pretty valid reasons. Consumption stocks gained on the back of expectations of a healthy monsoon. We're pretty much hitting the monsoon in Kerala, and it's going to likely hit Maharashtra in the next couple of days as well. Sun Pharmaceuticals also ended off the low point of the day to the extent of 3% or thereabouts. So the mood shifted quite dramatically. Pharma was the only sectoral underperformer, losing about 0.4%. The Nifty Defense showed further signs of cooling off and ended flat on Friday. The FMCG index was the top performer, led higher by both ITC as well as Varun Beverages, which ended the day with gains of about 4% or thereabouts. The Nifty Bank saw a healthy 0.8% gain, looked pretty good. And in fact, it trades above all of its key moving averages. So certainly one to watch out for in trade today. Just a last point on the VIX. It did inch up just a tad bit, about 0.1%. It stands at 17.3 at this juncture. The question really is, do we see that momentum carry on in trade today as well?
Yeah, so I mean, the one good thing was that the Nifty in Friday's session eclipsed the previous session's high for the first time in 5 sessions. So from a technical parlance, I would love to understand what our technical experts think about it, but that seemed to be a consensus amongst 2 or 3 names which wrote their weekend notes, right, about how important it was, the Friday's trade. So, which was one good thing. And from a support perspective, the 24,500 put strike has seen a heavy build-up, 94.76 lakh contracts on last count. So we know that 25,000 is a bit of a, what do you call it, a resistance, but 24,500 built out to be a very strong support as well based on the options activity. And Puneet will talk more about it, I'm sure, but just wanted to lay that out. As we discussed, I think the higher dividend from the Reserve Bank of India kind of assuages any macro concerns that India may have had, because everything else seems to be in favor. This was that one thing, that how will extra capex happen considering that the government expanded the defense budget any which ways. So now this dividend kind of takes care of that. And the surprise movers the whole of last week were insurance names. And then you try to look at whether a sector has tailwinds for this to do well. I mean, just look at what HDFC Life has done. It's hit record highs at the end of last week. So we're seeing some of these insurance stocks move really well in trade, and the sector has tailwinds for the short term. So what's working? I mean, people are talking about how, one, that the stocks are seeing the uptick on institutional buying. Retail buying doesn't move insurance stocks the way they have done last week. More teeth to IRDAI is the expectation, and which should help in confidence building, because people are, taking a leaf out of what happened with a RERA getting more teeth to how real estate became better, to SEBI getting more teeth to how the capital market space became better. And could the same thing happen to IRDAI insurance stocks? And the street is assuming possibility of premiums expanding in general insurance. So guys, be ready to pay more for your car insurances. But it works well for the insurance firms. So certainly a sector to watch. Finally, after a really long period of consolidation, is seeing a breakout move. Could be very interesting stocks to monitor in the very short term. Yeah. And okay, Taman, I think first let's finish the trade thing, because I'm sure you have some levels, then Puneet, and then talk about a really interesting tweet from Sanjeev Bikhchandani. But what are the levels that you figured out?
So, no, a few factors that are on my watch list today. First of all, RBI has given its largest ever dividend to the government of India at close to 2.7 lakh crore rupees. I think this is important. So, Morgan Stanley says higher dividend is positive to align the fiscal deficit with the government's fiscal consolidation path. It will also maintain the capex momentum, especially when global external factors pose headwinds to growth and thus revenue. So look out for that. I think BFSI has been sitting it out. Bank Nifty has been sitting it out. Look at these two sectors and spaces very closely, whether there could be a rebound there. I would add tech stocks. I would add a Tata Motors, only because if the European overhang had continued, it would have been bad for both of these. But the reversal is good news. So the way the Nasdaq futures has responded after Trump has postponed the 50% tariff, is what he has threatened, to the 9th of July as stocks continue, could be good for IT stocks today, for Tata Motors as well, because those conversations from a JLR perspective become very, very important. In terms of the indices, the Nifty rebounded on May 23rd, breaking a 5-session lower high pattern. As Neeraj mentioned, the index in fact closed above the key 10-day EMA, showing a positive momentum. On the weekly charts, it remains above all key moving averages, indicating an overall positive trend. So support levels to watch are 24,700 and 24,460, which was last week's low. Resistance may emerge around 25,000 and extend to 25,200. Bank Nifty remains above key moving averages. Resistance is 55,450, 55,600, and support at 55,000. So these are some of the key levels to watch out for. But Puneet, with more on what we can expect from the derivative space.
Well, thank you for that. So definitely the key levels you rightly mentioned there, from the recovery from May 22nd to May 23rd lows, that was one of the key ones, one of the key highlights from last week. For today at least, we also saw just marginal dip in the open interest for Nifty futures as well. For the Bank Nifty, we've been speaking about these levels, about 55,000, and that was briefly broken last week. We've rebounded again roughly about 550 points from those lows, getting close to the 55,500 comfort levels again. In terms of, let's look at, essentially the long short ratio as well as the net short positions. We've seen a mixed bag for the Nifty futures. The FIs have been largely short. 363 crores is what the number was for last week. In terms of index option as well as stock futures though, the FIs continue to be long. When you look at the PCR ratio as well, that's what was another interesting one. It's hovering around the 1.08 mark, which is a neutral position. What's interesting is the index long, which essentially is how long are FIs in terms of contracts. We were at roughly around 37% at the start of last week. We fell to 32, and again that will be another key level to watch out for this week as well. When you look at the open interest distribution, and Neeraj did highlight this, at 25,000, that level keeps one of the key ones for the bulls. We've also seen an increased participation from traders at the 24,500 level for the put option contracts, and that's been another key support level essentially for the market as well as for the traders. That is one which is to watch out for. We've also seen some increased interest at 24,800 for the puts, but that's largely been activity which has been moving on a daily basis as well. And finally, in terms of stocks, both on the open interest gainers and the losers side, for the gainers, we've seen some short build up in BSE, and that's also largely built up on the change in expiry days of what NSE could be. So there's a news flow attached to that as well. While some long build up has been seen in solar industries, really good set of numbers, and insurance, which Neeraj also highlighted for HDFC Life, has also seen some long build up. Finally, for the open interest losers, seeing just some short covering across FMCG pack, United Spirits, ITC seeing that as well, and some long unwindings in Sun Pharma as well on the back of results as well. We saw that news flow come in. Weaker set of numbers essentially in this particular quarter. But overall, we are setting up again for a week with the 25,000 level on the Nifty would be something to watch out for going forward.
Okay, and we'll think of stocks to watch. I wonder if Info Edge becomes a stock to watch, but not because of that. But Tamanna, just before we get, and Alex, before we get to that list, just this post, I mean, it's humor personified, but it also shows the confidence that shareholders of Info Edge have in their ability to do private equity investments, right? Sanjeev Bikhchandani, the two halves of the post, right? The first one is that 99.9995% of the people voted in favor of Info Edge Ventures Fund 3. But the second half of the post was the most hilarious, wherein he's saying that my friends informed me that such votes have been Kim Jong-un, Mugabe, and Gaddafi, amongst other worthies. Quite something.
Unless he held a gun to the head of all of his shareholders, which is what he seems to be talking about. But yeah, I mean, they don't get enough credit for the kind of ability they have to pick winners consistently.
Most certainly.
So that has been interesting. All right, let's get to the watch list this morning, and there's so much to cover, as it always is after a weekend. It's going to be a results-packed week. That's one of the factors to watch, actually. So results is going to continue to dominate the mode this week as well. But some of those that were pretty decent. I'm going to start with Azad Engineering. For this quarter, thumbs up is what we're giving it. Revenue up nearly 37% at 127 crores versus 92.7 crores. EBITDA is up 46% at 45.5 crores versus 31.2 crores. Margins at 36% versus 33.7%. So good uptick there. Net profit was up nearly 70% at 25.2 crores versus 14.9 crores. What's also interesting is that their export book has grown from 87% to 91% of revenue. So Azad Engineering has had a good set of numbers. That's why a thumbs up on our list today. Anupam Rasayan is the other one, another good set of numbers. Revenue growth was led by pharma and polymer, and revival in agrochem demand. Strong performance from Tanfac Industries aided their revenue growth. So Anupam Rasayan holds about 25.8% in Tanfac Industries. So that has contributed to their numbers. EBITDA margin expansion was led by product mix and operational efficiencies. They aim for 25 to 30% revenue growth in FY26. Revenue was up 24.7% at 500 crores versus 401 crores. That's the core numbers I'm talking about now. EBITDA was up 56%, nearly at 144 crores. Margins have gone up delightfully, I would say, 23.1% to 28.9%. So smart uptick there. Net profit was up 44% as well. Third stock is also a thumbs up, JK Cement. Revenue up 15.3% at 3,581 crores. EBITDA up 36% at 765 crores. Margins have also gone up from 18% to 21.4%. Profits are up 64% at 360 crores. So the reasons are grey cement volumes were up 15% year on year versus 3 to 8% for peers. This is important, implying market share gains in North and Central India. So the grey cement volumes is one reason why this would be a thumbs up today. Volume growth has not impacted pricing, as grey cement realizations were up 3% Q on Q in quarter 4. They will also be paying a dividend of 15 rupees per share. So here's the thing, in this season, in this result season that I've noticed, the good are really good and the bad are really bad. So that disparity is widening. The results which have howlers are pretty bad, and the good ones, some of them you can pick and choose, are seeing healthy margin bump ups, which is always great.
Yeah, stark margin bump ups. Just the small addition to that, I mean, and again, it's a brokerage view, so never know which way it moves, because Anupam's numbers were fabulous. And I wonder what it does to Tanfac as a stock too, by the way. But Jeffries, in their note on Anupam, has said that, because the OCF, or the operating cash flow, has declined so precipitously, so on and so forth, they are underweight because of the valuation being 3 standard deviations above. So you look at the numbers, blowout numbers, right? No surprise, it's a thumbs up. But there is one brokerage note which is saying that, we are a bit cautious on the valuations, but doesn't take away the fact that the margin expansion was superb.
So we're talking about how we view the numbers.
Exactly.
And the factors there. How
exactly.
The stock will move could be a variety of reasons.
Correct.
Yeah, absolutely. And on that note, actually, let me talk about another story of margin expansion. Based on the data that I looked at, and I only managed to look at the last 3 financial years, GE Vernova.
Only.
GE Vernova. So we're talking about 12 quarters, the best operating profit margin in at least those 3 years. The net profit is also the highest in at least those 3 years. A few more talking points in the way of order intake in the fourth quarter stood at nearly 3,000 crore rupees, and that's an increase of 124% year on year. As a result of which, the order backlog in the fourth quarter stood at 12,660 crore rupees, and that is up 17% sequentially. And so this is a great set of numbers any way you look at it. The revenue has increased as much as 26%, strong execution in evidence also for this company. But the EBITDA has gained quite considerably, is more than doubled, coming at 252 crore rupees. The margin standing at 21.9% compared with 12.1% in the comparable quarter. That's on a year-on-year basis. But even sequentially, it has improved. The net profit has risen 2.8x to 186.4 crore rupees, and that has also risen as much as 30% sequentially. Not a cheap stock. I will say this again, it's not a cheap stock, but take a look at the numbers. Absolute blowout quarter for GVTND. The second stock is Narayana Healthcare, and this is also a decent set of numbers actually. The revenue coming in at 18% higher. This is adjusted for certain aspects. Remember that on a consolidated basis. Remember they have an international hospital as well. Cayman is the business that they have. The revenue on a consolidated basis up 18%, as I said. The EBITDA has increased as much as 23% or thereabouts, and you've had a small margin expansion to the extent of about 80 basis points or thereabouts. 24.2% is where it stood right now. Net profit has increased about 3% or thereabouts, coming at 197 crore rupees, and they paid a final dividend of 4.5 rupees per share. Most of the business comes from the Indian hospitals, so let me take you through a few key numbers. The average revenue per patient rose as much as 9% sequentially, stood pretty strong for inpatient care. They also offer outpatient care, but inpatient is the large chunk of the revenues. The average revenue per patient was actually higher than the FY25 average as well, which is quite interesting. The average length of stay was flat at 4.5 days, and the patient footfalls remained steady. The ICU occupied days have also risen to 93 versus 91 a year ago and sequentially. So all told, a decent set of numbers. Remember that Fortis did not react too much on the day of its earnings, or maybe the day after, but the day after that, it gained as much as 7-8%. So watch out for this in trade today. Gujarat Narmada Valley, this is chemicals and fertilizer primarily company. Thumbs up. The revenues down about 2.6%, but here's another story of a margin expansion. The EBITDA has gone up by as much as 65%, and the margins have expanded from 6.9% to 11.7%. The PAT as a result has risen as much as 62%, coming at 211 crore rupees, and a pretty decent dividend as well, 18 rupees per share. What has worked is that there are costs that have dropped quite considerably in the quarter gone by. The employee expenses are down about 14%, the raw material costs have dropped about 10%, and the other expenses have also dropped about 9%. So all told, another strong margin performance for a company in the chemical space.
Yeah, so could be interesting how some of these stocks react. My quick 3 names, and I thought, KNR was an interesting one, but Anushi tells me that the news came in during market hours and the stock maybe corrected a little bit, but it's interesting to see NHAI banning KNR construction, so do keep an eye out for that one. Maybe there's a further reaction, but the news came in during market hours on Friday, so bear that in mind. So technically the first stock on my list is Inox Wind Energy. Now what's happened is that NCLT has approved the scheme of arrangement between Inox Wind Energy, Inox Wind and the shareholders. Effectively, the companies will now merge, as a result of which there was a ratio, earlier approved ratio of 632 shares of Inox Wind for 10 shares of Inox Wind Energy. And this means there is about a 7% arbitrage in favor of Inox Wind Energy shareholders. So effectively, if the shares are to be merged, as the scheme of arrangement is, if you buy Inox Wind Energy shares, if you would have bought Inox Wind Energy shares on Friday at the current prices, then there's 7% benefit that you get. So if the stocks open in flat today or at the same levels today, there could still be a 7% arbitrage if you want to play it. So keep an eye out for that. Divi's Lab is the second one. has signed a long-term manufacturing and supply pact with a global pharma company. The pact is for supply of advanced intermediates. This is the second such large one that Divi's has done in the last couple of months. Watch out in case there is a reaction on Divi's. So that's the other one. And by the way, there are a lot of results that the three of us haven't covered, right? Aditya Birla Fashion, JSW Steel, and a clutch of others, which we will talk during the course of the show. But the third very important stock, and which is what I want to go to Somit for, is Eternal. So that's the third stock on my list. But I'm getting Somit to talk about it because he's got this whole dope and done the whole math of what is it that Eternal will see in terms of rebalancing and flows through this week. Somit, fill us in.
Yes, Eternal will remain in focus given the fact that both MSCI and FTSE has announced their weight reduction for Eternal now. Because of this, there could be an outflow of as much as $840 million this week in Eternal, and this weight changes by FTSE and MSCI are implemented owing to the reduction in the foreign ownership limit that the company had done from 100% to 49.5%. So because of this change in the FPI limit that the company had announced earlier, both MSCI and FTSE have come out with this announcement. But there is something different compared to what usually happens with FTSE and MSCI. And what is different when it comes to FTSE is the fact that unlike the headroom related reduction these are implemented usually in phased manner, which means that if the weightage is coming down, it will come off in phased manner and there won't be outflows in one shot for any stock. But this time for Eternal, the outflows will be in one shot because the weight reduction is expected to happen in just one shot for Eternal. So that is different for FTSE. But when it comes to MSCI, there were no changes announced on the weightage of Eternal last week when they had announced the index reject. So the street never expected any change to come out up till the next review, that was in August 2025. But this is an out of turn announcement that MSCI has done and reduced the weightage of Eternal as well. Now because of this weight reduction, because of this FTSE weight reduction, there could be an outflow of close to $380 million on May 27th, and because of the MSCI weight reduction, there could be outflow of as much as $460 million on May 30th. So keep an eye out for FTSE. More importantly, why this will be important for Eternal is the fact that on Friday the stock had gained as much as 5% because despite the FPI limit going live on NSDL, there was no red flag that was raised. So street never expected this weightage reduction announcement to come in soon, and hence the stock had gained because it was kind of a relief rally that we had seen. But despite that, we have seen some weight changes coming in post the market had closed. So there could be a sharp fall when it comes to Eternal in trade today.
Watch out for Eternal. Because of an expectation of global outflows, not so much the fundamentals of the stock. So does that make this an opportunity to buy Eternal if you've been waiting on the sidelines? We'll get you all that and more on the other side. We have Parag Thakkar and Kush Bora joining us. All the top trading ideas as well when we come back. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Well, welcome back to India Market Open. Busy weekend and a busy week ahead and a busy day ahead. So we've got both our experts in the studios to try and understand what to do in a scenario like this. Kush Bora and Parag Thakkar on the technicals and the fundamentals respectively. Gentlemen, both of you, thank you so much for joining in. Kush, I'll start off with you because I want to understand the global headwinds which came on Friday have dissipated post Donald Trump saying, okay, let's extend it. And then couple of technical notes noted that in Friday's session, because the Nifty managed to eclipse its previous day's highs, it is a positive for a near-term trade. Now tell us if you would be a buyer in the Nifty or the Nifty Bank on open, and how would you trade it through the week?
Sure. First of all, very good morning, guys. And I don't know the weather in the rest of the country, but right now it would seem like we are shooting from a different time zone altogether. Yeah. That's the kind of cloud cover we've got in Mumbai.
Yeah.
And I don't know if you guys have observed this, but over the last few years, the prediction rate of the IMD has gone up significantly. I mean, gone are the days when we would say IMD ने बोला बारिश आने वाली है तो हम छाता घर पे रख के जाएंगे.
हाँ, तो आप आज लेकर आए हो छाता?
नहीं, मैं तो फिर भी नहीं लाया. I've got door-to-door pick drop, so I haven't really. But much like the IMD in the past, one of my previous bosses, in a very joking manner, said that analysts are a community that are paid to be wrong. Hopefully, that is changing for us as well and the IMD as well, right? So, from forecasting range to forecasting market, I completely agree with the last line, at least that Neeraj mentioned, which is that the lower high formation that the Nifty was making for the past week was negated on Friday, and that's a very positive sign. What happens now is that we come up with resistances, at resistances of 25,000 and 25,250. But see, that's the tone. The tone is bullish, and we're talking about where the next resistances lie rather than where the next support lies, which is very clear, close to the 20-day moving average of about 24,700, 650 thereabouts, right? So yes, the only trade right now in this market is on the bullish side. As I said, the resistances come up, but that's okay. You want to take them in your stride. If you have a position, continue to hold. If not, then for a second target of 25,250, the risk reward ratio from here on also is fairly positive. I have a slight concern, as I mentioned on Friday as well, with the Bank Nifty, where we saw the underperformance, at least versus the Nifty. What is interesting is that all 12 components of the Bank Nifty ended in green, and despite that, the Bank Nifty underperformed versus the Nifty, right? So immediate resistance is at 55,555 and then 56,000. Now, with whatever's being announced, by the RBI over the weekend, let's assume or let's hope that the momentum comes back with the banks. But what I would urge or what I would suggest, investors and viewers, is that start looking at financials beyond banking stocks as well. So insurance, I heard Neeraj speak about in the morning, NBFCs also. So some of these subsectors within the financials are also something that you want to look at, as in when the Bank Nifty goes sideways. The view here also remains bullish.
Okay, let's talk about the stocks that you've picked this morning, though. Before we go to Parag Bhai, and there are at least a couple of cement stocks that we want to talk about. But before we do, let's talk about the picks that you have today.
Sure. One outlier from the realty pack is Oberoi Realty. We've seen a good move on this one. We've seen a breakout in the last week, and then that breakout sustaining as well. So while I'm not very constructive on the entire real estate realty pack, but this stock stands out and hence made the cut on the long side. The weekly setup of this is very, very exciting. It's had a good volume based breakout on the weekly level as well. So from a medium term perspective, 1810, 1880 being your target, 1670 with with that being your stop loss. Oberoi Realty is a long trade. The other one is Strides Pharma. Here too, very interesting move, because for the last 4 weeks the stock was resisting near the 675, 680 zone. Last week we've had a good breakout again on the back of very good volumes. So this breakout could well sustain. The momentum could continue for targets of 760 and 790 with 700 being your stop loss. So Oberoi Realty and Strides Pharma are the 2 long calls for the day.
Parag Bhai, very good morning to you. What are you liking today? What are you liking today in context of what we have seen also overnight with Trump's mood turning? Are we going to see another good day for IT? Would you say that IT and auto are now spaces you need to look at seriously?
Sure. So IT, as I mentioned, I am equal weight on IT with TCS, HCL Tech and Emphasis. I have mentioned that basically betting on 4% dividend yield and good deal wins which they got in the last quarter, and their own confidence about the deal wins getting ramped up. So if there is any positive turn in US side, of course right now it is very foggy because US 10-year is above 4.5%, US 30-year we saw above 5%, and I don't think anything there is happening to reduce debt, which is a $36 trillion debt. So it's a gloomy scenario. So I would not go overweight on IT right now, but I will continue with these 3 stocks where I feel the deal wins were good and the dividend yields are good. And the other aspect which I would like to address is that, as Kush was also saying, that some time ago I think we spoke about Aditya Birla Capital at around 170, now it is 220, and that space, the interest rate sensitives, because in India I don't see there is a problem. At least the June rate cut should be done, although US 10-year is rising, Japan 30-year rising, so there will be some confusion around interest rate cuts in India also, but I would say that at least June rate cut is given. And this February, April and June rate cuts are slightly negative for banks. So I would not now go out and buy banks very aggressively, except for Federal, which I have told you for the different reason. But NBFCs or rate sensitives like Oberoi Realty, for example, which is also there in my portfolio also.
You would not go and buy?
No, I have already bought.
So, sorry, just before we go to that story, you're making an important point, Parag Bhai, here. You are saying that if you were in banks as well right now, maybe you would actually swap out of banks into NBFCs and rate sensitive.
Basically, I have already done that in my portfolio 1.5 months ago, when I saw that interest rate cut is a given. And as I was always saying that, of course, ICICI Bank result was not showing that, but it was given that February rate cut, April rate cut, then June rate cut. Definitely June quarter NIMs will compress for banks, while for NBFCs, the cost of fund will peak out. Right? So that's why we discussed Bajaj Finance also in the past at around 6,800 or so. So that is the time I started switching to some of the NBFCs, and then lately I have bought into some, apart from cement, which is my favorite, I have bought into some real estate like Oberoi Realty and Arcade Developers, and so those kind of debt-free Mumbai-based developers.
Interesting.
So, since we're talking about cement, JK Cement was on our watch list this morning. Did you take a look at the numbers? Would you see?
Yeah. So it has been a part of the portfolio. It's a company which is executing phenomenally well. 15% volume growth, 64% PAT growth, and EBITDA per ton of 1260, 5.8 million ton volume. Great company, executing well. The only thing is that, see, JK Cement is likely to do EBITDA of say 2,500 crore to 2,800 crore in FY26, and market cap is around 39,000 crore. So I expect that something like Remco, if the pricing stays good in South, plus whatever they have announced about reduction of debt, when Remco is at 24,000 crore market cap and its EBITDA is also likely to go to 2,500 crore in FY27, their market cap also can go to 39,000. So
the numbers weren't good. The numbers for Ramco weren't the best. Star, Ramco both came out with numbers. The numbers weren't good for Ramco.
So Ramco numbers were not good because March quarter saw a very subdued pricing environment in South. In South, the prices have moved only after 1st April.
So it's a regional play.
And plus a quality promoter who is taking right steps during bad times by reducing debt. That I always love. When a company who is a survivor takes some prudent steps, to cut down debt at a time when the cycle is, and now the cycle is also turned luckily.
And you're saying Q1 is going to be better?
Definitely. So in South and East, I have observed that after 1st April, the prices have moved up. South meaningfully, East little bit.
Okay, time for an NDTV Profit exclusive. In the latest from the JSW Bhushan Power case, the government has now started to review the gaps in the IBC code itself. Remember, on the 2nd of May, the Supreme Court rejected the resolution plan submitted by JSW Steel, holding it illegal and in violation of the IBC. Now, today itself, the Apex Court will hear a plea submitted by JSW Steel of that judgment. But importantly, what is the government looking at after this? My colleague Shimi has exclusive details.
Yes, government is reviewing its insolvency and bankruptcy code regulation in order to prevent the repeated instances like JSW Steel acquiring Bhushan Power and Steel. What we've been given to understand that Finance Ministry is adopting three-pronged strategy, which includes certain amendments in the IBC, and some of these amendments would be brought in the upcoming monsoon session is the indication we are getting, and these are mostly with respect to the process and the execution of such deals, and those approvals like for example the Competition Commission of India approval which is required prior to such resolution could be also done away with is the indication we are getting. However, Ministry is of view that there is no question of the robustness of the IBC. However, those gaps and the execution issues which has been highlighted by Supreme Court in the GSW matter, they'll try to sort of ensure and address those matter. In fact, the other one is with respect to having consultation with IBBI, the regulator, and the other stakeholders. In fact, all those ministries and departments which is being involved in such insolvency process, they will try to bring all of them on the same page. They're trying to sort of convey to have some commercial wisdom when it comes to insolvency process, and they will see whether there is a scope of further tightening of the regulation with respect to resolution professional in the CIRP, and also those involved with the code of conduct of these professional as well as committee of creditors. So all those discussions are already underway, and we would see some guidelines coming very soon in a few months is the indication again we are getting. And the third one is with respect to the ongoing matter in the GSW's case, where the government may not be the party of the review petition. However, the whole idea of JSW and the other lender is not to kind of challenge the Supreme Court verdict on the liquidation part. However, they're trying to sort of have some leniency in that decision, in the name of public interest, where a lot of employee hard work is involved. The operational creditors are there, the creditors are there, so they're trying to have some sort of relief there. And government, on the other hand, is of course monitoring the entire matter so that whatever the issues which is concerning and emerged in this particular case will be addressed in the IBC, and some tweaking in this regard we would see in the upcoming monsoon session is what the hint we are getting from the government.
All right, here's some brokerages coming in on JSW Steel, so watch out for that. A lot of action happening in any case with the Supreme Court hearing, but this is on its numbers, because remember, numbers have also come out over the weekend, and we in fact spoke with the management. On Friday, we had numbers coming out. So Morgan Stanley is maintaining an equal weight with a target price of 1,000 rupees. They say Q4 results are in line. BPSL, that's the Bhushan issue, that uncertainty remains. Standalone EBITDA was 5% below estimates. Overseas subsidiaries performance was weaker. Management expects improvement in FY26, mainly on the back of higher steel prices. Management believes to have implemented a resolution plan in compliance with the law and is in discussions with legal advisors for legal remedies. CLSA maintains an underperform, though they've hiked the target price to 880 from 825. They say Q4 is largely in line with consensus, spread higher but uncertainty ahead. Guidance is better profitability, but volume guidance is lower than their estimate. With BPSL, well, uncertainties galore is what they say. JP Morgan, on the other hand, has maintained an overweight, and they've hiked the target price to 1,085 from 1,020. They say the Q4 print was broadly in line with expectations. Supreme Court judgment on BPSL does not derail JSW's structural growth story. Company is well positioned to reach capacity market share well in excess of 20% in the next few years. And you'll also hear from Jayant Acharya, Joint MD and CEO of JSW Steel, at 9:40 this morning on India Market Open, so watch out for that conversation. I don't know if this is a stock that you're tracking, Parag Bhai, because
it's still very much there.
Yeah, very much there. No, so let's look at it in two parts. One is the Bhushan Power overhang, and then let's look at the numbers. Of course linked, but let's look at the numbers purely. If you take this factor out, which is what the Supreme Court has done and put a stay on their acquisition of Bhushan Power, how are the numbers at its core looking like?
Numbers are okay. See, I think again here also you have to look at it from forward perspective. So June quarter will be materially positive, because there has been a 3,000 rupee spread increase in June quarter. Of course, the volumes in both steel and cement in March are always very good volumes. In June, little bit of drop in volume, and now, I think because of this monsoon coming early, the volumes might drop slightly more than expected. But I would say that the spreads have improved. So you have to look, apart from Bhushan Power issue, I think you have to look JSW Steel from forward perspective. One of the good thing about this company is about execution, right? They complete projects on time, so the capacity increase always happens on time. And now we have got a safeguard duty protection. So it's a very good safeguard duty play. If you leave aside this short-term negative of Bhushan Power, which will continue to wane for some time, but if it drops due to that and goes below 950, 980, it's a good buying opportunity in my view.
Okay. We've got so many earnings to talk about, but Kush, I want to come to you first on a pretty big mover in a relative sense. I'm talking about a large cap. ITC moved 2.4% higher on Friday, and it led the IT pack, not the FMCG pack. I'm talking about IT as well, but FMCG pack. You had a big move. So, would you say that you would buy at this juncture? Do you bet on that momentum?
Not really, Alex. In fact, I recall a discussion that we had just before the results were to come out, and I said that don't buy because the setup wasn't constructive. Even after the result, what you've seen on Friday is more of a short covering rally. The volumes have picked up, but nothing to write home about, especially given the shorting volumes or the consolidation volumes that you've seen in the days, running up to that Friday big move. Immediately, there is a resistance at 440, so you might see some profit taking coming in at those levels also. So nothing to write home about. Momentum indicators rather flat, and the Friday move I reckon is more of short covering than anything else. So ITC, if you have, you might want to perhaps exit, especially if it's a trading position.
Okay. Some of the other numbers that came out and kind of stood out for us, Parag, I would want your views. I don't know if you had a chance to look at, and if you already spoken about GE Vernova T&D, but GE Vernova T&D, Hitachi Energy, I mean, these MNC names which have executed very well, the guidance has been pretty strong too, but steep valuation.
Yeah.
Would you venture, or the valuation?
So, see, it's a good space to look at, but I would say that like many other spaces, for example, we are just talking about DBs, right? Now, fantastic company, excellent order inflow, but when you see the PE multiple, 78 times trailing earnings, same is the case with these multinational power companies, right? The multiples are just too high. So when you pay such a high multiple, I would urge your viewers also to understand that when you pay 100 PE, you are getting 1% yield. Now your I would say risk-free bond in India is yielding above 6%. So 1% earning yield, even if you grow at 50% for 5 years, it is equal to today's government bond yield. So I think to pay high PE even for a quality business, then you'll see a time of consolidation. Like somebody would have bought IT stocks like Infosys and Wipro in 2000. He would have broken even 10 years after that, right? So sometimes to pay very high PE is very risky.
So speaking of valuations, then and another earnings in a different sector, I'm talking about chemical stock, Gujarat Narmada Valley. It had a pretty decent set of numbers and expansion in the margins as well. I had it on my list, 11.7% EBITDA margin on the back of a seeming softer expense overall. Employee expenses were lower, raw material costs were 10% lower, other expenses were lower by 9%. Very cheap valuation, relatively speaking. Would you buy that?
Yeah, sure, definitely. I'll deep dive into it. See, in chemical stocks, what you need to know is the PE is 12, right, trailing. Dividend yield is about 3%. So that actually causes a big alarm in my mind. So I'll definitely deep dive into it, and if the underlying chemicals which they make like TDI and all, if they have also bottomed out along with this China problems and all, and if they are rising, then definitely it's a great story to buy, because it's a great margin of safety.
There's an ammonia story, right?
Ammonia story, right? The TDI they also they make. And just to come back on Neeraj's point about power transmission, day before yesterday I saw NTPC Green has said that it has become difficult to set up a new solar power plant because the evacuation is a problem. So I would say that this space might be interesting also, because if you have to spend a lot of money on transmission, a lot of this power multinational like Siemens and ABB and all these companies will have some good traction ahead. So we need to study this, but overall broadly optically the multiples look very, very stretched.
point.
Okay. Soni Patnaik joins in. She's AVP JM Financial Services. Soni, very good morning to you. Let's get your index levels and your picks.
Good morning, everyone. Thank you for having me on the show. So, Taman, if we talk about the index levels, I think Friday's close for Nifty above at 24,800 marks as a crucial and a decent close on a weekly basis. Of course, the upcoming resistance is still towards 25,050 to 25,100 range. And a fresh move above this resistance level can take Nifty towards the 25,400 levels. Could be a bit difficult, but it may be a far-fetched scene for slightly short-term positional play. In any case, 24,800 to 24,700 also has multiple support levels, so there could be a bit of a consolidation before we see that upcoming move coming towards the 25,200 plus levels. Coming to Bank Nifty, which is clearly a better performer and showing relatively better strength than Nifty. I think Bank Nifty is heading towards the 56,000 plus level zones. It has seen decent correction in the recent past. 54,500 holds as a very key support levels. As long as the support level holds, Bank Nifty can head towards 56,000 plus levels.
Okay. What about your pick, Soni?
Right. So the first pick would be from the banking space. It is an Axis Bank, and it's also an official recommendation that we've shared with our GM clients. So one can buy Axis Bank with stop loss of 1175 and a positional target towards 1240 to 1260 can be seen. A strong close, multiple support levels towards 1180 can be seen, continuously bouncing from those levels, and has also closed above its 10-20-day EMA as of Friday's close. So we're expecting a positive move towards 1240 plus levels. The second buy pick also has a similar formation. It's in Bharti Airtel, which has been constantly supporting and defending the support levels of 1800. So one can buy in Bharti Airtel for targets of 1860 to 1875 and keeping a stop loss of 1800.
Bharti Airtel on top of Soni's list. We're going to take a very short break. We're right back with the pre-open with our interview with Chenu Agarwal of Ashok Leland. But before we get into that break, we are seeing a very, very rainy day, and some of those visuals will be on your screen very shortly. We'll be right back.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Welcome back. You're watching India Market Open, and clearly one stock that is going to be in focus in today's session is Ashok Leyland. What's interesting is that the company has announced a bonus, I think nearly after 14 to 16 years, so that's a good reward that's coming for the shareholders. But let's quickly take a look at what brokerages are making out of it. From a DAM Capital to Investec, Citi, Morgan, all of them, the ones that you see on the screens, they have given them a target price in the range of around 270 to 315. So that's the kind of range that you're looking at. Nomura has maintained a buy. In fact, they've increased the target price to a 275 to a 250 as well. So that's what Ashok Leyland is looking like so far. In fact, let's also get in the management. We have the Shenu Agarwal, MD at Ashok Leyland, joining in on the show. Shenu, good morning and welcome to the show, and a pleasure to speak to you as always. My first question coming to you is, a strong set of numbers, 40% jump is what you've seen in terms of profitability. FY25 as well, a jump of almost 26%. What has led to this kind of a growth in a time when the CV cycle was slightly muted? And is this number something which is going to be sustainable going ahead?
As far as margins are concerned, we are very happy that we could report 15% EBITDA margin in FY25 Q4. And for the whole year also, we were up by 70 basis points at 12.7. Now, see, this is not a result of anything special that we have done in Q4 or in the year. This has been a result of our strategy that we have adopted over the last 2 to 3 years. And we have 3 very clear pegs on this strategy. One is that we want to achieve higher realization per vehicle. And therefore, we are working on every segment, on every product and every variant to see how we can add more value in our products. That is one. The other is that you are aware that Ashok Leyland has a cost leadership position in the industry. That is a big strength for us, and we want to continue to work on that. Therefore, a lot of focus has been on looking at cost, whether it is material cost or any other cost, and see how we can optimize the cost further. So that is the second lever. And the last lever we believe is after sales service is equally important, if not more, than a superior product in this CV industry. And therefore, we have started a project a few months back, which is now yielding some results, where we are benchmarking our service operations to the global best. Basically, our product, the kind of product we sell, is a revenue generator for our customers. So if the product is down or is waiting at the workshop to getting the service done, or is has a breakdown and needs immediate assistance, etc., so those are the levers that we are working on. We are embedding a lot of technology into our operations, service operations, including AI and prognostics and other things. So, it's a well laid out strategy that is just yielding results, and we do hope there is a lot left in this strategy to be done, which we will continue to do, and therefore these kind of initiatives should continue to reflect in our performance in the future as well.
Shenu, so that's with regards to overall business. A quick update, if you could help us understand with Switch Mobility, and this is specifically because we are amidst that tariff war. You have seen a EBITDA break even in terms of Switch Mobility in FY25. So is it where, the situation is where the IPO is on the cards? And when do you see it returning or coming to a net profit number?
No, we are not, we don't have any plans to go for IPO in Switch right now. What we want to do is, our path is laid out very clearly. Number one, we wanted it to be EBITDA positive, which is now EBITDA positive in FY25. Next, we want to start generating cash in Switch India, which means it has to be PAT positive and generate enough cash to meet the requirements of its own capex, which we hope that we will achieve in FY26. And the third target is then to scale up Switch India by gunning for market share and gunning for volumes. Once we achieve these three goals, then we can look at a possible IPO. So therefore IPO is still a few years away. Eventually we will go to an IPO because we hope that we are confident that this company Switch will add a lot to the success of Ashok Leyland, but it is still a few years away.
Shenu, from an investor perspective, overall, a bonus that has been announced, I think, almost in 14 years. What's the thought process behind the same?
No, very simple. We just wanted to reward our shareholders. We are sitting on a very healthy cash position, and therefore in FY25, we have announced 2 interim dividends, which is 625%, which is 6.25 rupees per share. And we also, our board also considered that we should issue a bonus share to reward our shareholders further. This will probably improve the liquidity of the market. This will improve the trading in the market, and therefore, it should help shareholders to that extent. So, we are doing financially very well. Our EBITDA has moved from 4.1% in FY22 to now 12.7%. So, in just 3 years, we have really turned around EBITDA. We have a very positive cash situation in the balance sheet. We have a clearly laid out strategy, in all parts of the business, whether it is defense, PSP, aftermarket, MHCV or LCV. And since we are doing quite okay and the future prospects of the industry are good, we thought we should be rewarding the shareholders.
Absolutely, a strong reward coming in for the shareholders as well. Thank you, Shenu, so much for joining us on the show at NDTV Profit. Always a pleasure to speak to you. So, Alex, clearly the stock itself is up nearly 1.5% in pre-open. Let's see where it heads up to from here on, taking into consideration a couple of upgrades from a target price perspective that have come in so far.
Absolutely, you said it. Thanks so much, Hiral, for that. And watch out for the stock in trade, of course. But before we get into more stocks that you should watch out for, take a look at the rupee. It's hovering around that 85 mark against the US dollar. It has actually moved quite considerably. Let's pull this off because the number is actually around 85, and that might be incorrect. It has moved from 86 levels all the way to 85 very quickly. The move is from 85.17 at the end of last week to around 85 right now. Remember, the dollar has been losing strength against a raft of currencies. Even the dollar index at this juncture is at around 98.8, and that should give you an indication as to what has happened over the course of the last couple of months. It has moved from around 100 levels down to where it is at right now, and the rupee therefore is something that you should watch out for in trade today. A few more stocks that you should take a look at. GVTND, we were talking about the earnings being blockbuster. It is looking like it's going to be a positive start for this company, close to 9.5% or thereabouts. Anupam Rasayan, again on earnings, reacting up about 2.3% or thereabouts. Azad Engineering up about 2.3%. GNFC another 2.3% higher or thereabouts, or 2% higher. A lot of movement right now in the pre-open session, close to closing that. Anything standing out to you, Kush, right now?
I think in Azad Engineering would perhaps continue the momentum that it had over the last 2 months. We saw some consolidation over the last week, but we all know how the last week went by. So I think on the way up, 1870, about 1950 are good levels for Azad Engineering as the next target. Support zone around the 1780 mark, which it respected for the most part of the last week. So I think this one stands out. I think a brief pause, but I think on the whole, the medium-term structure is very bullish, and this rally could well continue on the upside. 1950 are your targets on the upside.
Some other stocks, I want to see what Eternal is doing in the pre-open session. We talked about how that clarification on flows is going to be negative for Eternal, 2% down on the stock. Look at Brainbees this morning on results. Brainbees is standing out. Some decent set of results which we haven't yet covered in detail, but Brainbees is about 2% up, showing some good movements there. Afcons on the other end of the spectrum, not a great set of numbers, nor is it for Sarda. So you're seeing some pain points in some of those stocks there. I'm just wondering, Kush, is Eternal an opportunity to buy? You are going to see a downtick here because of the reversal in news on outflows. So you'll see outflows now expected coming in because of how they've hit their foreign holdings cap. Is it an opportunity to buy for those who've been waiting for some downtick in Eternal?
So what's happened for the entire calendar year so far is that the range of 240 on the upside and about 200 on the downside is playing out. Right now, despite the kind of cut that you're seeing in pre-open, it's still closer to the upper end of the range. The risk-reward ratio is not favorable. Do I see a momentum breakout beyond 240? Not really in the near term, because the volumes aren't really supporting. Plus, as you said, the news flow isn't really corroborating that theory. So I would wait, perhaps closer to 210, 215 zones, where the risk-reward ratio from the range play itself makes it favorable trade, is when you consider. Right now, if you have it, you might want to continue to hold because it's still consolidating. But if you're looking for a trade, I don't think the risk-reward ratio is quite favorable, despite the downtick that you're seeing at open.
Okay. Let's go across for the top brokerage call of the day. Motilal Oswal's coverage initiation on Radico Khaitan. Harsh Johnson for that. Harsh, good morning.
Good morning. There's a 20+% upside sitting here is what Motilal Oswal believes. In fact, target price being 3,000 rupees. They are talking about one of the oldest and largest manufacturers of Indian-made foreign liquor, and that's Radico. They're saying that net revenue is currently at around 4,800 crore. They're expecting around a 16% growth, at least in the medium term, on that number. Volume at around 3.1 crore cases in FY25 has seen a sharp increase, and moreover, that has been led by premium and above, and that's what gives them a lot of heart with regard to the way in which this brand is moving. They're saying premium will continue to grow at a much faster clip. 9% is what they're building in terms of volume growth, but premium will grow at 15 to 16% in terms of volumes, which should add to margins. Of course, when you're looking at geographic footprint and the spread there, they're seeing consistent expansion on the distribution reach. Touch points have now reached 110,000 on-premise locations sell their liquor. And of course, it's an industry where there are several industry barriers. How will growth sustain? Of course, it's premium and above category which is driving growth. Margins, it'll depend on glass as well as extra neutral alcohol, which has kept margins subdued. In fact, margins have missed the guidances, and that's probably one of the concerns. Debt too could likely start to come off now. FY25 has seen the debt come off, but they expect ROE and ROIC ratios to start to improve going forward, given that a large part of the capex is now behind. Currently trading at around 67 times. They value this at 60 times. FY27 June numbers, or June 2027 numbers. Key downside risk, of course, being inflation and pricing of raw material, excise duty increases, as well as competitive intensity.
Thanks a lot for that, Harsh. So do watch out for Radico Khaitan, but no big moves there. So I'm going to skip the question on Radico, viewers. You've got the Motilal Oswal view, but it's only 2.5 minutes left. So I want to talk about one particular space wherein Astral, in their interview, said that there have been a hike in PVC prices, and usually a hike in PVC prices leads to an uptick in pipe company stock prices as well. Parag bhai, it's a sign, right? Some demand is coming up, they pass through, revenue growth happens, maybe margins improve. So Astral, Supreme, Apollo, Prince, what have you? Do you like that space?
So basically, first of all, disclaimer that I don't own any stock at this point in my portfolio. But Supreme Industries and Astral Poly are great companies, definitely fantastic companies. So at some point, definitely they'll find a place in my portfolio. Currently, just because of the valuations and the point which you are referring, what happens in this PVC thing is, when the prices go down, they suffer inventory losses. When the prices recover, the inventory losses come, so they reverse. So that is one positive. But at the same time, when the prices are low, the volume grows because the affordability increases, right? So I would say that the PVC price moving up or stabilizing is a good thing, because the entire trade channel will now start buying, because now they'll feel that, okay, now the price fall is arrested. So they'll rebuild the inventory, and that is positive for Supreme and Nestle.
Okay, just want to take a quick view from Sony as the pre-open session has settled in. We're looking like we're in for a quiet start, actually, more than anything else. Sony, anything that you're spotting standing out for you after the pre-open session?
So Tamana, it would be from the cement space, and my, the stock that is in my radar is Ambuja Cements, holding above a 560, 558, immediate support. If continues to defend this support, can head towards 595 to 605 odd levels, and I think one can actually keep this stock in radar. Maybe even try to add on dips towards 568, 565. That range can also be the accumulation zone where one can initiate a long positions towards a 595 and 605 targets.
Good stock pick based on what you've seen in the pre-open?
LT Foods, we had a target of 415 as the first target and the 430 mark as the second one. First target being hit. Momentum very strong, excellent moves last week. This could well continue, so continue holding on. If you don't have, still initiate for targets of 430 and higher. And now your stop loss will be close to the 405 mark.
Okay, we'll talk about some of the other stocks post-market open now. The clutch of stocks which have to be discussed is just such a packed day. It's raining stock moves this morning, as maybe not as heavily as it is raining in Mumbai, but still it is. So 10 seconds left for the markets to kickstart. We have a quiet start to the trading day, which is not bad considering what the US markets did on Friday. Remember, both US and UK markets are shut for today on account of some Memorial Day, but 1/3% up for the Nifty. It's not a bad start actually. Banks are giving company, IT is giving company, in fact 0.5% for the Nifty, IT as well. It's picking up as we speak. Mid caps 0.6%, small caps 0.6%. Not a bad start at all. Now, I mean, maybe you could argue in line with what the Asian markets were doing. Bring up the heat map and show you what's moving and what's not. So except Eternal, none of the other stocks in the red. This is a very, very green screen, even though the moves may not be exaggerated. So Eternal, BEL, but Eternal in particular, 2.5% lower. We Sumit highlighted this early morning for all of you. NTPC 1.5% higher, M&M 1.3%, Grasim, JSW Steel not a bad reaction. I think this is more a reaction to their FY26 guidance on volumes, etc. Even as they include Bhushan Power numbers, so Bhushan Steel numbers, so keep that in mind. There is Ultratech, there is ICICI Bank, Hindalco. So the Aditya Birla clan is also having a fairly good morning. Power Grid is up 1.6%, Tata Motors up 1%, but that's about it. I mean, there are no big standout movers, viewers per se. On the gaining side, I think the one key takeaway is what Eternal is doing and slowly sliding to 3.5% lower. Whether it's an opportunity, no, remains to be seen. But on the gaining side, no rara moves, but still very, very pleasing to see so much of green on the screen.
Yep, and Eternal, is it an opportunity to buy is the question. IndusInd Bank also slipping into the red right now. JSW Steel will be in focus for more reasons than one. Also perhaps because of what's happening in terms of the Supreme Court and the government's view on the entire IBC situation. I'm also going to pull up the sectoral heat map if we can before we get to what is happening specifically on the small and mid cap. Nifty Energy in focus this morning, metals in focus this morning. It's a great screen, frankly. This is not something that you should be worried of at all. Yes, no crazy moves, but definitely a smart screen. You have the Nifty now above the 25,000 mark, which is also a good start to the morning coming in. I want to pull off the mid cap, the small cap index, as well as the India VIX. Before we go into stock specific moves, 0.5% up on the Nifty mid cap 150, about nearly 0.5% up on the 250 as well. India VIX is also up above the 17 mark. So that's not great, 3.5% up, but nothing too much to worry about. It's all about results. Let's get specific moves in. GVT&D, good numbers. Azad Engineering, good set of numbers. Brain Beeves, good set of numbers. Is the street rewarding them this morning? JK Cement, also good set of numbers. Well, 10% up on GVT&D, could well be the stock of the morning. Azad Engineering, all of these on our watch list, by the way. 3% up on Azad Engineering. Brain Bees, about 1.5% up this morning. Let's pull up JK Cement, see what's happening there. Anupam Rasayan, again a good set of numbers. Street is rewarding it. JK Cement 6% up. Strong quarter for them with a huge boost in margins. NTPC also a good set of numbers. GNFC, Glenmark, Let's look at some of those as well. Glenmark was not the best set of numbers, and that's being seen on the street. GNFC, on the other hand, was 4.5% up. Afcons and Sarda Energy, actually, frankly, in the dud list as far as the numbers are concerned. And Sarda Energy, 6% down thanks to that. Divi's Lab is the other one that we should pull up. They've had an agreement with a global pharma company, 3.5% up on the Divi's Lab stock right now. So these are some of the big movers this morning that we're seeing, Alex. All in all, not a big morning, not a bad morning at all. I think bulls are firmly in charge.
Yeah, Tamanna, I think you and I got our colors absolutely bang on today. You've got green, I've got mostly green with a splash of red, and I think that's how you would describe the market today. Just a small splash of red, and that splash is diminishing. Might have to change my tie in another hour or so. But 0.6% higher for the Nifty 50, 25,000 broken on the upside. First, before we get into any stocks, I'm curious about what Kush makes of this, because you still had quite a considerable amount of call open interest at 25,000. If that does get taken out on the upside, what is the implication for the rest of the week, Kush?
I think then the second resistance level of 25,250 comes into play. I will be a little cautious around this level, whether I initiate a fresh long position or not. I won't. I mean, if I did it very early in the morning and it's just been 4 minutes to open, but if I did it at open and if I have this kind of a profit, I would perhaps take it home. If it's a positional bet that you've taken, you might want to ride it because, you're coming up at a resistance, but, you seem to be knocking at the doors and slightly, the moves are slightly higher going past it. Fresh position risk reward ratio might not be as favorable, but yes, continue to hold. As we mentioned, the texture is bullish, and as we saw from the wall that most of the sectors are participating, so you don't want to sit this one out.
Okay, speaking of specific stocks, and we've spoken about quite a few that are reacting to earnings, one that continues to react to developments from last week is Emcure Pharmaceuticals. Pull that stock up 7.7% higher at this juncture, and the question is, how high can this one go? Soni Patnaik, the question to you, if you have a trade ongoing, would you take money off the table? Would you venture to put money in fresh in Emcure?
So I think, Alex, we've seen very strong move, and of course the stock is sustaining strongly above its 200 DEMA, but it makes sense to book some profits if you're already holding it, long strong, maybe like a 1200, 1220 odd range. It makes sense to book some profit or at least trail the stop loss towards the 1220 odd levels, which is where the support can be seen next. In any case, if there's any profit booking towards that support levels, one can reinitiate the buy, or else continue to ride with a trailing stop loss, and the next resistance can be seen towards a 1420, 1450 range.
Okay. Call from you, Parag Thakkar, on what the first start of the markets are looking like, and especially on Eternal. I know we've spoken about Eternal. This is something that you've skipped in your portfolio, and you've said that perhaps, if you have an opportunity, you'll look at it. Yeah, do you think that opportunity is now?
Yeah, might be below 215 or something. I'll look at it because, but see, the point is that the multiples you cannot understand in this business because the size of opportunity in long run is very high. People are assigning very high multiples to these businesses, and actually the businesses are getting more and more competitive also, right? We are hearing that a lot of this 10 minutes and 15 minutes concepts are going away because they want to reduce losses. They have increased the prices to the consumers. So I would still wait. I will not jump in as of now. By the way, one of the stocks which we discussed in the pre-morning, JK Cement
is doing well.
Because it's a superb execution. When the market which it addresses is growing by 4-5%, the volume growth of 15% along with good prices and good EBITDA, I think was a good. Of course, that said, I'm not recommending stocks to buy at this price. The stock has gone up so much.
Yeah.
Same with the Emcure Pharma. In fact, the results are phenomenal.
But
and it is an uncovered stock. Hardly 2 or 3 broking houses cover the stock, and stock has done phenomenally well. Commentary is also superb, and that's why we are seeing this rally sustaining. Right, 10%, 10% today, 7%.
7%.
But very good numbers, and in such environment when the world is so much totally full of uncertainties, I would love to buy a pharma company like this which delivers such
these
strong
valuations.
numbers. So basically, see, it's a mental block also, right? You have seen it at 1,000 rupees some days ago, 3 days ago. Now you cannot buy at 1380.
Wow.
But that said, I am not saying that this company is very expensive. If it continues to deliver this kind of numbers.
I love the idea of a mental block when you see that. I wonder what people are feeling about GVT&D this morning. All right. Thank you so much, Parag Bhai, Kush Bora, and of course, Soni, for joining us in the first leg of the show this morning. But we have a great conversation coming up next. Aditya Suresh, Managing Director and Head of Equity Research at India at Macquarie Capital, joining us now on the show. Aditya, always a pleasure speaking with you here on NDTV Profit. Thank you so much for your time. Let's just start with how you are seeing the markets right now. Last time we spoke, I recall you were quite skeptical about the kind of bull run that we were seeing. And of course, a lot of water has flown under the bridge then, Trump's flip-flops, etc. But right now, do you think the mood changing for emerging markets and especially India?
No, thank you for having me on the show. So maybe just going back our conversation to level set a little bit, was that the core kind of dynamics which we were speaking about as to why we'd be a bit more defensive and very selective in terms of where we're positioned, is that one is we thought that earnings is not your friend, where we did see kind of downgrades come through. We expect more downgrades to kind of come through as well. And growth momentum was kind of softening, right? So earnings wasn't really your friend given where expectations were at. Point two was about kind of foreign flows. Point three was about the moderation in domestic liquidity. And when you kind of think about those three kind of aspects, earnings, we still believe at today's juncture is not your friend, right? So expectations are full. We still see cuts to earnings, whether it be fiscal 26, fiscal 27, which is still to be absorbed in the market, right? So that's kind of one dimension. Even just calling out this quarter, when you think about kind of whether it be net profit growth, X of say something like a Bharti Airtel, you're hardly looking at any net profit growth for all the companies which have reported. But we're still sitting at, as a market, let's say 12, 13% kind of growth in earnings, right? So there is still that uplift in and inflection earnings, which us as a broking kind of community is calling for, but that's not really been the trend. So earnings not your friend. I think foreign flows has been a key change since we spoke to Manav. So and there it's really been about the dollar. And so the jury's still out how this kind of shakes up. Now, to the extent that the dollar is going to soften, our working assumption is that that's going to mean EM in general sees more flows, and within that, India sees flows, right? So I think the key change has been on this on the foreign flows into India's market. Domestic liquidity again, as it's kind of there and thereabouts compared to where we spoke. Incrementally, do we see this as a support factor? Not really. I think that the current pace in itself is a good number. So I think the key change has been about this the Trump dynamics and how that's kind of impacted the dollar, how that's impacted kind of fund flows. Just taking a step back, yeah. So we've been like clearly positively surprised by the resilience and strength of the India market. It still kind of shines very, very nicely in a global setting.
Hi Aditya, good morning. So earnings not your friend, then what according to you is going to be the primary driver in the remainder of this financial year? Because a lot of people, so I think the range for earnings expectations for the top companies in India are anywhere between nominal GDP growth and about 13-14%, right? So where does your estimate sit, one? And do you think flows into the country as part of what is playing out globally is going to be the primary determinant of near-term triggers for Indian equities?
No, Alex, so just in terms of our, to give you some background, right? So like when you look at the trend in the past 4 quarters, whether it be top line or net profit, and when you kind of look at even at a headline level without excluding some of these one-offs, we're looking at like, let's say mid-single digit kind of net profit growth, right? And if you take out something like a Bharti Airtel types, and that the impact which that's had on earnings, and you're looking at basically flat. If you take out financials, again, similar kind of comment. So the point is that that's the past, say, 1 year, right? Now, on a go-forward basis, as you point out, there's some version of nominal GDP growth plus 200, 300 basis points, which is kind of embedded in estimates. Our bottom-up estimates are meaningfully below this. In fact, we'd be more like nominal GDP minus rather than plus. And you can kind of go through at a stock level, sector level, and kind of drill down on this, right? So even, for example, with the financials, we think estimates for the larger private banks needs to kind of come off, right? With IT, you'd see that moderation in guidance, consensus kind of reflecting that in estimates as we speak, so on and so forth. So even where we've seen kind of optimism on earnings, it's been more in the cyclical areas rather than being kind of it being your financials and IT and your pharma, consumer, these type of names.
Aditya, good morning. Neeraj here. So if I expand that universe to Nifty 100 instead of just the Nifty 50, right? And I'm trying to think that there is the first half which will have the benefits of the low base of last year. IT numbers or IT outlook may improve if anything. Metals don't look all that bad if China is looking okay. Banks are okay. Yes, there might be some NIM contraction, but nothing too dramatic, I presume, right? Why is it that earnings will be lower than the nominal GDP growth?
Yes, I think it's just about kind of what's in expectations on both the top line and then the margin, right? I think on the margin side, there are kind of risks kind of worked through. For the banks in particular, it's on the margin dynamic where at least we're seeing a moderation in estimates. With IT, it's more about, okay, so you have the guidance, and that guidance meant that consensus had kind of rebased lower. And so that's kind of clearly not a GDP linked kind of construct, right? With consumer, it's specifically on margins, right? So in consumer discretionary in particular, there we feel margin estimates are far too optimistic. With pharma, again, you're seeing some of this kind of come through. So Neeraj, I think the broader dynamic is more about, yes, you will see growth in certain areas, and that's good. That's on the top line. But some of this is being offset by margin pressures. But I think that the overarching comment was that what's in the market is, let's say, with a low pace of earnings growth back towards that typical 10, 15 kind of number which people think about. And for that to happen, that's already in expectations, right? So at best, we're meeting those numbers. The real risk which we think about is margins disappointing. Growth in itself, I think, so we're more in the camp that we'll see a moderation in that pace of growth.
Aditya, let's put this into perspective. What's the best case scenario and the worst case scenario for Indian markets going forward? I think the worst case scenario is something that you've described in some detail, and earnings is a big part of it. What is the upside that you're seeing here, and what would be the factors that would change that perception?
Yeah, no, I think like even today, the Nifty is trending above 2,500, right? 25,000. The broader dynamic is that I think a lot of this is going to be about how liquidity kind of shapes up. So you have the regulator, which has been supportive, right? So RBI has clearly been kind of pro-growth, if I may. Inflation is soft, and it's going to continue to remain soft. So could we get a further, say, 1 or 2 rate hikes from the RBI? Possibly. We've seen this kind of dividend from the RBI as well. So I think when you think about the 10-year bond deal, that in itself, I think, could moderate further, which would then make the India bond deal compared to the US almost the narrowest it's ever been, right, in terms of the gap. So I think the main dynamic which kind of keeps the more optimistic case is going to be about kind of the cost of capital continue to come down, and that's supporting already high multiples. So therefore, as a market, could we be at, let's say 10-15% higher just on this kind of liquidity cost of capital dynamic? I think we can. I didn't want to leave you with the conclusion that therefore what you're saying is kind of meaningfully be underweighted. That's not what you're saying. What we're saying is that I think as a backdrop, earnings in general, kind of what's in expectations is already full, right? So we're being really selective in terms of which stocks and sectors we're really being exposed to.
That's fair enough. That's fair enough, because earnings also have to be seen relatively, and you're right that there might be more misses than hits there. So when you're being selective, just trying to understand, and I don't know if you'll give us any specific names, but just trying to understand where you're veering, Aditya, what you're liking right now.
Yeah. So this is a published list. So what we do on the bottom up is that so we have our own version of kind of best ideas, and it's called Super Sixes. So core names in that list, right? Where at least we have conviction on the fundamental and earnings. it'll kind of give you a flavor kind of where we're tilted towards. So one has been Bharti Airtel, two has been TCS, three has been HDFC Bank, M&M has been part of that list. Then the two other names, which probably is more kind of where it's the jury is still out, is more Trent and PFC. So those six. Then we have another basket which is more kind of tactical in nature. Stocks like Reliance, NTPC, Bharat Electronics, these type of names kind of fit in there. And then we have this list of kind of small mid caps, because I think like small mid caps it's been painted with a brush that avoids small mid caps full stop. We don't take that approach. Even within our coverage, we still have these kind of 6 small mid caps where we think there's a good shot of these companies doubling on a 3-year basis, right? So we have names like Delivery, Lemon Tree, IRCTC, AB Cap, these type of names there. So all this is part of the published Macquarie research.
Okay, Aditya, on the platform businesses, and now we have a material set of them, and I'm guessing that you guys might also have some coverage on some of them, if not all. The only problem with bucketing them as a sector is that each of these have a different vertical specialization, right, in some fashion. So just trying to understand, would you prefer a basket approach to the portfolio name or the platform companies, or is it very bottom up? And what within that do you like? Do you like an insurance platform or a food delivery platform and a quick commerce platform? What do you like, if at all?
So we cover quite a few of those platform names. Unfortunately, the bottom up for us does not justify a positive stance. And so, for example, with a popular kind of food delivery, quick commerce kind of platforms, both of them were being kind of underweight rated. With the larger insurance platform, PB Fintech, we're being kind of underweight rated there as well. And this is not to say that there is no growth, right? So there is spectacular growth, for example, in I'm the analyst covering, say, Eternal and Swiggy. So there is clearly a lot of growth in these platforms, in particular in quick commerce. Our challenge has been about, at some point, that growth has got to mean something from a profit perspective. Doesn't have to be today, but even if it's like 3 years, 4 years, 5 years, whatever it is. That pathway, at least in quick commerce for us, in the face of rising competition, is ambiguous. And so in terms of kind of the value which we're ascribing to that optionality piece, which kind of gets or drives up some of these stocks, we're not there, right? So the value of that option, if I may, we're not seeing it clear enough. And that's more linked to kind of fundamentals and the economics which we see. But, like if I take this back to like an OTA space, something like a Make My Trip. Make My Trip is generating a lot of free cash flow. The platform is generating a lot of returns. That ROIC is going to expand. They're dominant in that space. So really good fundamentals, right? And that's kind of a platform which we like, we want to own. But valuations are kind of, we think, full there. So it's these type of considerations, Neeraj. So I would be very selective. Again, it's going to be bottom up. But I think the overarching comment, at least when we think about these companies, is yes, you may have the growth, but that growth has to be with free cash flow and has to be with at least a path towards some profit, which is sustainable.
Okay. Aditya, I wonder what you think about some of these transmission and distribution companies. The disadvantage, I think, here is that while the earnings trajectory is there, and I'm specifically talking about a company like GVTND, I was looking at the numbers, they look really, really good, but the problem is on the valuations, right? It's a discovered theme. Is that something that you see as well? Or do you see any pockets of opportunity in the broader power and distribution space?
So we don't cover the stock which you mentioned, but I think the comment about kind of this being a discovered story, it's in the price, in the multiples, etc. I think that's a fairly common construct across quite a few stocks, right? So that on its own, I think will be less in terms of how I think about it, but it'll be more about can earnings kind of meaningfully expand, what's kind of in earnings expectations, that type of stuff, right? So within the broader kind of power space, so we do like NTPC, and so our analyst there is constructive on in fact growth, free cash flow, maybe a positive dividend angle. So NTPC is one which we like. We do have a positive view on Power Grid as well, but within the two, we like NTPC more.
Okay. We'll leave it at that, Aditya. Thank you so much for taking the time out and being with us today and giving us your thoughts. Good to have some checks around numbers, And your views on the same, of course, as always.
Thank you.
Thank you. That's Aditya Suresh of Macquarie. Not quite constructive. And I think that's where the tide has been, ebbing and flowing around the confidence on results or otherwise. This morning I saw a note from, I think, one of the dailies which said that the earnings growth has actually been positive. But guys, the one thing that stands out today is Balkrishna Industries or Balkrishna Tires, right? Because, I mean, just look at what's happened to that stock because of, I think, two key factors. One, that the numbers were below estimates. The profit after tax was down 24% at 362 crores. The estimates were 448 crores.
Yeah.
But more importantly, Balkrishna Industries has said that they are entering into, rather they've announced an entry into commercial vehicles and passenger vehicle radial tire market for India by quarter 4 FY26 and FY27, and this capex should probably hit them. So I think, which is why the stock is down.
Which is interesting because for those that don't know about BKT, it's actually an export-oriented off-road tire play. So quite a lot of its margins come through because of its export play and those heavier tires, which generally give you better margins. And if the volume mix is going to change, and if there's considerable capex that is also lined up, from an earnings perspective, it's not going to be very positive.
Right. We just have about 40 seconds for that JSW Steel interview. So I want to get Hiral in very quickly to set that up. Hiral, just take us through the numbers.
Thank you, Tamanna. So clearly, the numbers have been in line with what the street was estimating, but it's a good set of numbers because if you see in terms of the profit number, that has seen a growth of almost 16%, and this is mainly on the back of lower costs. Additionally, they have not made any provisions which are related to Bhushan Power as well. Overall, if you talk about the consolidated sales volumes, they were up around 11% on a year-on-year basis. However, mainly the sluggish pricing with regards to steel has caused a decline in the company's consolidated revenues as well. So that's the overall picture to just set it up in terms of the conversation.
As brisk as it can be. Thanks for that, Hiral. Now, joining us now on the show for the numbers is Mr. Jayant Acharya, Joint MD and CEO of JSW Steel. Mr. Acharya, good having you. Thanks for joining in. How would you sum up the year and more importantly, the quarter for us? It was slightly above estimates.
Yes, I think we had a very challenging year gone by. The external challenges which we navigated through have been many, geopolitical, trade-related, etc. In spite of which, JSW Steel delivered a very strong operational performance in the quarter. Our production was the highest ever at 7.6 million tons. It grew by about 12% YOY. Our sales were also the highest again, primarily led by Indian operations, which were fueled by a very strong Indian demand. So very strong quarter. As we see going ahead, we see equally strong year in FY26 on the back of a good economic activity in India and strong demand of steel continuing.
Mr. Acharya, China is picking up, but we also have an ADD which kind of, makes our steel prices our own. I'm just trying to understand though, because China is picking up, how does that augur for steel prices and the outlook and thereby your FY26 results as well?
So just a little bit of the background, you know that last year the exports from China were at one of its highest, and we continue to see increased exports from China. So therefore, the safeguard duty which was levied by the government was a very proactive and helpful step for providing a level playing field to the domestic industry. That has helped the domestic industry to be able to recover from the lows which were seen in terms of the prices in December and January, primarily because of dumping. The rest of the world has reacted more or less everywhere with increased tariffs. That has been reflected with improved prices from the lows in those countries as well. So we see quarter one giving an improved price flip vis-a-vis the quarter four gone by, since the prices started increasing towards the later part of the last quarter and in April of this year. So I think better pricing, lower coking coal cost, better operational efficiencies from JVML will be very positive in terms of our margins for the quarter coming in.
Mr. Acharya, what is the guidance that you're giving for FY26?
So on the guidance, we are looking at a 10% growth in this year in terms of volume, an incremental 10% on the back of primarily the India growth. On the pricing and the operational efficiencies pricing I talked about, we would see probably an increased price in Q1, and we would expect that to remain range bound during the year. However, the positive is that our cost efficiencies in various areas are kicking in. JVML, with the largest blast furnace will provide a lot of operational efficiencies vis-a-vis our existing operations. And we will see the cost being significantly lower, which will structurally build into the margins. The second thing, as you said, is the renewable energy component. Our renewable energy has ramped up sharply, and we would be having more than 1 gigawatt of renewable energy by the end of this quarter, and that again would reduce our cost. Our operational efficiencies on our raw material sourcing and blending will again reflect in our costs. So all in all, we certainly feel that we will have a better operating environment and operating margin for the coming year.
What about BPSL? Mr. Acharya, that's quite a bit of a setback, right? And an impact on the future piece of your growth too. What happens next here?
So, as you know, the matter is sub judice in Supreme Court, so I will be able to share limited information with you. But, we would like to reiterate, number one, is that we have implemented the resolution plan in full compliance with the law. Secondly, the asset has been revived as it stands today with a very strong operational performance and improvement. We have analyzed the case, the matter along with our legal advisors, and we feel we have strong grounds for looking at all the available legal remedies which are there, and we would do so.
Okay, so Mr. Acharya, tell me, does the volume guidance for FY26, does it include the assumptions of BPSL, and by when do you think you can actually resolve this issue?
The volumes certainly assume part of the BPSL operations as we see the situation today. In terms of the timeline which you asked, it will be difficult to really put a timeline in place when the matter is sub judice, but I think we will have to see how it goes as the days go by.
Got it. Okay. Now, how does this impact your expansion plans? Because your target was for this 50 million by 2031. Does the BPCL issue impact your expansion?
So, as in terms of our expansion plans, as you said rightly, 50 million tons by the end of the decade through brownfield expansions is something which is in place, and we are on track to get to that number. As far as the greenfield opportunities are concerned, we have two main big options. One is the asset in Odisha, where already our slurry pipeline is in the process of getting completed. Our pellet plants are under construction. The land is getting developed. We see a big opportunity to develop that facility, which will be again one of the lowest cost facilities, because both from import of raw material and from the movement of iron ore, you have an advantage. Also from moving out logistically into the market, you have an advantage. So it will be one of the lowest cost operations as we see today. As far as the Maharashtra asset is concerned, or the opportunity is concerned, which you're talking about, is the Gadchiroli area, where the mines are of good quality. We are already using some of the iron ore products from there, and it's a very good quality blend which we have. We see an opportunity to develop that area into a mining and a steel operation. And since it is very centrally located, it can actually reach the rest of the India by and large at a very optimum freight cost. So that's an opportunity which we are exploring.
Okay, Mr. Acharya, just one final word, because what the globe does has a big impact on metals, right? How do you see the globe from a growth perspective?
I think things look better. As we see today, one of the biggest challenges was the tariff escalations which had started, and we see some of that having come into control. There is a de-escalation, there is a discussion, which is very positive. Also from the geopolitical side, I think we see more balance. We see cooling off from various areas, whether it is the Russian-Ukrainian side or the Middle East side or even our borders. So that again is positive. So on a near term, I think India will continue to be the fastest growing major economy in the world. We see a very good opportunity for India to really become one of the largest economies in the next few years in the medium term, and very good opportunity in the long term. This year as well, I'm quite positive because the disruptions which were there last year with respect to the elections, with respect to some disruptions on the weather, those are behind us. We will see a more smooth flow of capex across the year, which will build good demand. We also see private capex reviving, I would say, albeit in select sectors, but it is reviving. And we also see external companies, international companies looking at building facilities in India, not only for the world, but also to take advantage.
I think there is a bit of audio glitch there, but Mr. Acharya, we got the gist of what you were trying to say. Sorry to cut you there, but we got the gist of what you're trying to say. Thank you so much for joining us today and giving us your thoughts. Really appreciate your time. Okay, as we just to do a quick check on JSW Steel, the management is sounding fairly optimistic about the short term and the long term as well. The growth plans do not get materially impacted as a result of all that's happening. So that is part one. Now, just want to mark a few stocks before we take that break, as the markets are doing well. Some of small stocks are starting to perk up too. So, well, Inox Wind Energy isn't quite small, but we highlighted this stock in the morning that stock may actually do well because of the swap ratio and the arbitrage that stays. So Inox Wind is 1.28%, but Inox Wind Energy, I think, is up about 4%. And I remember I said in the morning that there's a 7% arbitrage between Inox Wind and Inox Wind Energy, or IWEL, because of the merger ratio difference. So I think that is doing very well for itself. Watch out for a stock called Diffusion Engineers. That one has had about a 6% up move. So that's not doing too badly. Sangvi Movers is up about 3%. Adani Green is a couple of percentage points in the green. And Suzlon is perking up. 3.76% higher is Suzlon. So keep an eye out for that as well. Okay, we slip into a quick break. Lots more lined up on the other side. Stay tuned.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest
Namaskar. Welcome back. You're watching India Market Open, and we have a very special guest in our studios this wet, rainy Monday morning. Pranjul Bhandari, Chief India and Indonesia Economist, HSBC, joins us. Pranjul, pleasure to speak with you in our studios in person. Always great to have you on, and so let's just start off the conversation with what's on top of mind, I think, which is the RBI dividend, which came in post markets Friday was when the announcement was made. 2.7 lakh crore rupees, the highest ever bumper dividend. How did you look at that?
Yeah. So look, I think it's definitely higher than what was budgeted, which was closer to 2.3 trillion. It was higher than what the government got last year, which was 2.1 trillion. It might be a little lower than what markets had expected. Markets had expected more like 3 trillion, but I think the miss is not very much. I think overall, it's a good number. I like two things about it. One is that alongside this number, we have now put in more money for some of our risk buffers. So the risk buffer has been increased from 6.5% to 7.5%, which is a very good thing at a time of so much global volatility, right? You want all of these buffers. So we've actually built up that buffer. So that's great for macro stability. And the second, the fact that, it's about like 0.1 to 0.2% of GDP higher than budgeted, which basically means that the government can spend that much more without running a higher fiscal deficit, which will be good for growth on the margin, it will be good for liquidity on the margin. So overall, I would say, it's a good number at this point of time.
Also important to see perhaps from the point of view of what the RBI's perspective has been. It's not emptying out the accounts to give the government, the risk buffers have been kept high, as you said. In terms of government capex, how would you like to see this move forward? This is something that we've been waiting for since the budget. What do you expect happening in this direction, and what would be ideal?
Yeah, so the state's capex actually picked up in March, and I think that's one of the reasons why I'm seeing a lot of the rural spending and I'm seeing informal sector consumption actually pick up a little bit over March and April. I think state capex has helped there. Central government capex, we are still waiting and watching. We don't have all the data for March. We'll get it in a few weeks. But overall, we should just take a step back and understand that this is a period of a lot of uncertainty globally. Generally, in years like this, capex and investment take a back seat. Already we are seeing FDI inflows around the world have, paused in a big way. Even India's FY26 FDI was not very strong. Sorry, FY25 FDI was not very strong. I think this is a year to focus on consumption. And I really wanted to actually bring out consumption because something interesting is happening there. I'm noticing that informal sector consumption, which is both rural and also urban informal, like small firms, like small shops, that consumption has picked up. One thing that's helping there a lot is inflation. Inflation is falling off, real purchasing power is rising. So I think that's a good story. But unfortunately, to offset that somewhat is formal sector consumption, which has slowed a little bit. But I would say I will watch consumption this year. If informal can continue to rise the way it has in March and April, I think it can be a good thing.
Pranjul, so are you therefore making the point that if one wants to look at the efficacy of growth in FY26, don't look at small misses in capex if there might be, and instead keep a focus on all the measures that come around consumption? We know the tax rates have been one, but beyond that, whatever else happens.
Yeah, I think so. I would not say that in any other normal year. The gold standard is always investment, but in a year like this, which has so much of uncertainty, you understand who would want to put up capex of 3 years when you don't even have, the visibility of 3 weeks, right? So investment does take a back seat, but then you have consumption, and India is like this big domestic demand economy. So I would watch that very carefully.
Okay, so that is one. Part two is what role, therefore, and how important would the central banking action be? And how much of it is possible for the RBI to do, given the fact that the global picture is not necessarily looking as sanguine about rate cuts as probably it looked maybe say 6 to 12 months ago?
Yeah, so look, I think the first thing we have to understand is inflation is very low, and it is likely to remain low for a while.
In India?
In India. My sense is that the average of next 6 months, we could see inflation actually average about 2.5%. which is way lower than the 4% target, simply because food inflation has fallen. And not only is it because of items like vegetables, but it's durable items like pulses, wheat, rice. After a very long time, state granaries are full of food. And once that becomes the case, and that can keep a lid on inflation for like a 1 to 2 year horizon. So food inflation looks to be in a good place. And then you have core inflation, on the back of slightly weaker growth, on the back of the currency now having rebounded a little bit, on the back of imported disinflation from China, falling commodity prices. My sense is core inflation will also remain quite low. Now, when inflation is so low for so long, it helps in many ways. One, it helps the RBI to have a loose monetary policy. It's been cutting rates. We are expecting 3 more rate cuts in this cycle. It's giving a lot of liquidity. We think that will generally continue. Second, it provides higher purchasing power. And this purchasing power is very important for the informal sector. When prices fall, they feel rich, they buy more, right? So it helps growth in that way. And the third is a very interesting angle, which is it also impacts fiscal finances favorably. Today, inflation has fallen so much already, and now that oil prices are falling, the government may not want to pass on all of it to lower pump prices. It may actually take up some of it by increasing oil taxes, and that will give a huge tax increase to government, which the government can spend and support growth. So low inflation, low commodity prices can help India's GDP in a meaningful way over the next 6 to 9 months.
And we'll come to that GDP print in a bit because we're expecting that GDP print. But I just want to follow up on 2 points that you made, Pranjal, I found interesting. On the FDI point, because we just sort of skimmed over it, but it was a huge headline over the last couple of days that the foreign direct investment coming into India has plummeted over 96%. I think it merits putting that into a bit of perspective on how you see it. Is this an issue with India as a destination for capital, or is this in the context of global turmoil we're seeing, where everybody's like saying, let's wait and watch and see how this pans out?
Yeah, I think it's a global phenomenon. When you look at global investment intentions, they are very subdued right now. Again, I'll just repeat, if you have no clue what's going to happen in the next 3 weeks or maybe 3 hours, how do you basically take a call on some investment which will be there for 3 years? So it is a global phenomenon. But even when the global mood changes, I think India should play it more strategically than it has in the past. My sense is that in the past, we have focused mostly on high-tech FDI, like semiconductors and green hydrogen and EVs, solar panels. The problem with high-tech FDI that lots of countries are competing for the same pot of money, including the US, the Eurozone, all advanced economies. I think we should diversify. We should not just focus on high-tech FDI, but also mid-tech FDI. Textiles, footwears, furniture, these are mass, labor intensive. They will give a rise to mass incomes. That will be good for our growth. So the next round, whenever we are out of this particular storm, I think we should focus on diversifying the kind of FDI we want to attract to the economy.
It's something which won't even tick off Trump, because he said, I don't want to make t-shirts, but I want to make the iPhones.
Exactly, right? So you get it, right? That there is chance for a new manufacturer in mid-tech. But for a new manufacturer, large manufacturer like India in high-tech can be a lot more competitive.
But having said that, just on, so what do you think are the key markers to watch out from an Indian perspective? So far, the consensus has been whatever is happening with what Trump says, trade deal, etc., does not impact India too much because we aren't a very export-oriented or export-dependent economy. Do you first of all concur with that? And what do you think is the next big step you would watch out for in this trade war from the Indian context?
Yeah, so look, a lot of people say India is this big domestic demand economy. I like to not agree with this in entirety. My sense is India has only grown rapidly in years when it has integrated more with the global world. The years when we focused only on domestic economy, we get 5.5% growth. The years when we compete, go and look for new markets abroad, both goods and services, we get 8% growth, right? So, I would like us to compete. I would like us to grow much faster. We need it for our people. And I think we are taking the right steps. My sense is that we've been bringing down tariffs. We've been going out there trying to forge new trade deals with advanced economies. Now, you can argue that the India-UK trade deal does not have too much of economic impact, but I think the sentiment impact was even bigger. For the first time, India said that no, let's fast track it. Let's have something. We'll have a lot of issues. We'll look at it on the side, but let's fast track at least a bare minimum deal. I think this is a right attitude to have. On the back of this attitude, I think this year we'll also get a trade deal with the US and also the EU. Then we have been more open to FDI, especially regional FDI. Hopefully, eventually, we get a lot of FDI from China as well, which is a big giver of FDI. And finally, the currency. I think it's good to have a flexible currency. It becomes a shock absorber, and it also gives a lot of macro stability, confidence to manufacturers. So on all of these fronts, I think we are moving in the right direction to become a little more globally integrated than we were in the last couple of years.
Yeah, and then maybe Pax, New Zealand, Chile, what have you, a lot of smaller things as well. Pranjul, just on the point that you made about the need to attract not necessarily just high tech but low tech too, is India doing enough, or is that something that India needs to do but not quite doing right now?
So in the last couple of years, India has not been doing it. But my sense is that I think India is also sort of learning a lot of lessons, realizing new realities. My sense is in the last 6 months, there's been a general sense that this is a nice area to track as well. This whole mid-tech FDI, because that's our number one plan out there for creating jobs. We need jobs, right? Yeah.
Okay. The note that you guys came out with over the weekend, right? And it observes that in periods of rising integration with the world, India has done well. We are anything but getting integrated with the world. Or I mean, as in the world by itself, right? It's actually more deglobalization than globalization per se. So how do you think India fares in such a scenario?
Yeah. So look, there are two types of integration. One is financial integration, the other is trade integration. I think we've done better in financial than trade. Today our stock markets are much better aligned to global stock markets. But in terms of getting more trade market share in the world, we haven't done as well. So we've done one part of integration, but one whole part remains missing, which I think is trade integration. So let's focus on trade integration. Within that, there is goods and services. The world may be deglobalizing in goods trade, but it continues to globalize in services trade, and that's where I think we are a world leader, right? We are the ones who've moved from IT services to professional services. We are on the forefront of technological innovation, so let's keep at that. I think that's a good thing to have. Within goods as well, my sense is, yes, the pie may be shrinking, but even in a shrinking pie, if you're strategic, you can get a bigger market share. Today, especially for mid-tech products, there were a few countries that did very well in Trump 1, like for example, Vietnam. Right? But I think now if in Trump 2 supply chains start getting rejigged again, manufacturers, MNCs may look for new manufacturing hubs, which have still not got huge trade surpluses with advanced economies. And India, Indonesia, who did not benefit that much in Trump 1, can actually benefit a lot more in Trump 2. So I think the opportunity is there despite it being a shrinking pie.
All right, looking forward to two interesting things from Indian economy perspective. One is the IMF data, which came in that we're the fourth largest economy. Obviously, a lot of celebration at this end, but put it into perspective for us. And of course, you will see Q4 and FY25 GDP figures on the 30th of this month, ahead in this week. Give us your view on both.
So look, if we can grow at 6.5% in real terms per year for the next 5 to 10 years, then yes, this year we'll become the fourth largest economy. And I think by 2028, we'll become the third largest economy in the world. Right after the US and China.
Just doing what we're doing.
That's right. Yeah. Just because we are like a very large economy, right? We're a populous economy. We are a large economy. And if we grow at 6.5% at a time when the world is growing at, probably half the clip, I think we can reach there. So that's the good news, right? The not so good news is that we should not track just GDP. We should also track GDP per capita. How much money does each person have? Because we are the most populous country in the world. And if we sort of track that, we are not doing that well. I think for that, we need growth to be closer to 7.5 to 8% if we really want to climb as rapidly in GDP per capita terms. So I'm going to celebrate the fact that we are fourth largest and on our way to be third largest in the next 5 to 7 years. But I think for me, the bigger test would be if we can really increase the GDP per capita, which means even higher growth.
So this whole traction, the whole traction was, right, that we'll move from 2,000 to 2,500 to 3,000 to eventually $5,000 per capita. You think we are going slower on that because of the pace of rise in population is faster than the growth?
No, I won't say the population is rising at a faster pace. I think in fact it is softening over the last decade or two. But I think real GDP growth has to be even faster for us to get there even quicker, right?
6.5 is not going to
doing
cut it. Because that's just that's status, actually. It's because we're just doing what we're doing.
No, we'll still get there, but we'll get there a little later with 6.5. My sense is we need 7.5 to 8 for at least 10 years for us to really become a meaningful middle income economy.
Which ties in with what you said on mid-tech investments, which can actually bring in that employment, etc. But more in the here and now, the fourth quarter and FY GDP numbers that we'll see, what are you penciling?
Yeah. So look, we have a large database of 100 indicators of growth, and that aligns very well with GDP numbers. Our sense is that the March quarter is looking a little better than the December quarter. So in December, GVA grew by 6.2%. So in March, we think GVA will grow more like 6.4%, slightly better than the previous quarter. What will be the positive part? I think informal consumption, rural consumption has really picked up. I think that will be the positive part of it. But I think what markets will be looking at beyond GVA is GDP growth, and GDP growth could be even faster. My sense is GDP growth will come in at 7.1%. The reason it will be so high is, I'll just get a little technical for a second. GDP is GVA plus indirect taxes minus subsidies. March was a quarter in which central government subsidies really fell. So for statistical reasons, GDP will look very strong in the March quarter, but this will not continue beyond March. I think this was just like a March sort of statistical innovation.
So don't get excited with the GDP number of 7.1. Don't get too excited about the 2.5% inflation print as well, because that could also be temporary.
Well, look, I think it's going to be there for the next 6 to 9 months. So it could be a little more long lasting, because I just don't see any price pressures that are meaningful at this point.
And then does that therefore give the ammo to the Reserve Bank to rate cut? Do you think 2 more in the offing?
I have 3 more.
3 more in the offing?
Yes.
In the current calendar?
In this financial year or calendar year?
In calendar year.
This calendar
so
year.
June, August, and then December.
Oh,
wow.
Yeah. Look, when you have such low inflation, then you act, right? And we have it at this point of time.
Do you think the Reserve Bank has been conservative so far in rate cuts from what you've seen, and the language from the last policy?
No, absolutely not. As in, I think they've cut twice back to back. My sense is they're going to cut again the next 2 meetings. Then they may take a break and then cut again. So they've been pretty consistent with their rate cuts. Had they gone for bigger quantum of cuts, it could have given a sense that something is wrong. They are feeling scared about something. Maybe growth is falling a lot, and you don't want to give that signal that you're a scared central bank, right? So I think the quantum, the pace has been just right. And more encouragingly has been liquidity. At some point, the OMO purchases that the RBI did was way more than the market had expected, right? So I think overall, central bank is really on top of its game right now.
In terms of consumption, just want to follow up on that point that you made earlier, Pranjal, that you would be watching for consumption. That's sort of that... The mirage that we've been chasing for a while, if I say so, because you're going to see a few things coming in. Tax cuts, which were announced in the budget, are going to start padding up pockets of the middle class. A monsoon seems fine. I mean, we're sitting in a very rainy day, has hit early, so we'll have to wait and see if it does more damage than good. What do you think are going to be the rural consumption markers that are going to be very, very crucial this time around?
Yeah, absolutely. Look, I would say, agricultural production, which is a leading indicator, because when production is good, then a few months down the line, you sell it, you make money, and you buy stuff. So that's a good marker to look at agricultural production. And Rabi crop production has been pretty strong. You look at rural wages, we get very good data on it. Is it rising or not? And it's broken down between agriculture, construction, so you can really get a handle on other parts of the rural economy. Then there's something called terms of trade, right? Like how helpful is inflation being for the rural Indian? So I think there are a couple of markers we can get. And then there's, of course, like two-wheeler sales, non-durable, staples sales. So there are lots of ways to track this data. But I would say not just rural, I would call it informal. Informal is rural plus urban. Something between urban rural, right? Basically small shops, small firms. I think the whole informal section, which is about 2/3 of India's consumption, I think is important to track.
There's actually, I think, a term for urban, is what they call it, the rural-urban mix, and that's the kind of consumption play that we've been seeing. But Pranjal, it's been an absolute pleasure speaking with you. Thank you so much for joining us in our studios.
Yeah, thanks for having me. I really like your studio.
Oh, thank you. Thank you, and you're welcome back anytime that you're here. We'd love to have you on. So, Pranjal Bhandari, their Chief India and Indonesia economist, breaking down the data really, really well. I think the statements on fourth quarter GDP and the expectations there are important, as well as the outlook for the Indian economy. We'll get to number 3, but we need to do much more to make sure our per capita GDP stands out. I thought those were a few points which stood out for me from the interview. All right, just an eye on what's happening in the markets while we're at it. 200 points up on the Nifty, so it's a good morning, no doubt. A couple of things helping. That RBI dividend definitely has the kind of positive news that we've got from Trump on extending the deadline on tariffs has also helped. So some of those factors in play. But meanwhile, stock-specific focus this morning, Divi's Laboratories is something we're working on. New global pharma agreement has been secured. The company, in fact, has secured another long-term pact to manufacture advanced intermediates. Customer to fund 600 to 700 crore capex required for this new project. Let's get in Varsha on this in just a bit, but meanwhile, telling you that this is a significant growth potential. It's the third dedicated capex announcement recently. Total investment will be 2,000 crores and could add over 50% to Divi's FY25 revenues. They've also added multiple high-value products from major pharma companies in its pipeline, which is why that stock is about 3.5% up. Citi's view is that they've maintained a buy rating with a target price of 7,750 and an upside potential of 20.1%. They believe new investments are likely for Merck's MK0616, that's a peptide for high cholesterol, and Divi's 15 million ton capacity for MK0616's intermediate suggests it could be a primary supplier for this product, and they expect many more such announcements. So that's the news with Divi's. I think pharma in focus today, but it's an overall, Neeraj, if I look at it, it's an overall up move on the markets, which is holding up quite well. Quite impressed with the way the Nifty has held up and shown strength this morning.
Most certainly. A lot of stocks actually holding out. Yes, pharmaceuticals out there. Pipe companies, Tamanna, we spoke about it in the morning. And look at what Astral or a Supreme or maybe a Prince Pipes are doing. I think pretty interesting showing there. But I think the stock of the morning, and for the wrong reasons, has to be Balakrishna Industries. And that stock is in focus because it's cracked 9% on weak Q4, brokerage downgrades citing increased risk from new competitive business forays. Puneet Johnson with more details on this. Puneet.
Well, thank you for that. So definitely it's a big negative coming in for Balakrishna Tyres, largely also partly because of this earnings, that net profit is down 25%, but majorly because of the company's entry into passenger car radial tyres, which is tyres for cars essentially, as well as the truck and bus radial tyres essentially. Now, the key contention is that's a very hyper competitive market with players such as Apollo Tyres, MRF as well as SEAT having a long stronghold over the last 3 decades, and hence an entry with a minimal capex at this point of time, considering the opportunity, could be challenging going forward. Now, they've also mentioned that roughly 3,500 crores of total capex will be for 3 separate ventures, including the new tire capacity and new tire segments, but they've not given a separate breakup for what the opportunity is. The company did highlight that this will only come in post 24 months. So over the next 2 years, we still won't see any entry by the company in this new segment. But the capex outlay as well as the plans currently for the company seem to be they'll be only targeting a very niche market in the passenger car radial space, and that might not give the desired returns at least over the next 5 years. We've also seen brokerages such as Citi as well as Nuvama come in and cut target prices. Citi has maintained the sale rating target price of 2,400, and they've said that they are relatively cautious on the company's new foray into the passenger car radial space. They've also said that the strategy, which is for sales, distribution, marketing, amongst others, is very different to the company's traditional agri as well as off-highway tire capacity, and hence they've cut the valuation multiple by 10%. And Nuvama, they've downgraded actually Balakrishna to a hold now. Target price is cut by 13% to 2,700. And one key point that they're making is while over the medium term, increasing this would be a logical step and increase, getting into a new segment. The competitive intensity is much larger in this, and you need a separate brand essentially for getting into this space. So that's one of the key verticals. Balakrishna is also the most expensive tire stock amongst all the 5 companies listed. So we're seeing that valuation re-rating, but definitely the street not liking this entry into the passenger car tires as well as the truck and bus radial tire space for Balakrishna today.
So that's a losing story of the day in terms of Balakrishna Industries. But I just want to put the focus, and with the standard disclaimers, of course, so on the Adani Group stocks. These have been buzzing for the last few days, up in trade today as well. And the reason is data that they put out as a group. The company has posted a record EBITDA and PAT in FY25 with strong performance in core infra and emerging sectors like green energy and airports. In fact, let's go through some of those details. The key highlights is, of course, the group companies have posted a record EBITDA and PAT in FY25, strong performance in core infra and emerging sectors like green energy and airports. What's also worked is improving net debt to EBITDA, reflecting reduced leverage. Improving returns on assets among infra players is also an important point to note. So Adani Group stocks, of course, have given a positive return in FY26 so far.
And Tamanna, the numbers kind of speak for themselves, right? So if you leave out Adani Power, wherein the FY25 EBITDA is at circa 24,000 versus about 28,108. I don't know if all those numbers are legible or no, but hear me out, viewers, any which ways. On almost everything else, Adani Power, Adani Port and SEZ, 20,471 versus 17,000 crores. This is EBITDA I'm talking about. Adani Enterprises is given 17,316 versus 13,681. Adani Green Energy at about 10,532 crores versus 8,900 crores. Cement business 8644 crores versus 7589 crores. On almost all other businesses, in fact not almost, on all other businesses, the EBITDA performance FY25 or FY24 has actually been very strong.
And so let's just put all those highlights together for you for perspective. So it's the highest ever net profit of 40,565 crores. This is on a group level. The 6-year CAGR, and this is phenomenal, has been 48.5% for the group. They have improved net debt to EBITDA. They've reflected reduced leverage as well. And in fact, net debt has lowered at 2.36 lakh crores versus 2.41 lakh crores. Net debt to EBITDA is in fact down to 2.6 times in FY25 from 3.8 times in FY19. The declining cost of debt is also apparent. FY25 is 7.9% versus 9% in FY25 and 10.3% in FY19. So if you put it on a bar chart, you can see that trajectory going downwards.
Yeah, and all of these factors leading to maybe the ROA is doing well. In fact, the highest ROA amongst infra players, one of the highest, if not the highest. The FY25 ROA was at 16.5. Gross assets are at 6.1 lakh crores. Record asset addition, 1.26 lakh crores, the highest ever addition. And this is what you want to probably see. And maybe all of these factors leading to the kind of ROAs that have been built up as an infra player, it's been very strong.
And then, of course, that's helping with the continuously improving credit profile as well. So there you can see it in April 2025, 89% have rated it at AA minus. April 2023, where the 63% have rated above AA minus, and in April 2019, 48% have rated AA minus. So you're seeing that upward move as well. In fact, key highlights that you can see for FY25 in the company: modules volumes were up 59% to 4,263 megawatts on a year-on-year basis. In terms of data centers, 17 megawatts at Chennai was fully operational. Noida data construction was completed and operational with an initial capacity of 10 megawatts. In terms of roads, highest ever. That's 2,410 lane kilometers were constructed in FY25. Passenger movements for airports was up by 7% year-on-year to 94.4 million. Cargo movements were up by 8% year-on-year to 10.9 lakh metric tons. Mining services, in terms of that production volume, was up by 45% year-on-year to 47 million metric tons. The renewables business is also interesting to focus on. In FY25, operational capacity was increased by 30% year-on-year. In terms of Adani Gas, overall volume grew by 13% year-on-year. For ports, volume grew 7% year-on-year to 450 MMT. For Adani Cements, in FY25, Ambuja crossed the 100 MTPA capacity, and for energy solutions, they achieved robust system availability of 99.7% at portfolio level in FY25. We'll go through all the group companies in terms of Adani Power. Consolidated O&M available was 91% during FY25. For Adani Wilmar, it was the highest ever full-year EBITDA at 2,482 crores, up 119% year-on-year. So just important to highlight what the performance of the group has been, and of course those disclaimer plates, standard disclaimers on your screen, because you are watching this on NDTV, which is a part of the Adani Group. All right, but primary markets in focus. Primary markets are starting to buzz again. Over half a dozen companies have filed for their IPOs in May. My colleague Hiral has a more detailed report on this. Hiral, clearly IPO mania is back.
Absolutely, IPO mania is back, and what has happened is that your initial year in terms of 2025 was slightly subdued, and reasons known, from the kind of uncertainty we saw in the global markets to the kind of FIs that were pulling out, who have come back as well. But let's understand what it's looking like now. 76 IPOs that have been filed in calendar year 2025 so far, out of which, if you go to see, this is the highest number of IPOs that are filed in over a decade up till May 2025. Now, what's interesting is the kind of mix that we have between main board as well as the SMEs. First, let's understand the money that has been raised. Almost around 18,964 odd crores that have been raised by IPOs until May 2025 versus 48,152 crores in terms of the same period last year. So the amount that has been raised is still lower as compared to last year, but the number is what we are focusing on right now. Now, in terms of the distribution between main board listings and SME, 11 until May 2025 on main board versus 36 SME listings. And if you see the same data in terms of last year, 29 main board listings versus 32 SME listings. So the quantum of SME listings has remained the same, whereas main board has been slightly lower this time around. Moving on from there on, if you talk about more than half a dozen companies that have filed IPOs, let's understand the kind of companies that have come in. Canara HSBC Life Insurance, Canara Robeco AMC, Tata Capital, Urban Company. That's the top four. Apart from that, you have BMW Ventures, Priority Jewels, Jinkushal Industries, and Corona Remedies. So majority of them, if you have to see, are still from the BFSI space, to highlight it all. And you have a Mori Tech and Ravi Infra. Others, again, divided between various sectors. Let's understand the 6 IPOs that have come in terms of May so far. Burana Weaves, that has already been launched. We've already seen 144 crores is the size. Bellrise, again, already launched. 2,150 crores is the size. Now, what opens today is the Aegis Wopac. 2,800 crores is what they are raising. Apart from this, you have Skoda Tunes, again 220 odd crores. Scholz Bangalore, which is Leela, opens today 3,500 odd crores. And Unified Data Tech Solutions, 144 odd crores. So these are the ones that have already come in terms of the month of May so far. Now, let's just quickly recap 2024. It has been a record year. 91 companies which actually hit the IPO market back then, and they've managed to raise almost 1.6 lakh crores in 2024. Moving on, if you see in terms of the overall data as well. Now, the key from here on is whether 2025 will be able to hit that 1.6 lakh crore mark, or exceed that, because the quantum of IPOs that are hitting the markets is huge in terms of filing the DRHPs, but the mix right now is skewed towards SMEs. So the main board quantum is lower in terms of number versus the SME portfolio, and the amount raised in the period so far, it's a 48,000 odd crores in 2024 versus a mere 18,000 crores right now. So that is a key that we need to take into consideration whilst moving forward from here on to understand this market.
All right. Thanks a lot for that, Hiral. So our IPO, stake sales, everything is back in action, but certainly heartening to see primary market action. The only thing that we hope for, it doesn't become so rampant that it becomes an issue for the secondary markets. At some point of time, it will be. Anyways, on to more news and updates. In the last SEBI panel meeting, MSCI and NCDX dissented to the idea of having just 2 expiry days for derivatives. They suggested that each exchange should be allowed its own weekly expiry day, saying this would promote fair competition, support new entrants, and avoid any uneven playing field. The committee has asked both exchanges to make a detailed submission to SEBI. Charu has these details. Charu, good morning.
Hi, so MSCI and NCDEX are the 2 exchanges which approached the SEBI committee dealing with the expiry day proposals and said that they are not in favor of these new proposals restricting the weekly expiries to only 2 days. Now, it is their case that this is only going to help the bigger players in the market, the bigger exchanges, and is going to take away the loaf from smaller exchanges. However, it was SEBI's view during the meeting that in order to facilitate fair competition, which is also important, we cannot forget that there were once a lot of expiry days, that is any weekly day was allowed previously before the October curbs on F&O volumes came, and that led to a lot of hyperactivity in terms of the volumes, and this is not the case scenario that can be sort of repeated. And after listening to their concerns, the committee members said that they are free to make submissions to SEBI and basically appeal to SEBI by making detailed submissions and requests and explain how even their proposals or their benefits are going to help the investors and market stability in long term, and maybe SEBI can look into it and make a decision or tweak its already made decision about the 2 expiry days. So we'll have to see how any sort of tweak takes place, or if there is anything done to facilitate the smaller exchanges.
Thank you for that, Charu. It's raining exclusives this morning on NDTV Profit. Here's the next one. SEBI is weighing consent and a conditional NOC for NSE cases. This is important because it could potentially clear the way for the NSE IPO. Shrimi Chaudhary is joining us for more details. Yes, Shrimi.
Yeah, so very crucial information, Tamanna. SEBI is considering settling 2 ongoing cases involving NSE through the consent mechanism, is what sources, top sources tells us. 2 options which are under consideration and under discussion include that one is NSE may withdraw its court case related to the dark fiber controversy and file for a consent settlement with SEBI. And the second one is with respect to that SEBI could issue a no objection certificate with specific condition, including full disclosure of, the pending matters which has been there and the contingent liability in the DRHP which they're supposed to file for the IPO. So these 2 conditions they are weighing on. One is with respect to the consent. Now, the consent mechanism, as we all know, allow entities to settle regulatory matters by wrong or denying the allegation. And what we've been also given to understand that NSE is currently in talks with the regulator to resolve all the issue. And as you rightly mentioned, Tamanna, that this move is seen as a key step towards clearing all the path for NSE long-awaited IPO. So one of the cases under review, clearly involved the allegation that certain broking firms were given preferential access to NSE co-location facility through dark fiber connectivity. At the main issue here that has drawn regulatory scrutiny for years.
Okay, important. Very, very, very important if there is closure to this, because this is an IPO which is hanging fire for the last several years. Thank you for that, Shrimi. All right, just a quick wrap on the markets before we end the show on the day and just see what we're leaving you with on India Market Open. 153 points on the Nifty, holding up above the 25,000 mark, but no, actually just slipping off, just coming off as we speak. Still up in the green. What's working out for the markets today? It's, there's no one theme, I would say. IT is doing fine, banking is not half bad, IT is of course doing better. Auto stocks are doing okay, but it's more about individual stocks than anything else that we're seeing buzzing in trade. But with that, it's a wrap on India Market Open from Neeraj, me and the team that put the show together. Thank you so much for watching. We'll see you back tomorrow. But of course, don't go anywhere. A lot more coming up on NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hi, welcome. Thanks so much for joining in on this rainy Monday morning. This is Ask Profit on NDTV Profit. My name is Alex Matthew. And the markets are looking reasonably good at the start. We'll talk about that in just a bit. First though, let's talk about earnings. Let's talk about Narayana Healthcare, which has posted a very decent set of numbers, and the stock is reacting positively. It's off the high point of the day, but still up about 4%. Let me take you through the snapshot of the numbers before we get on the management to tell you about the path going forward. The revenue's grown by as much as 18% on a consolidated basis, and this has been led by a good performance for the India business. The margins overall have expanded to 24.2% and led to an improvement in the PAT to the extent of 3% or thereabouts. The realizations for the domestic business for the India hospitals has gone up quite considerably. There's lots to talk about in terms of bed addition. Where does that stand at in the current financial year? What the expectation is for the revenues per customer, patient, all of that and more with the conversation we have lined up. Sandhya J, who's Group Financial Officer of Narayana Health, joining in right now. Sandhya, thanks so much for taking the time. Pleasure speaking with you. Let me ask you first to sum up the quarter gone by. And then there's one aspect that stands out to people like me. Unfortunately, we do look at where underperformance also happens. Seemingly that international business has not necessarily done as well as it might have. What is the reason for that?
Thank you, Alex. Thank you for having me here. So from a performance point of view, just I want to set in context that we've not added any capacity in the past few years. Despite that, we have seen very strong growth in our domestic business, while offsetting the impact of the decline in the international business. So Bangladesh is our largest international market. And for the full year, we have seen a 30% decline in Bangladesh. And for the quarter, it's 53%. Despite that degrowth, we've been able to compensate with the domestic business. We've always held that we will not be focusing on the international business and our focus is domestic. We were expecting that the international revenue will fall over a period of time, but because of the geopolitical conditions, it accelerated faster than we anticipated. But the task remains cut out for us. We will have to grow the domestic business and fulfill those volumes which erstwhile we were servicing with international patients.
Right. Hi Sandhya, Varsha here, great to have you. Sandhya, you have mentioned that the revenue growth or the numbers that you have seen is on the back of good realization that the Narayana has seen. Now my question to you is, has a large part of business came from better high value procedures, number one, and number two, what was your volume growth versus value growth? Sorry, value growth.
Yes. So from a pricing point of view, there are two aspects. We do our price increase on 1st of January. So there is a small effect of the price increase also in the ARPP growth that you have seen, though it is a small price increase, low single digits. The other part of the growth which has come from improved payer mix as well as improved procedures. We have also reported our robotic procedures and high value complex procedures have also shown good traction. So all of that is reflecting in the numbers. As far as volume is concerned, there is a mixed bag effect on this because Bangladesh was also a very high volume business for us. High volume, slightly lower realization kind of business. So therefore, we've seen a flattish kind of volume performance for the year owing to the loss of Bangladesh. But if we exclude that, we've seen a reasonable volume increase.
Okay, interesting. I want to ask about capacity because you mentioned that you hadn't added capacity, but the plan is quite an ambitious one heading into 2030 from the current, and correct me if I'm wrong, 5,745 beds at the end of the financial year, heading to 7,680 beds in 2030. And this is going to be a mix, Sandhya, of greenfield, brownfield, leased projects. So can you give me a sense of the current financial year, what is the expansion plan and what is the spend that you have lined up?
So for the current financial year, hardly any of these projects will come online because if you see the trajectory we have given, most of them are coming online. I think one of them is coming FY27, but everything is from FY28 onwards. So therefore, I don't think you will get any additional capacity in the current year. Of course, in terms of capex, we will have capex. Most of the land capex is already done. So there is no further large land acquisition planned unless some meaningful project comes up for us. But we will definitely be investing in terms of the build out of these capacities, that is the greenfield growth, as well as the typical replacement and maintenance capex that we do. So about 300 crores a year is what we spend on replacement, maintenance, new capex, etc. within our existing units. In addition to that, we may spend about 450 crores odd in terms of the greenfield, brownfield capacities that we are trying to create. But these are projects, so the the way the spend will get scheduled may be depending on how the construction progresses.
Okay, thank you for that clarification. Just a couple more questions, Sandhya. In terms of the outlook for FY26, you mentioned that the price increases take place in January, and that has had a bearing on the margins as well. Also, the reduction in revenue coming through from the international business currently standing at around 40 crore or thereabouts, dropped from 80 plus crore. I'm just wondering, does that mix change also lend itself to better margins for the rest of the financial year, for the new financial year as well? And what is the trajectory you're anticipating?
To some extent, yes, because we did have the Bangladesh was a high throughput, a lower realization book of business. So therefore, there will be some benefit in the margins. We do anticipate to improve margins like we have done for the past 3 years in FY26 also. Without guiding, a lot of it will come through the same measures which we have taken, which is more throughput through the same infrastructure. No new infrastructure is coming online, but we do aspire to grow within the same capacity, which means we will continue to exercise the throughput levers. So we are hoping that the India margins will see expansion on the hospital side. Of course, we will continue to have cash burn on the insurance business side, and Cayman may broadly be stable in terms of its margin performance. So on an overall basis, maybe we will have a more stable margin performance, but definitely on the India hospital side, we are aspiring for margin growth.
Also, Sandhya, just coming back to the your capex plans. So, how are you going to fund this capex? Number one, and will there be capex in Cayman also? Because you've done lots of capex when it comes to Cayman Island.
Yes. So, as far as Cayman is concerned, we have exhausted the capex needs of the geography. Therefore, even if we do, it will be very small maintenance capex. All the capex will be invested in India only, and we are funding this mostly through debt. Our debt, net debt to EBITDA is 0.15 right now, and therefore there is a lot of headspace for us to borrow. So we will try to utilize that space we have.
Very quick follow-up to that, Sandhya. Where do you anticipate it moving in FY26? Net debt to net debt, I mean.
Yes, not necessarily FY26, but over this project period, the next 3 years, we will at some point in time definitely hit a net debt to EBITDA of 2 at least. Our aspiration is that we want to keep net debt to EBITDA under 2. Unless some really interesting project comes for us and we may need to breach it for a short term, that's the range within which we operate, and that's what drives our capex decisions as well. So over the next 3 years, there will be a point there where we will breach the net debt to EBITDA of 2.
Sandhya, absolute pleasure speaking with you, and exciting times ahead. Thanks so much for joining in.
Thank you for having me here.
All right, let's talk about the markets very quickly, and we'll jump straight into the questions that some of you have already sent through. We did start off very positive, but we've given up a little bit of ground for the benchmark Nifty 50, and indeed for the broader markets as well. I'm just pulling that up on the screen right now. The mid-cap index gaining about 0.5% or so. The small-cap index around that same mark, about 0.5% higher at this point. And take a look at some of the stocks that are in focus, because you have a few big reactions to earnings. One of them, GVT&D. This is GE Vernova T&D. This is a company that supplies equipment for the transmission and distribution space here in India. Very strong set of numbers, margin expansion and order wins also taking it through the fourth quarter. You have a few more. JK Cement looking particularly good on the back of the fourth quarter numbers, up about 6% or so. Narayana, we just spoke with the management, it's up about 4% or so. GNFC, this is Gujarat Narmada. Chemicals and fertilizers, and this is a stock that is doing quite well, up about 4% off the high point of the day, and valuations, according to our experts who spoke to us earlier on in the day, are quite attractive at this point. Something like a Balkrishna Industries on the other end of the spectrum, not doing particularly well on the back of a weak quarter four, and also on the back of the expansion plans in India, where they're likely to set up a radio business right here in India. Of course, if you know about Balkrishna Industries, you know that it's an off-road tire manufacturer that has a large amount of its revenues coming through from exports. So several stocks that are in focus, and we've got Brijesh Ail, who's the head of technical and derivatives at retail research at IDBI Cap, as well as Saurabh Jain, who's equity head research at SMC Global Securities, joining in this morning. Gentlemen, thanks so much for waiting by. Appreciate the patience that you've shown. Let me ask the first question, which is incidentally on GE Vernova TND. We've got a viewer who has bought at levels of 201. Which is incredible. He's got 4,001 shares, so it's a 10-bagger for him, and bought it about 2 to 3 years back with a view of 10 years in India. What is the fundamental view in case you've seen the numbers, Saurabh?
Even the numbers were quite good, but on the valuation side, I feel that the stock is expensive. I think it is quoting about at 30-40 times to book value and about close to 100 times to its trailing earnings. I think he has already taken a good amount of profits. I mean, it is a time-bagger kind of a stock for him. And in my opinion, I think the growth, the forward growth is largely being reflected in the current multiples. So in my opinion, I think he should take some profits off the table.
Take some money off the table is the view, and you've made some considerable gains. So congratulations on that. Ugro Capital is the name of the counter we're talking about next. And Srinivasan from Hyderabad is asking this. Bought at levels of 216, asking whether he can add more at this point. Brijesh, what's the view on the charts?
Hi. So basically, this is quite looking okay. It's positive on charts. Maybe there can be a further momentum can be there. I think this can go back to 200, 210 level on the higher side. So if he's having a position, I think he should hold on to the longs.
Hold on to the longs is the view. So what would you keep the stop loss as in this trade, and what are the key levels to watch out for on the higher levels?
So basically the 160 was the level from where the demand has come. So I will take 160 as the stop loss. And on an immediate basis, as and when this 190 is taken out, I think that will be a fresh upside will be there. But structurally, it is looking positive. So I will hold on to the long position. Okay,
it's up about 4% in trade. One stock to keep on your radar, certainly. Sunil from Vishakhapatnam is asking the next question. Tilaknagar Industries is the name of the counter, and he's bought already. He's bought 100 shares at a price of 356. The stock is up and about in trade today, 6% higher. The question is on the fundamentals. Sunil wants to hold for a period of more than a year. What's the outlook on the fundamentals, Saurabh?
All the alcohol beverages companies have posted good set of numbers. Tilaknagar Industries last quarterly earnings were out and they were good enough, and the management is quite confident of their portfolio going forward. So in my opinion, I think he can hold.
Hold is a view. Very quick view, Brijesh, on the technicals as well. Is this the key level to add more?
Not exactly. I won't be looking to add any fresh trade because the risk reward ratio won't be favorable. But then he is already having a position. I think one should hold the position because it can go back to 400 plus levels. So hold is the view from my side.
Hold is the view on Tilaknagar Industries. Now is not the time to add more. Dheeraj is calling us from Hyderabad, the first caller for the day. By the way, in case you want to call us like Dheeraj has, you can call us on the number at the bottom of your screen. That is the landline number to call us on. Dheeraj, hi, good morning. How can we help you today?
Sir, good morning. My query is regarding Azhar Engineering.
Okay.
They declared the results on Friday, I guess.
Yes.
So I bought these shares on Friday. So 92 shares of Azhar Engineering at 1,803 rupees.
Okay.
Can I add more at current levels, or can I add more something like Gravita India is my query, sir.
Okay, and you bought this. You bought this based on the earnings, Dheeraj. The earnings were quite good. Would you say that you are holding based on the fundamentals?
I bought these before the earnings, sir. I expected a good performance from their quarterly earnings.
Yes.
The stock jumped to 1865 in the morning, but it came back to 1805.
Yeah.
So should I stick with the same counter for another couple of months?
Okay, so it's okay.
Stick to something like Gravita India is making?
I got your question. So no, so you bought it based on the price move that you expected. So therefore, Brijesh, on the charts, what's the view on Azad, and would you hold this or would you switch to something like a Gravita?
First, I won't be holding to the Azad because the level of this 1800, 1850 is the supply zone, and historically this level has acted as a very stiff resistance. So I do believe there can be some more profit booking, and this can come back to 1700 levels. So I would first take an exit from this, and definitely if I need to switch to something else, I would do that.
Okay. And specifically on Gravita? If we can pull up Gravita India, let's do that.
Yeah. So Gravita, okay, not exactly, because the Gravita is also something which is observing a profit booking and has broken the 200-day moving average. And there has been selling volumes which I can see. So I think this can also come back to 1720 level. So there is no positive trigger in Gravita. So I won't be taking any fresh bets on the Gravita.
Okay, then let me ask you this, Brijesh. If you're got a sell call on the previous stock, and if it's not a buy on Gravita, then what is your high conviction buy at this point for a period of 2 months?
So we today one of the stock like Camlin Fine is some stock which has come into my radar. So I think the momentum is quite positive. We can bet for 20-25% move from the current level. So Camlin Fine is something which I would like to take a bet, and currently it is trading at 210. So I think it can go back to 230 to 45 levels. So I think I would make a shift at Camlin Fine.
Camlin Fine is something you should watch out for. It's up quite considerably in trade today, 12% higher. But it's still a buy at this point. Sudha is calling us from Saudi Arabia. Sudha, very good morning to you. Thanks so much for calling us. How can we help you today?
Hi, good morning. I'm having a question on CDSL.
Okay.
Can I buy CDSL at current market price, keeping NSE IPO on mind for short-term gains?
Okay, so what is the connection?
CDSL.
Yes, I got it. But why are you watching for the NSE IPO?
Because I have on mind as when NSE IPO comes, these capital gains sectors will also have lead.
Okay, understood. Okay, and when you say short-term outlook, how long would that outlook be?
Maybe 6 months to 1 year.
Okay. All right. Saurabh, what do you make of that? CDSL, of course, is a capital market play and it's gained quite considerably in the recent past. Let's pull up, if we can, the 1 month, 3 month charts just to drive home that point. There's been a bit of a comeback of some of these names. It's up about 11% or thereabouts over the last 1 month, and it's gained about 22% over the last 3 months. But specifically on the NSE IPO and the implications there?
I think there is no largely a good connection between CDSL and NSE. I think people are making connection with the BSE, but that is also too expensive, even after the because of the split has happened in that in BSE also. In case of CDSL, I think on the operational front, there is no problem. The company is posting consistent growth, but yes, there is a concern on the valuation. Because of the valuations, high valuations, the stock corrected very largely, and now a bit of recovery has come from the lower levels. But still, I think I find the stock expensive, 20 times to book value. I think one should refrain from investing in the highly valued stocks.
I want to come back to you on Divi's Laboratories. It's a stock that is in focus today, Saurabh, and it is gaining quite considerably, 4% higher at this point and holding on to the high point of the day at 6743. We've got Chandan Jain, who's writing in from Hubli in Karnataka, and he's bought at levels of 4,000 rupees per share. He's wondering whether he should hold or book profits at this point, and this is reacting to a pretty strong Q4. Wouldn't you agree?
Yeah, I mean, Divi's Lab is a bellwether in the pharma space. I think the numbers were pretty good, and these stocks generally do attract high valuation. If you look at on the valuation side, it's trading at 30 times to book value. So, in my opinion, I think it's a kind of a portfolio stock. If you have a long-term perspective, I think you can stick with it.
Stick with it is a view on Divi's Laboratories is up about 12%, as are a number of other stocks in the last 1 month. A lot of stocks making a comeback, 4% of that move in today's trade itself. We've got the next question from Jishan, who's writing in from Hyderabad, asking about Equitas Bank. He's bought at levels of 98.3 and he's looking to hold basis fundamentals for at least a year. He's incurring a loss at this point because of the various issues that this company, this bank has had to face. Saurabh, on the fundamentals, would you hold on?
think it is one of the weakest in the small finance bank category. The balance sheet is in pain and the numbers are bad. There is an issue with the NPAs also. So my sense is better to exit from a company like Equitas SFB. And you can switch to medium-sized public sector banks, for example, in the case like the Union Bank or maybe a bigger bank like Canara.
All right, so exit is a call on Equitas Small Finance Bank. By the way, we have to slip into a very quick break. We've got several of your questions that are lined up and a few of you are on the phone line. Do stay with us. We'll be back very quickly.
That's huge. That is a biggie. It's on deck.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready.
Welcome back. You're watching Ask Profit. This is the show that gets you answers to all of your stock-related questions. And the first caller that we have on this side of the break is Murli, who's calling us, apologies, from Bengaluru. Murli, good morning to you. How can we help you today?
Good morning, sir. Thank you for taking up my query and answering very elaborately. And I bought MGL,
okay,
Mahanagar Gas, 200 shares at 1352 recently. Considering about 8% and 9% growth for the 4 to 26 given by the management and good dividend yield, I am willing to wait for 1 or 2 years.
Okay.
Can I add more if the price comes down to around 1300? Now it is around 1340.
Yes.
And hold for 2 years. So alternatively, do you suggest any other better growth stock?
Got it.
Which can give a better return than MGL?
Okay. All right. Thanks for your question, Murli. Let me ask Saurabh what he thinks about the fundamentals and the valuations that they stand right now. On a trailing basis, around 13 times price to earnings, not the most expensive stock. Would you say that this is a good level to add at this point, Saurabh?
I think on the valuation side, it is quite comforting, but I think the market is, jittery about the lower allocation for the companies like MGL, and maybe they have to purchase on the gas on the market prices, and thus it will give them lower margins. And that is why the market is worried and that the stock got beaten down. I would not suggest to chip into the MGL till the things get clear, but otherwise I'll suggest him to look for investment in sectors like hotels, banking, capital goods. In the banking, he can invest in the ICICI, in the capital goods, or in the maybe transmission segment, he can go for the KEC International kind of a stock. And in the hotels, he can look for the Lemon Tree.
So there are quite a few stocks that have been named. Murli, hopefully that helps you out. We're joined now by Ajit Mishra. Brijesh, thanks so much for taking the time as always. I think that he's left us already. But Ajit Mishra, Senior Vice President Research at Religare Broking, joining us this morning. Ajit, thanks as always for taking the time. Let me ask you a question on Hudco. And this is a question coming in all the way from France. Tamil Selvan is asking, he's bought at levels of, he's asking whether to buy this current price for a short-term target of 260. The stock is currently at 235 and up and about in trade today, 3.4% higher. What do you say about that level though, 260?
Yeah, good morning, Alex. So, yes, definitely he can consider. And since his target is 260, which is 25 points up from the current levels, his stop should also be at 225. So, means 1:1.5 is the ratio, basically, if he's okay with that. In fact, he can, the way we are seeing, Hudco positioning its base around its major averages, probably it can surpass the 260 level plus targets also. So, considering the market volatility, I would rather suggest him to maintain a slightly lower stop loss at 220 and then wait for 270, 75 as a positional target.
So, those are levels to watch out for on Hudco, and it is hold at this point. We've got Sanjay calling us from New Delhi. Hi, Sanjay. How can we help you today?
Yeah, morning, Alex.
Good morning.
Thank you very much for taking my call.
My pleasure.
And I am having this small business finance credit, 5,000 shares at the rate of 109.
Okay.
And I have a time horizon till 30th of June. And I'm looking somewhere around 120, 121.
Okay.
Would I be able to get it at these prices or and suggest me a stop loss too, please?
Sure. Okay, let me go to Ajit on this one. Ajit, it's up and about, it's 0.9% higher in trade today, and it has moved up as much as 22% in the last 3 months. Does that mean that the momentum will take it to levels of what, 120 plus? And is that possible by the end of June?
So probably yes, Alex, considering the kind of momentum that the stock has been experiencing, but at the same time, it's a slightly volatile stock. Means if you'll see the last 10-15 days of move, 110 to 92 and then again to 110 levels. So stop is at 102, which is the short-term moving average. So it's 5 points down roughly from the current levels. And 120.25 positionally can definitely be considered as a target.
Okay, all right. So that's the view on SBFC. Sanjay, hopefully that answers your question. And we've got the next question on Aavas Financiers. This is from Gautam, who's writing in from Mumbai. He's bought at levels of 1,833 and he's got a 12 to 18 month time frame. He's wondering whether to hold, sell, buy more or switch to something else. Saurabh, on the fundamentals, he's incurring a bit of a loss at this point. Does he book that and move on, or should he hold on?
But best of the lot, I would suggest him to switch to banking counters like ICICI or maybe Canara.
So you've already mentioned that you like those names in the banking space. All right. So we've got Javinder Kumar Sharma, who's writing in from Amritsar in Punjab, and he's asking about Tata Teleservices. He's got at levels of 79 rupees a piece. The stock is currently trading at 75. He's asking whether to hold or sell at this point. And since he's not given us a time frame, I'm going to assume that he's asking based on the technicals. On the charts, Ajit, what's the view?
So Alex, I assume that he has just bought it. Means in the last trading session, the stock has moved up almost from 57 to 80 in just 3-4 days. Now, today it's slightly down, roughly around 1.5%. So it's a natural move that after such a phenomenal surge, we usually see stock consolidate, and probably around 70, 72 could be the lower band for this consolidation, and upside next swing could help the stock to inch toward 87 plus levels. So as of now, if he's okay with 70 as a stop loss, he can stay put with 87 as a position target.
Okay, all right. Rajan Iyer is writing to us, and he's asking about a stock that is not a very long track record. It's a recent listing, relatively speaking. Vishnu Prakash R. Punglia. And he's got 400 shares at an average price of 193, acquired in July of 2024, and he's ready to hold for a period of 3 years. He's asking what the prospects are based on the fundamentals. Saurabh, what is the view?
I think it is a very good company, very old company, listed recently, but we are quite optimistic on the infrastructure space. But recently, what is happening? Even the companies like HG Infra are not posting good set of numbers. There was some kind of a margin pressure was seen. But from the 3-4 years perspective, I think it should be a good.
Okay, so hold is the view on Vishnu R. Punglia. Eternal is a stock that we're talking about next, and we've got Rohit who's asking. He's got at levels of 198. Which is actually a pretty attractive price, all things considered. There are people that have been waiting for from higher levels for a good price to deploy. The latest update, of course, has to do with the implication of the MSCI rejig and the weightage of this particular stock, and as a result of which there is selling that is taking place purely on account of expected flows. The question to you, Ajit, would you buy at this point if you have the opportunity, or would you hold on to something that has been bought at levels of 198?
So Alex, my suggestion would be to hold, because if you see, it's been almost like 2-3 months of consolidation in this tight band, roughly around 200 to 250, and we are currently in the middle of the band while hovering around the major averages also. So probably it can spend some more weeks within this range before we resume the trend. And since he has bought it at very lower levels, he can maintain a trading stop at 215 also, because that seems like the immediate base for this stock. So once we cross, let's say 250 to 60 area decisively, then probably 285, 300, the previous swing high is something that the stock might retest.
All right. Suresh from Hyderabad has got a few names in the banking and financial services space that he's looking at. Among them, he's talking about Bandhan Bank, IDFC First, as well as Ujjivan Small Finance. Saurabh, you've already given your preference. You've said Canara Bank, ICICI Bank are banks that you prefer. What do you have to say about these three that I've just mentioned, though?
Won't recommend to invest in any of the banks, in any of these banks, but he is just noted. But apart from ICICI Canara, I would suggest him maybe he can go for a smaller bank like Maharashtra Bank, or maybe a good name like Indian Bank.
All right, so that's the view on the banking space as a whole. It is something to watch out for, as remember, as interest rates go down, and we're anticipating that there will be another rate cut in June, there is an expectation that there could be further contraction in the net interest margin of these banks, and that could have a bearing on the earnings going forward. Remember, that wasn't a problem in the fourth quarter because most banks managed to keep their net interest margins stable despite the rate cuts that you saw. Ramesh is calling us from Tamil Nadu. Ramesh, very good morning to you. How can we help you today?
Sir, Ratan India, TVS supply, chain supply.
Okay.
2,000 rupees, 2,000 shares at 187 rupees.
Okay.
What can I do?
Okay. When you bought this, what was the thinking, Ramesh?
I bought 6 months back, sir.
Okay. And what had you thought at that time? Why did you buy it?
The TVS chain supply has good news. That company is TVS company. So only I bought.
Got it. Okay. Okay. So I understood you incurring quite a big loss in this. So let me go across to Saurabh on this one. Bought at levels of 187 and bought a pretty large quantity. So what is the recommendation here?
I think if you look at the numbers, there was a degrowth in the numbers. It's relatively a recent listing. Not much history is there. So I think he can wait for one more quarter or 2 quarters to get the sense of from the management. If management is sounding good, then keep on holding. If there is some kind of a nervous, management is not going to give you confidence for the growth going forward, then better to exit.
Okay. All right, so wait for a couple of quarters for TVS supply to turn around. We've got Suman who's writing in from Hyderabad and asking about Amara Raja batteries, which he's bought at a price of 1,276. He's got 55 shares, in incurring a loss at this point because it might just be incorrect. All right, so the price may just be incorrect. 1,276 is the buy price. He is incurring a loss. It's currently at 1,045 or thereabouts. He's got 55 shares. He's wondering what to do. The question to you, Ajit, on the charts, what are the prospects on the upside? Where would you keep your stop loss?
Right, Alex. So it's been almost a year that the stock has been witnessing correction. It's a gradual decline from the record highs delivered roughly around 1750 to 950 now. And if you'll see from the last 2-3 months, we are seeing some base formation. Means around 950 on every dip, we are seeing that buying interest emerges, and then the stock witnesses a rebound recovery. But at the same time, the major hurdle is still intact, means the area of long-term moving averages, which is placed around 1100. And that's the zone basically where we have the price-wise resistance also. So let's say once we break this zone, then probably we can see the decisive recovery, which could push this stock slightly above his buying price. Means 1300, 1350 is something the stock might test once we break 1100 mark. So as of now, since the base formation is still in place, he can continue to hold his position with the 950 as a stop loss, and with 3 to 6 months, he can wait for 1350 as a position target.
Okay. All right. Karthik is calling us from Bengaluru. Hi, Karthik. How can we help you today?
Hi, Alex. Good morning.
Good morning.
Yeah, Alex, I have a query with regard to Waddilal Industries.
Okay.
So I bought around 8 shares at the price of 5,500. So I can hold this for another 1.5 years, but wanted to know if I can add more at the current price, which is at 6,100 something today.
Yeah. So you're looking for a technical view, is that right?
Yeah.
Got it. Okay. So it's doing particularly well today, Ajit. It's up about 5% or so, 6,215 on the ticker. Would you add more at the current price?
So Alex, I would rather accumulate, means in case if he is planning to add a similar quantity what he already has, he should rather accumulate in this range of 6,000 to 5,800, not at the current level, because if you see that it's been almost a month now, the stock has been experiencing volatile swings, means in the range of 5,800 to 7,200. So probably we can get better levels to re-enter, once we see any dip towards this 5,800 to 6,000 zone. And then probably for this entire position, he can maintain a trailing stop at 5,200 in case if the view is short term.
Okay. All right. Satyan has got the next question asking about Gland Pharma. Long-term perspective is being sought. His target is 2,500 to 3,000. And he's asking whether he can add more at the current juncture for a period of 12 to 18 months. The stock is currently trading at 1,522. So it's pretty stiff target, I would think. Ajit, would you agree? It would need to double.
Alex, it's still like, the trend is down. Every now and then we do see attempt of a rebound recovery. But since it's an underperformer within the sector and otherwise also, I feel that the right approach is to stick with the leaders within the sector. So stock like Divis, Dr. Reddy, Sun Pharma, Lipin, they are doing much better. So instead of adding to your loss-making position, in case if you have any, or you are planning any fresh bets in an underperformer, it's better that you should go ahead with the names which you just mentioned, or the other, outperformers from this particular sector.
Quick question on that then, Saurabh. Based on fundamentals, would you switch to something like an Eris Life?
Yeah, Eris Life is a good choice. I mean, the company is doing good and the promoters are quite aggressive in their business. In case of Gland Pharma, I think yes, the company is largely in the injectables, doing nothing, and there is a margin pressure. There is a lot of competition in the injectable space. So I think it would be a better idea.
All right, Shiva is calling us from Hyderabad. Hi Shiva, good morning. How can we help you today?
Good morning, sir. I have 130 quantity, 130 SBI at the rate 810 rupees.
Okay.
I'm looking for dividend. If I exit, I have bought it on May 1st. If I exit right now, will I get dividend? That's what my query.
Okay, so I'm actually not sure. I'll have to pull up the record date. Effectively, you'll have to understand whether or not you have had the stock. Saurabh, do you have that data handy? And if at all, I do not know. Shiva, why do you want to exit at this point? I'm just curious. When you bought it on the 1st of May, did you only buy it for the dividend?
Yes, exactly. I only bought for dividend, and I will wait for 810 also. At the rate 810, I can exit right now. Yeah.
Saurabh,
when the 810 price comes.
Saurabh, you want to weigh in on this strategy?
See, 15 rupees 90 paise was the dividend. The dividend got axed on the 16th of May.
There you go.
So he will surely be getting dividend. And with regards to its holding, I think it's a kind of a portfolio stock you can hold for the long term.
Okay, the dividend apparently will be paid on the 30th of May. So you will get your dividend. It is a portfolio stock, as Saurabh has pointed out. Let me very quickly go to Ajit. Ajit, 810, not too far away from the current market price. Is that something that is achievable in the near term?
So certainly yes, Alex, because when it comes to the banking space, we are seeing that on the rotational basis, both private and PSUs are witnessing decent traction. And within the PSU space, we have seen decent run-up in stock like Canara Bank, Indian Bank, and others. So SBI could probably the next candidate because the base formation is going on for almost 2-3 weeks now, while holding above his short-term averages. So with stop at 780, he can in fact wait for 820 plus levels also.
Okay. All right. So let's take the next question. This is from Indonesia, and Srinivasan is asking this question. He's got BEL at a price of 185 rupees, 212 shares. He's planning to hold for a period of 5 years. Should he book profits? And considerable profits at this point. The question is, can you call a top at this point? And I have this question for the both of you. Saurabh, on the fundamentals, what more can you say about BEL? There's quite a bit that's happening for this company, but the valuations are something that you have to ask about, right? So would you continue to hold?
There's a good chase for all the defense stocks, and the BEL is among the one which is performing well. On the operational front, I think the numbers were great enough. There was a margin expansion also. The book is doing good. The order book is doing good. Yes, the valuations are on the expensive side, but yes, when the company is posting good set of numbers, who cares for the valuation? And that is what is happening for the BEL. I think for the next 4 or 5 years, it should be a good stock to hold.
Okay, quick view, since this is a stock that a lot of people are interested in. Ajit, on the charts, BEL, what is the potential upside from this point?
So Alex, if you see that within the defense stocks, last week we were seeing certain stocks witnessing consolidation after a strong surge, but BEL on the other hand continued to inch higher. It's been among the top performer in the Nifty 50 basket from the last 2 weeks. Now, after this strong performance, there could be a phase of intermediate consolidation, but considering the past consolidation means almost a year-long consolidation, probably 430, 440, in case if the view is, let's say, for 2-3 months, that could be the probable target the stock might test.
Okay, all right. The next question is from Shubham, who's writing in from Kolkata and asking about Piccadilly Agro. I don't think that he is bought yet. He's asking about a fresh purchase and whether or not he should make it. The stock is currently trading at 63. What's the view on the fundamentals, Saurabh? If you have coverage, would you suggest a fresh entry?
I think all the alcohol beverages companies are doing, and in my opinion, I think it is in the same segment. So it's a small company, but yes, he can hold on to it.
750 on the ticker. I must have misplaced that. The stock is trading at 555 or thereabouts. All right, so it's a good pick. But having said that, Saurabh, what according to you is a top pick in the alcobev space?
I think United Breweries, Radico Khaitan, both looks good.
Okay, all right. Tata Motors, and this is a question from Razia Sultana, who's writing in and asking about it. She's not really told me anything more in terms of what she wants to know. The stock is currently trading at 733. There's a lot that's happened over the course of the last few months on this company, not least of which has to do with their international business, which is Jaguar Land Rover, and the tariff concerns in the United States. Some of that has dissipated. The question is whether you would deploy at this point or not. So, Saurabh, would you buy at levels of 730?
I think it is very difficult to take a call on the Tata Motors based on what is happening in the global arena. I mean, major part of the revenue comes from the Land Rover and Jaguar, and the tussle is still on. And we are talking about lower demand also. So, in my opinion, I think it is better to base on the domestic one, like maybe Mahindra rather than Tata Motors.
Okay, all right. So that's a view on Tata Motors. Mahindra & Mahindra is the preferred pick based on the fundamentals. Raj is calling us from Tamil Nadu. Hi Raj, good morning. How can we help you today?
Yeah, so I am holding the share of IDFC First Bank 390 at the average price of 70.66. Now I could see shall I consider accumulate more since I am ready to hold for a long term, because I could see some institutional investors voting rights issue with Vaidyanathan to be in the CEO space. So on that note, shall I consider since it is in the downfall? So.
All right, so we've got Saurabh, who's already indicated that his preference in the banking space is ICICI Bank as well as Canara Bank. But let me get you a view on the technicals. If you bought at levels of 70.66, it's not too far away, if I'm not mistaken. Let's pull up the ticker, just see where it is right now. IDFC First Bank, can we do that? The intraday chart for IDFC First, it's at 66.69. So not too far away from the current market price. From that perspective, in the near term, what are the triggers according to you, Ajit, and what levels would you watch for? Where would you put your stop loss?
So Alex, if you see that it's been almost 1.5 years now that the stock was witnessing corrective phase, but in the last couple of months we have seen a very sharp rebound. The stock has reclaimed its major averages on multiple time frames. So that gives us comfort that yes, the declining trend is over, and probably we can see some fresh momentum also once we cross this 70 hurdle. So in case if the view is, let's say, for 1 year or 2 years, definitely he can consider accumulating. Now at least the stock should hold 60 levels decisively in months to come. So until we break this mark decisively, there could be a possibility that 85, 90 is something that the stock might attempt in next 6 to 9 months.
All right, I'm circling back to you on this one. Varun Beverages, it was a stock that was in focus on Friday. It gained as much as 4%. It's down about 0.8% in trade today. What is the target price money is asking for Varun Beverages for a 1-year time frame? He's bought at levels of 498 and he's got 231 shares. He's in a small loss at this point. He's bought at 498, stock is at 484. What is a strategy that you would employ for a 1-year time frame?
So Alex, I would recommend him to at least liquidate partial position in case if that is his final position, because probably he can get better levels to re-enter. Because if you see, the stock has been a steady outperformer for last several years. It's just that in the last couple of years we are seeing a bit of a consolidation or a sign of like a slightly topping out in the medium to long term charts. So probably close around 440, 400 is the zone basically where we've tested last time also. It's a good area to re-enter, or in case if we see a breakout above 550, then only he should re-enter, because otherwise he'll keep on holding it, let's say for a next couple of months without any major action.
All right. We've got our next caller from Bengaluru. Chindu is calling us. Chindu, very good morning. How can we help you today?
Yeah, actually I'm holding a share of Fiat, 1,000 shares at a price of 3725. So my question is, should I hold it or book the profit?
So I just want to confirm, is it 3275 or 3725?
3275. 3275.
Because Chindu, that makes all the difference. You're sitting on a gain of 5.2 lakhs or thereabouts. And that wouldn't be the case if you had bought at 3725. Okay. So your question is, should you hold for the long term, is it?
Yeah.
Okay.
And if I hold it, how many more months should I hold?
Okay. But did you buy it based on the business or did you buy it based on the price action?
Price action.
Okay. Ajit, on the charts then, the question is for you. The stock has run up quite considerably after its numbers, good set of numbers, and relatively speaking in the tire space. Would you hold on at this point or would you book?
At least I would book partial profits, Alex, because from 2200 to almost 4000 mark in no time. So probably we can see a dip towards 36 and 3500 in the near future. So it's prudent that at least book partial profit and then maintain a trailing stop loss at 3600 if the view is less than a year.
All right, let's take a couple quickly. Geeta from Bengaluru is asking the next question. Gujarat Gas, bought at levels of 630. Would you book losses at this point? Is the question. Ajit, what, on the charts, what would you do?
Yes, certainly, because Alex, I doubt that the stock can make any meaningful up move once until we break 500, 510 levels decisively. So if the view is let's say less than 3 months, it's prudent that she should book losses and switch to the better counter.
Okay, we've got Manoj from Mumbai asking about BHEL, bought at levels of 248. What is the future? Is the question. I guess he is asking about the fundamentals. Would you hold at this point? Saurabh.
I mean, the company is putting up a good show. They've been getting good orders. In my opinion, it is a hold.
Okay, so it's a hold, is it?
Yes, it is a hold.
Okay. All right. Would you buy Relaxo footwear at this point? And what is the breakout level in your opinion, Ajit? This is a question from Yash, who's writing in from Gurgaon. He's holding at a price of 1,052 for a long time. What's the view?
So Alex, it seems like a short-term bottom. So probably yes, one can buy, and 425 should be a stop loss. In the next swing, close to around 480, 85 is something that the stock might test.
Got it. All right. That brings us to the end of this edition of Ask Profit. Saurabh as well as Ajit, thanks so much for joining in. Pleasure having you on the show.
Thank you.
We've discussed a lot of stocks today, and hopefully, even if your specific question was not answered, you've benefited from the stocks that we've discussed. We've got lots lined up for you over the course of the day, starting with Know Your Company. That's up next. Do stay tuned. This is NDTV Profit.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? Hello and welcome. You're watching KYC Know Your Company and I'm Harsh Saita, your host. I'm going to today talk about the IT index. Now, in terms of the way and the manner in which the IT index has performed, it's done very well from the lows. From 32,000, we've rebounded quite well. While the macro does not seem to be improving in significant fashion, at least on ground at this point. Commentary also did not see a material improvement, and that's exactly why we've brought in eClerx Limited to talk to us about IT and what are the trends playing out in IT. Now this entire small and mid cap space in IT is evolving and is very, very interesting. Some stocks have rebounded all the way to 20-25% and all the way to back to their highs or towards their highs, and that's why it's starting to look very interesting, and it's important and relevant to zoom out and know whether there's actually expected to be a recovery here. What are management seeing and what is it that's transpiring in the US? There's plenty happening on tariffs. Is there a tailwind with regard to US macro? Once tariffs start to possibly, or the concerns start to ease out, which it has, could you start to see an unwind with regard to all the pessimism in the US? That's the other thing that we will try to understand from management. The third piece is, let's look at eClerx specifically. What's making it unique? What's helping it stand out? Or is it just another IT company within that IT basket? Are margins eroding is my next question, and they have been. The margins were well north of the 20-23% number. Now they are sub 20%. So clear erosion with regard to margins, and is that a concern? And the last piece is, what are growth prospects looking like for the coming year and for the medium term? What should one pencil in terms of growth, and therefore in that context, how do valuations stack up? All of this we'll try to break up on today's KYC. Let's first start off and look at what the company does. And eClerx is a pure play IT company incorporated in the year 2000. It got listed in 2007 or more so 2008. It provides business process management, automation and analytics services. That's broadly its service offering. It caters to what kinds of businesses? Financial services, communication, retail, media and manufacturing technology companies. So all of those is what it caters to. Last off, and more importantly, how's the breakup in terms of industry? And you're seeing the numbers, of course, Q3, Q4 and full year FY25 largely stable, and therefore let's just look at the FY25 numbers, which is the column, or rather the row right at the end. Look at that. BFSI is around 43%, communications is around 26%, and communications includes media and basic technology as well. Then there's high tech. High tech plus manufacturing is around 16.5%. You have fashion, which is roughly 9%, slightly different, but largely in that retail basket, so retail, fashion and the like. Then there's emerging businesses, which is roughly 5%. That's how it's broken up. So a very high reliance on banking, financial services, communications, media, telecom. That's broadly how it's split. So something to keep in mind. Now, in terms of currency contribution, dollar is largely the predominant contributor. Nearly 80% of its top line comes from the US. Euro is around 8%. So Europe too, some bit of exposure, and then there's small exposures from the UK as well as others. That's how it's split up, and that's how you'll see even the geographic concentration. There you go, around 78% from the US, 14% from Europe, which would likely include the UK as well, and then there's 8% rest of the world. So US concentration is extremely high, and that's why we've picked this one. It's an interesting one. Now, in terms of offshore, that's days of sales outstanding, broadly flat, nothing to be too concerned about. Let's look at offshore voluntary attrition. Now, what exactly is an onshore service and what exactly is an offshore service? I'll try and quickly split that. The onshore services is when a US company is availing services from an Indian company having a US presence. So It could be an Indian company listed in India, but having a subsidiary in the US, having people in the US, the 2,000 odd people or 5,000 odd people in the US are servicing the US based company. This is offshore. So this is people sitting not in the US but in India. And that's broadly what eClerx does. And the offshore, and you look at the numbers in front of you, 15,000 versus just about 600 which are onshore. That's largely the split. And in terms of what the attrition is like as well, that's the other concern I have. Attrition has gone up. So I want to understand from management whether that is going to be a concern. 24% attrition is what the company has clocked in FY25. We're going to speak with Srinivasan Nadathur, the CFO of eClerx, but let's try and first, as we always do, understand the metrics behind eClerx and what it has done over the last 3 to 5 years. These are the rating parameters for eClerx, typically with all IT companies. We'll start off with the income statement, balance sheet, cash flow, and thereafter look at return ratios. You also have shareholding, street cred, street coverage, and valuation. So that's how we'll kind of break it up. And let's quickly get you our views. Let's look at the numbers to start off with. In terms of the income statement, you look at the top line growth, it's roughly around 16% on a 3-year CAGR basis. Revenue in FY22 was around 2,100 odd crore. Currently sitting at around 3,400 odd crore. In terms of the size, it's extremely small, and therefore, would you want it to grow at a faster clip? For sure. So that's where some of my pessimism comes from. The other piece is with regard to EBIT. Look at that EBIT growth, just 7.5%. So your top line is not translating to profitability. That's how your EBIT trend has been over the last 3 to 4 years. So you're not seeing a very sharp increase with regard to EBIT. And therefore, if I can take you back and look at the margins, you look at how the margins have evolved, they've been on a continuously falling trend line. 26%, 23%, 22%, and now you're at 20%. So you're sitting on a lower margin number. And therefore, if we look at the first graphic again, the net profit has actually gone from 418 crore to 541 crore, which is just about a 9% CAGR growth. Not significant, right? And you're looking at a company which is sub 20,000 crore in market cap. So you want it to grow faster, you want it to grow towards the 1 lakh crore, but at this rate, it's not going to do that for a fairly long period of time unless something strategically shifts. And for the moment, we are not seeing that, at least on the income statement. And that's why I give this one a thumbs down. But the balance sheet looking fairly good. Let's look at the net worth of the company. It's sitting at around 2,300 odd crore. That's on your screen. And it has a fairly decent amount of cash and bank balances, as would understandably be the case with IT companies. They always come out with solid amounts of cash. They distribute that cash across the board. And therefore, it's looking like a decent balance sheet as such. No concerns, no debt whatsoever. So fairly clean, a thumbs up with regard to the balance sheet. Now let's look at the cash flow. The cash flow, again, an interesting one. And this time what we've tried to do is we've tried to get you operating cash flow to PAT. I want to understand how much of that profit after tax number is reflecting in operating cash flow. And look at that, 101%, 103%, 121%. So very strong operating cash flow flowing from the profit after tax straight to the company. Some part of that is getting distributed, of course. They have done a buyback of nearly 400 crore in FY25 at the start of the financial year. And therefore, you will continue to see distributions come in because as is the case with most IT companies, the cash coming in is very strong, whereas the amount of capex required is not that large. And therefore, a positive even with regard to the cash flow. No concerns. Even receivables, we spoke about the days of due or debtor days. That also is not fluctuating in a significant fashion. Now let's look at the return ratios, and as is usually the case, you will have a fairly solid set of return ratios which are coming through. The only downside here is it's on a falling trend line. You want it to start to go up, rather it's coming down. That's the one concern, but nonetheless you're holding steady. When you're looking at, and I'll tell you why I've given this a thumbs up. When you're looking at the broader universe of companies, you'll largely see that ROCE is above 20% is very healthy. But when it comes to IT stocks, ROCE of 20% is nearly a given. And as it scales, the ROCE ought to inch up. Now, this one is on a slightly difficult glide path with regard to returns and margins. And therefore, you're seeing a fall with regard to ROCE and ROE ratios. And therefore, you're seeing a bit of concern there. But when you're looking at it from a broader universe perspective, your return ratio is very healthy at 21, 22 odd %. But there's again no reinvestment happening in the business, right? And second, a large part of the cash flow, therefore, is coming straight out as dividend. So those are some things that you want to keep in mind when you're looking at the return ratios. Let's look at shareholding now. The shareholding, promoter holding is around 54 odd %. FI is around 10%, but it's fallen from the 12% number same time last year. DIs have increased their holding from 23% to 25%. But broadly, why the thumbs up is because the promoter holding is fairly strong and fairly steady at 54 odd %. Now let's look at the street cred. You look at the 6-month performance, you look at the year-to-date performance, it's a fairly muted performance. But you look at the 1-year performance, 54% up, and you look at the 5-year performance, it's very solid at 11x. And that's where you start to see the outperformance shine. So in the near term, it's been a bit of a drag, yes, for sure. But over the longer period of time, it's done very well for itself. And therefore, we'll give this one a neutral because of the near-term headwinds it's seen. Last couple of metrics. Let's look at valuations now. And again, this is a very interesting piece. We'll come to street coverage in just a minute. Let's look at valuations first. You look at the way it stacks up in terms of valuations. Now, these are all its peers. You're seeing eClerx at 25 times, 5-year average is 20 times. So it's already trading at a 25% premium. You have First Source, which is trading at 33 times. It's currently sitting at 44 times. So very strong growth coming for First Source. That's being built in by analysts. 33 times 1 year forward, but the 5-year average is 36. So still some scope for upside. Look at Hinduja Global. It's trading at 47 times, 5-year average is 28 times, and a Birla Soft is trading at 19 times, 5-year average is 22 times. Now, Hinduja Global is not trading at 47. I'm going to change that. It's Newgen Tech, which is trading at 47 times, 5-year average is 28 times. That's how the valuations essentially stack up. You look at other companies, they're looking cheaper compared to their 5-year averages. That's point number one. But at the same time, eClerx in absolute terms is trading at a lower valuation compared to others. But it's also offering lower growth. There's some bit of headwind on the margin as well. So you want to look out for all of those factors when you're deciding in on valuations. We're giving this a neutral. There's no comfort per se with regard to valuations. It's obviously trading at a premium. But at the same time, it's a slight discount to some of the other IT stocks. And therefore, if it significantly outperforms from a results perspective, you could well see this stock re-rate. That's something that I would want to be looking out for if I were to be looking at the valuations versus some of the others. So something for you also to look out for. Neutral with regard to valuations is what we're calling it at this point. And when you're looking at how analysts and the street is viewing this as well, there are just about 10 analysts covering the stock with just a 7% upside. 8 buy calls on this one. So largely, there's no comfort with regard to upside either. So we've given a neutral, and that is reflecting here, and hence we took street coverage post valuations. So just kind of caps all of this out. Let's look at the summary of how all of this stacks up. You're seeing balance sheet, of course, healthy, and no doubt cash flow decent. Return ratios compared to the larger universe, I did mention that, is a thumbs up for sure. Shareholding is a thumbs up. Street cred, street coverage, valuation, more to be desired, especially on that street coverage and valuation. So we've given this a 5.5 on 8. Now, we'll focus in with regard to the management. I earlier spoke with Srinivasan Nadadhur, who's the CFO at eClerx. Here's what he had to say with regard to Trump tariffs first, because the road ahead for the company is going to be largely based on how the US performs. So a couple of questions on the US to start off with, listening. Right, in conversation with Mr. Srinivasan Nadadhur, who is the Chief Financial Officer at Eclerx. Welcome, sir. First off, I want to understand from you what the impact with regard to US tariffs is likely going to be, because you have such a large mix coming from the US in terms of business.
Thank you, Harsh. Thanks for having me on the show. So we primarily are a provider of IT services, and therefore first order impact is nil. But we do have clients in high tech and retail, and they may have some impact because of tariffs to their business, and therefore there may be some second or third order impact for us. What that means as of now is not very evident to us, but we do know that a lot of their management bandwidth is being consumed on how to manage the new situation that has arisen in their businesses.
That's interesting, sir. And you know, if I can couple that with the way in which demand is shaping up from the US, because you're so skewed to the US, is demand in the US showing any sign of recovery whatsoever at this point, just given all the headwinds that are there and in combination that some of the businesses there are facing?
Actually, our pipeline remains strong, and it has improved over the last 1 year. And other than the fashion and luxury segment, which for us is a very European-focused business, we are seeing good demand in all the other parts of our business, including the US. So at least on the demand front, there appears to be not much of an impact that we can see today.
Okay, and is there a conscious call to try and go and make the other geographies slightly larger, and is there a preference, or is there a preference to go more towards the US? What is the internal preference like? What's the strategy like?
Our internal preference has been always to make Europe and other East Asian companies, East Asian geographies larger. Having said that, you know, we've seen a lot of growth, and this has been the preference for maybe the last 4 or 5 years. But the growth from the US has been very strong for us. So I would say that, as you rightly pointed out, we still continue to be heavily reliant on the US.
So what can you extrapolate from this? How should the next 3 years probably play out? How would you play this very difficult headwind cycle that the US is seeing in terms of numbers?
It's hard to give specific numbers on what the next 3 years would look like, but we've always been focused on, firstly, we are a small company, so maybe that impact for us may not be as much as that for larger companies who are reliant on larger mega-sized deals. So our focus will continue to remain on solid delivery and execution, and to remain close to our clients and try and add value in whatever that they are trying to do through technology, through AI, and so on. So that basic fundamental aspect of our go-to-market strategy, that remains unchanged.
And what's the thought process behind employee costs? They've continuously climbed. When you're looking at the last 5, 6, 7 year trend, employee costs are trending higher. And that is in some fashion impacting your margins as well. At what point does that peak out, stroke bottom?
So there are a couple of reasons for that increase. One is that over the last 5, 7 years, the percentage of revenue that gets delivered onshore, that has nearly doubled. So maybe 8 years back it was about 10%, now it's about 20%. So that is one main reason. And the second is that we've started over the last 2 or 3 years to invest more on analytics and technology skills, and these skills, as you would know, are more expensive. We will continue to invest in AI and technology skills. The onshore component will stay where it is. So we may see a gradual, maybe a very slowing down of that increase. But again, if I think we will want to invest more in technology and analytics because we want to make that a larger part of our portfolio.
And therefore, would you say that margins at this point have bottomed, or there is still some way to go, maybe a year or so? And these AI costs that you will incur, will you expense them, or will you, and of course as an extension to that previous question that I asked, would you expense them, would you capitalize them, and therefore what will the impact on margins for that be?
So as of now, everything, the investments are fairly small, so it's all being expensed. There is no capitalization. To your first question on what the margin range for FY26 and maybe future is going to be, I can talk about FY26. So we give a 4% range on the EBITDA margin, including other income, which is about 24 to 28 is what we had said for FY25. We ended up at 26%, right in the middle. And we are continuing with the same range for FY26 as well. There are a couple of headwinds. So we opened delivery centers in Lima and in Cairo. So there may be some headwinds, but as a percentage of the portfolio, it is likely to be small.
What are the new age growth levers that you're looking for, or how do you take this from 3,500 odd crore in terms of top line to 7,000? Would it just be consistent 10-15% kind of growth compounding, or would there be new levers that you look for to push the growth baton?
So we are looking at a couple of things. One is to strengthen sales operations and effectiveness. So there's a lot more focus on how we are selling, what we are selling, whether there are conversations that are maturing, how much time it is taking for deals to move to down the funnel. So that is one. The second is we have digital services, we have technology, and we have customer experience services. These we want to cross-sell across our entire portfolio, across our entire set of clients. And the third aspect is that we want to sell more larger deals and not just focus on smaller deals. So these are the three areas that we are working on actively.
And how do you stand out to try and win those?
I think it will be what has set us apart till now has been execution and delivery, and that will continue to remain our basis for selling.
Is there a plan to build moats? What really helps you stand out? Is it the relationship with the client that you have? Is it the niche that you've created within the sector space? How does that work?
So the moat is essentially the kind of domain that we are working in, and that tends to be high complex, high touch domain. So we have very close relationships with clients. We work in domains that are more complex, require a higher level of skill, and that's something that we will continue to strengthen even in the future.
And what about segments? You work across a wide board of segments: financial services, communication, retail, fashion, media, entertainment, manufacturing, travel, leisure, technology. Where is it that currently you're best placed to capture the largest available opportunity?
So in BFSI and in cable media telecom, these are two areas where we see significant pipeline growth. Those have been the growth drivers for us even in FY25. So we expect that at least in the next 2 to 3 quarters, growth will be led by these two industries.
Okay, you'll continue to deliver value to shareholders through buybacks, or is there a larger plan to maybe invest to go into inorganic expansion? Is that at all on the table?
It is on the table, so we continue to look for opportunities, and as and when something interesting comes along, we will use the cash for inorganic.
How large would it be? In what segment, space, pocket, geography?
Geography will be developed countries. In terms of size, maybe 10 to 20% of our revenue is the maximum that we will look for. And in terms of capability, it will be something that adds to what we already do. So either in the data space, analytics, or technology.
What does this new setup, new delivery center in Lima and Cairo bring to the table for you? Does it bring, of course, new set of opportunities, but how large would those opportunities be? How much would it add in terms of top line maybe over the next year and maybe over the next 5? What's the thought process?
So this has been driven on the back of client demand. So clients want us to deliver from multiple geographies, and that's what we've addressed through these centers. It also gives us the capability to service multilingual requirements in a more meaningful way. So something like Spanish, which we were not able to do at scale earlier, which we'll now be able to do. It's hard to again see where this goes in the next 5 years, but we believe we have a reasonable amount of visibility for the next year or so. We've started small, but hopefully these centers will continue to expand.
Are there more centers in the pipeline? Is there more demand coming from customers? And does this cause margin headwind at least in the near term?
There'll be some amount of headwind in the near term because of these two new centers. But I think because they are small, the impact on the overall book is not likely to be much. And we believe that we can manage the drag on margin. At the moment, we have no plans for opening anything more. I think we need to get these couple of centers up and running at scale before we decide to go in for anything more.
And your attrition well, out of time, frankly, on this one, we spoke about attrition as well, and he suggested that it's fairly normalized. There are no concerns whatsoever with regard to attrition. But completely out of time on this edition of KYC. Stay tuned to NDTV Profit. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind?
Hello and welcome to Markets at 12. I'm your host Anushi Vakharia. Let's take a quick check at how the markets are doing currently. First off, starting off with the benchmark indices. Now what we are seeing in terms of Nifty 50, we are seeing gains of around 0.6%. We've seen a slight bit of an uptick in the last half an hour of trade or so. Currently the day is high at 2579, while the Nifty 50 is trading or hovering near the range of 25,000 over here. In terms of where the Nifty Bank is headed, Nifty Bank seeing gains of over 0.23%. We've seen a slight bit of an uptick here as well. In terms of where the point contribution table is, let's see which are some of these stocks bucking up the trend today. Now we have something like Reliance in focus, ICICI Bank, M&M, other stocks which are pulling up the index, while Eternal is one stock which is down under pressure today. This is on the news flow of its outflows, which will take place in the MSCI and the FTSE indices. So some bit of pressure in Zomato, that's Eternal that we are looking at. Sun Pharma, Ultratech, Cement, other stocks in counters which are under pressure in trade today. So that's as far as where the Nifty contribution table is holding up. In fact, let's also see the Nifty heat map to see where the major action is taking place. So in terms of where the heat map is, M&M top gainer, Bajaj Auto, it's the auto pack in focus, Hero Motor, M&M and Bajaj Auto all seeing gains of around 2%, while Eternal, as we discussed, seeing cuts of around 3 odd percent or so, while flattish moves in counters like Grasim, Sun Pharma, Ultratech, Cement and JSW Steel is what we are looking at. In terms of where the broader market action is concerned, now let's pull up Nifty Mid Cap 150 in terms of where, so we are looking at gains of around 0.5%, similar to what we have seen in the benchmark index, that's Nifty 50. And where small cap 250 is concerned, let's pull that one out as well. We are seeing gains of around 0.52% here as well. Let's look at BSE 500 to get a gauge of which are the stocks under focus. Weber Global right at the top, seeing gains of around 8%. Phenolics, this is despite a weaker set of earnings that we are looking at. The stock is up over 7% in trade today, while for India also we are seeing gains of around 6%. Again, the trigger being the fourth quarter results is what we are looking at. While on the losing end, we have something like a Balkrishna Industries seeing cuts of around 6%. We will discuss the stock later on the show as well. Hikal, another counter, seeing cuts of around 6 odd percent or so. Team Lease, another counter, seeing cuts of over 4%. Eternal, Dalmia Bharat, other stocks in focus here. In fact, let's see which are some of the top gainers in the mid-cap space and top losers in the mid-cap space as well. So in terms of where the gainers are in the mid-cap indices, if we are considering that, so this is what we are looking at in terms of where the Weber Global, Phenolics and Linde is. So this is overall the Astral currently seeing gains of 3%, Paytm and MRF also. MRF is seeing gains of over 2% in trade today. In terms of where the sectoral indices are concerned, now for sectoral indices, let's see which are some of the key sectors in focus. Now here we are seeing auto pack right at the top of gains of over 1%. IT is another one seeing gains of over 1%, while it's media and PSU bank which is under pressure. So this is as far as where all the action is happening in terms of where the markets are concerned. But let's discuss individual stocks, and the first one on the radar is GE Vernova. Now what we are looking at for GE Vernova, now this is buzzing on the back of its fourth quarter results. They've posted their best operating profit margin, and this is the best seen in the last 3 years at least. Net profit is also the highest seen in the last 3 years, and it's the margins which are a standout this quarter, which margins have expanded on the basis of better pricing along with improving exports as well as change in the product mix. In fact, if you look at the headline numbers, revenue up over 26%, EBITDA is about 2.3 times of growth we are looking at, which has resulted in margins moving upwards to the range of 22% as compared to 12%, and net profit in line with the EBITDA jump has seen about a 2.8 times of a jump. In terms of where the order book is headed, so if you look at the Q4 order intake, we saw about a growth of 124%, with the value standing at 2,990 crore, just shy of the 3,000 crore mark, while for overall FY25 the orders were up around 860%. FY25 order backlog stood at the levels of 12,660 crore at the end of FY25. Now in other key highlights, the company also mentioned that they are looking at 1-2 HVDC projects which will be finalized in FY26, so watch out would be that. as well, since these are big ticket order sizes that we are looking at. So how this would shape up the order intake for FY26 is another factor that we should be watching out for. Other than that, they also expect a 240 crore of organic capex over the next 2 years. So GE Vernova in focus, the stock currently locked in upper circuit of 10%. But let's also talk about Balkrishna Industries. Now the stock has cracked over 9% on weak fourth quarters, and brokerage has downgraded, citing increased risk from new competitive business forays. Puneet joins in with more details on this.
So definitely it's a big negative coming in for Balkrishna Tyres, largely also partly because of this earnings, that net profit is down 25%, but majorly because of the company's entry into passenger car radial tires, which is tires for cars essentially, as well as the truck and bus radial tires essentially. Now the key contention is that's a very hyper competitive market with players such as Apollo Tires, MRF as well as Seat having a long stronghold over the last 3 decades, and hence an entry with a minimal capex at this point of time, considering the opportunity, could be challenging going forward. Now they've also mentioned that roughly 3,500 crores of total capex will be for 3 separate ventures, including the new tire capacity and new tire segments, but they've not given a separate breakup for what the opportunity is. The company did highlight that this will only come in post 24 months, so over the next 2 years we still won't see any entry by the company in this new segment, but the capex outlay as well as the plans currently for the company seem to be they'll be only targeting a very niche market in the passenger car radial space, and that might not give the desired returns at least over the next 5 years. We've also seen brokerages such as Citi as well as Nuvama come in and cut target prices. Citi has maintained the sale rating target price of 2,400, and they've said that they're relatively cautious on the company's new foray into the passenger car radial space. They've also said that the strategy, which is for sales, distribution, marketing, amongst others, is very different to the company's traditional agri as well as off-highway tire capacity, and hence they've cut the valuation multiple by 10%. And Nuvama, they've downgraded actually Balkrishna to a hold now. Target price is cut by 13% to 2,700, and one key point that they're making is while over the medium term increasing this would be a logical step and increase getting into a new segment, the competitive intensity is much larger in this, and you need a separate brand essentially for getting into this space. So that's one of the key verticals. Balkrishna is also the most expensive tire stock amongst all the 5 companies listed, so we're seeing that valuation re-rating, but definitely the street not liking this entry into the passenger car tires as well as the truck and bus radial tire space for Balkrishna today.
Well, thank you for that, Puneet. Balkrishna Industries down about 6% in trade currently. But before we talk about more stocks and what's happening with the markets, let's talk beyond these 4 walls that we are looking at. Mumbai woke up to lightning, gusty winds and thunderstorms this morning, causing severe disruptions to suburban rail services and traffic. The India Meteorological Department has issued a nowcast warning forecasting thunderstorms accompanied by lightning and intense rainfall. This is over the next 3 to 4 hours in Mumbai, what we are looking at. Meanwhile, an orange alert has been issued for the national capital, Delhi, with rains and thunderstorms expected. To discuss the situation further, we are now joined by Air Vice Marshal G.P. Sharma, President of Meteorology and Climate Change at SkyMed. Hello and welcome to the show, Mr. Sharma. First off, now what we are looking at is heavy rainfalls today. Also, this will also mark Mumbai's earliest ever monsoon. Just want to understand from you, what is the current kind of environment that we are looking at in terms of where the rainfalls are concerned?
You see, Konkan region has been having heavy rainfall for the last almost 48 hours. Mumbai escaped with just about moderate shower, that is yesterday and day before. Yes, last night onward, the rains have picked up for Mumbai also. Colaba had very heavy rains, 120 millimeter, whereas Santa Cruz was shade less. But then today morning onward, the non-stop rains going on over Konkan region, including Mumbai and all the suburbs also. Heavy rains are likely to continue, I will say, for the next about 4 to 6 hours over Mumbai. Also, since the high tide time is also there, 1 to 1:30 or so that will add to further the waves which we have. High tide The wave height, storm surge will be there almost about 4.5 meter, means about 15 feet or so. So one needs to exercise a lot of care because that will add on to the normal astronomical waves which we have. High tide put together, it is going to be a little risky going along the coastline. Flooding possibly may take place in the low-lying areas. So this will continue. Today we need to be a little cautious. Tomorrow may ease out a little for Mumbai, but Konkan will continue even tomorrow. Major breakthrough that will come day after tomorrow when the rains are going to ease out. Yeah, that's it.
And Mr. Sharma, what's your prediction for the next few days? Now, with the onset of this early monsoon, it has also been considered that 2025 might be the year which would break previous year's records as well in terms of where the early monsoon is considered.
That's right. You see, this monsoon in Mumbai was 29th of May. Okay, so that's it. This could be the earliest. This could be the earliest monsoon. In any case, Maharashtra also we are having the monsoon early arrival, beating the record of last 35 years because monsoon has already entered. It will cover some more parts of Maharashtra in the next about 2 days also with heavy rains, heavy to very heavy rains over many parts of Maharashtra. Mumbai, in any case, as I said, that also will break the records of arrival of earliest monsoon. And you see, the situation will improve after about 48 hours or so. We need to be very, very cautious, exercise all cautions for the next about 24 to 36 hours. Konkan region, Mumbai for the next about 12 hours or so. Tomorrow possibly it will ease out a little, but the southern suburbs of Mumbai still will continue from Sindhudar, Raigad, Ratnagiri. These areas will continue. But then the Mumbai, major improvement in case you say, that should come around the day after tomorrow. Yeah, that's it.
Okay, so day after tomorrow, some improvements seen over there. Thank you, Mr. Sharma, for joining and sharing what is all happening with the prediction as well. Thank you so much once again for joining us. But shifting focus and back to the markets, Eternal faces $840 million of outflow hit this week as FTSE, MSCI slashed their weights. Can this food delivery giant weather the storm? Let's bring in Somit with more details on this.
Well, yes, Eternal will remain in focus given the fact that there are now $840 million of outflows expected this week on the back of the fact that both FTSE and MSCI have reduced their weightages of Eternal on their respective indices. Now, this weight change is because the company had earlier implemented the reduction in FPI limit in the company to 49.5% from earlier a limit of around 100%. But there are differences in this weight reduction that FTSE and MSCI have done this time. Specifically for FTSE, unlike the headroom-related weight reduction which is implemented in phased manner, direct reduction may lead to one outflows in one shot for Eternal. And for an MSCI case, if you look at, there were no changes announced last week when MSCI had done the index rejig, and no changes were expected till the August review as well. However, the MSCI has come out and announced this change in weight reduction for Eternal out of turn this time, and the outflows that we will see because of FTSE weight reduction will be around $380 million on May 27, 2025, while for MSCI outflows are expected to be to the tune of around $460 million on May 38, 2025. So total of $840 million expected this week. However, also do remember that on Friday the stock had gained 5% on expectations of no changes that could happen as early as August. So we had seen a strong gain in the share prices on the back of this, but out of turn, both FTSE and MSCI have come ahead and announced reduction in weightages of Eternal.
Well, thank you for that, Somit. The stock currently under pressure, seeing cuts of about 4%. But primary markets are starting to buzz again. This is over half a dozen companies have filed for their IPOs in May. My colleague Hiral has a more detailed data on this. Hiral, is the IPO mania back?
IPO mania is back, and what has happened is that your initial year in terms of 2025 was slightly subdued, and reasons known from the kind of uncertainty we saw in the global markets to the kind of FIs that were pulling out who have come back as well. But let's understand what it's looking like now. 76 IPOs that have been filed in calendar year 2025 so far, out of which, if you go to see, this is the highest number of IPOs that are filed in over a decade up till May 2025. Now, what's interesting is the kind of mix that we have between main board as well as the SMEs. First, let's understand the money that has been raised. Almost around 18,964 odd crores that have been raised by IPOs until May 2025 versus 48,152 crores in terms of the same period last year. So the amount that has been raised is still lower as compared to last year, but the number is what we are focusing on right now. Now, in terms of the distribution between main board listings and SME, 11 until May 2025 on main board versus 36 SME listings. And if you see the same data in terms of last year, 29 main board listings versus 32 SME listings. So the quantum of SME listings has remained the same, whereas main board has been slightly lower this time around. Moving on from there on, if you talk about more than half a dozen companies that have filed IPOs, let's understand the kind of companies that have come in. Canara HSBC Life Insurance, Canara Robeco AMC, Tata Capital, Urban Company. That's the top four. Apart from that, you have BMW Ventures, Priority Jewels, Jinkushal Industries, and Corona Remedies. So majority of them, if you have to see, are still from the BFSI space to highlight it all. And you have a Mori Tech and Ravi Infra. Others, again, divided between various sectors. Let's understand the 6 IPOs that have come in terms of May so far. Burana Weaves, that has already been launched. We've already seen 144 crores is the size. Bellrise, again, already launched, 2,150 crores is the size. Now, what opens today is the Aegis Wopac. 2,800 crores is what they are raising. Apart from this, you have Skoda Tunes, again 220 odd crores, Scholz Bangalore, which is Leela, opens today 3,500 odd crores, and Unified Data Tech Solutions, 144 odd crores. So these are the ones that have already come in terms of the month of May so far. Now let's just quickly recap 2024. It has been a record year. 91 companies which actually hit the IPO market back then, and they've managed to raise almost 1.6 lakh crores in 2024. Moving on, if you see in terms of the overall data as well. Now the key from here on is whether 2025 will be able to hit that 1.6 lakh crore mark or exceed that, because the quantum of IPOs that are hitting the markets is huge in terms of filing the DRHPs, but the mix right now is skewed towards SMEs. So the main board quantum is lower in terms of number versus the SME portfolio, and the amount raised in the period so far, it's a 48,000 odd crores in 2024 versus a mere 18,000 crores right now. So that is a key that we need to take into consideration whilst moving forward from here on to understand this market.
Well, thank you for that, Hiral. That's a pretty interesting set of study that we are looking in terms of how the IPOs have fared. Of course, with the market recovery back in picture, the quantum, or rather the frequency of more IPOs coming, is something that we should be watching out for. But Narayan Health is in focus. This is after the company announced its fourth quarter numbers, with the PAT seeing a growth of 3%. This is on a year-on-year basis. My colleague Varsha joins us with more detailed breakdown on what has happened with Narayan Health.
Yeah, thank you for that. So overall, good set of numbers. If you see performance in India unit was led by domestic volume pickup and of course increased realization that the company has seen. Company has taken minor price hike as well. The India revenue is up 10.7% year on year. That Cayman Island revenue is up almost 50%. So that's the highlighting part when it comes to Narayana. If you see there, domestic business is up almost 16.2% year on year, but their international business, if you see, is down 54%. That is because of the Bangladesh. If I were to talk about their expansion plans, so the current bed capacity stands at around 5,745 beds, but they have a target of 7,680 of bed in the next 3 to 4 years, and for this company will have to raise debt going forward. So overall, yeah, good set of numbers, and company is going into expansion plans when it comes to greenfield and brownfield as well.
Well, thanks for that, Varsha. In fact, earlier today we spoke to the company's CFO Sandhya J about their growth trajectory in FY26. Listen into what she had to say.
We do anticipate to improve margins like we have done for the past 3 years in FY26 also. Without guiding, a lot of it will come through the same measures which we have taken, which is more throughput through the same infrastructure. No new infrastructure is coming online, but we do aspire to grow within the same capacity, which means we will continue to exercise the throughput levers. So we are hoping that the India margins will see expansion on the hospital side. Of course, we will continue to have cash burn on the insurance business side, and Cayman may broadly be stable in terms of its margin performance. So on an overall basis, maybe we will have a more stable margin performance, but definitely on the India hospital side, we are aspiring for margin growth.
Well, that's the view that we are having for Narayana Health. The stock is passing in trade today with seeing gains of about 3% in trade today. If you look at but it has cooled off a bit from the day's highs of 1869. So, well, that's all on the Narayana side. But Aurobindo Pharma is expected to post its fourth quarter earnings today. The company is eyeing fourth quarter revenue jump, but margins may face a hit. Varsha, talk to us about this as well. Why are we looking at this margin contraction?
Yeah, so first of all, a company is expecting a recovery in US. Now this is due to new product launches and contribution from the key generics, and Aurobindo's injectable business is expected to support top line also. Europe is expected to sustain steady growth momentum, while EBITDA margin, now there is an expectation that gross margin will improve, but EBITDA margin may decline. This is due to OPEX related due to recently commissioned plants. On to four numbers, if you see, revenue is expected to rise almost 8%, EBITDA is expected to rise 10%, margin are expected at 22.3% versus 22% last year, while net profit is expected to rise almost 12%.
Okay, so that's the key expectations that we are seeing for Aurobindo Pharma. Thank you for that, Varsha. But as a major boost to the government's fiscal position, the board of the Reserve Bank of India has approved a record surplus transfer or dividend of 2.69 lakh crore to the central government for the accounting year 2025. This transferable surplus for 25 has been arrived on the basis of the revised economic capital framework as approved by the central board in its meeting held on May 15. My colleague Pallavi now joins us with more details on this.
The RBI is estimated to pay 2.69 lakh crore rupees as dividend to the central government. This is at a record high. It's the highest we've ever seen, but it's also among the lower range of economist estimates who were expecting this figure to range anywhere between 2.5 lakh crore rupees to upwards of maybe even 3.5 lakh crore rupees. The RBI board also revised the economic capital framework, and this revised framework stipulates risk provisioning under the contingent risk buffer within a range of 6 plus or minus 1.5% of the balance sheet as against the existing level of 6.5% with a lower bound of 5.5%. So it is essentially the tweak to this contingency risk buffer because of which the dividend has come in at what it was, and economists do believe that without this tweak the figure would have been closer to 3.5 lakh crore rupees as was being earlier estimated. Nevertheless, it does continue to remain a record high figure, and it is expected that changes made to strengthen this framework are expected to help given what the global geopolitical environment is looking like. This surplus transfer, while we will find out details of where it exactly has come from, only from the RBI annual report which will be released next month, it is largely expected to have come on the back of higher forex sales, higher earnings on forex assets and higher earnings on VRR operations. The government was targeting 2.56 lakh crore rupees this year from the RBI and PSUs in the form of dividends from them. So that this does mean that this figure does continue to provide substantial comfort to the government on the fiscal front.
Well, even on that note, if you take the macro side of the picture in consideration, core inflation is set to remain lower on slower growth. This is what Pranjal Bhandari believes, Chief India and Indonesia economist of HSBC. Listen in as she explains how low inflation will help the economy.
My sense is that the average of next 6 months, we could see inflation actually average about 2.5%. which is way lower than the 4% target, simply because food inflation has fallen. And not only is it because of items like vegetables, but it's durable items like pulses, wheat, rice. After a very long time, state granaries are full of food. And once that becomes the case, and that can keep a lid on inflation for like a 1 to 2 year horizon. So food inflation looks to be in a good place. And then you have core inflation, on the back of slightly weaker growth, on the back of the currency now having rebounded a little bit, on the back of imported disinflation from China, falling commodity prices. My sense is core inflation will also remain quite low. Now, when inflation is so low for so long, it helps in many ways. One, it helps the RBI to have a loose monetary policy. It's been cutting rates. We are expecting 3 more rate cuts in this cycle. It's giving a lot of liquidity. We think that will generally continue. Second, it provides higher purchasing power. And this purchasing power is very important for the informal sector. When prices fall, they feel rich, they buy more.
Well, that's all the time that we had on this show. But before we wrap up this segment of Markets at 12, we leave you with an intriguing campaign that is taking social media by platform. Watch this sponsored feature and stay tuned to NDTV Profit.
Today we bring you a mystery that's got the entire nation talking.
Red envelope society है एक mystery, जहाँ elite minds create history.
No name, no words, just a red envelope. Inside, a cryptic message, a QR code. And here's where it gets stranger. Once scanned, the code vanishes completely.
In the next 2 hours flight, you can read, sleep or watch movie. But your money doesn't do any of these. True. You wanna know how elite make their money work? Yes. Your invitation expires upon landing.
No trace, no history, no data left behind. Social media is in overdrive. The Instagram handle at Red Envelope Society has crossed 250,000 followers as users share mysterious footage or encrypted posts and theories that spiral from the bizarre to the unbelievable. Some believe it's a covert signal passed among the ultra-rich. Airport hoardings have also joined the game, flashing thought-provoking messages as travelers pause, phones in hand, minds racing. No confirmations, no official statements, just question after question.
And just look how amazingly people are dressed in here.
Who is the woman in red? Why only select travelers? And what do the vanishing QR codes really mean? As the red envelope mystery spreads from terminals to timelines, one thing is clear. This is no coincidence. Stay alert, stay curious, and keep watching as the truth unfolds.
That's huge. That is a biggie. It's on
गोल्ड क्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest?
Hello and welcome to Profit Buzzers. A very good afternoon to all the viewers. This is Heera Datia. With me is my colleague Varsha. Varsha, good afternoon. An interesting day of trade. Clearly, if you see in terms of SNSEX goes a little over 500 points is the kind of gains that you're seeing which is creeping in. If you pull up Nifty 50 also on the screens to understand the kind of uptick, because it's a lot of stock specific action that you're witnessing in terms of where markets are concerned. Overall, if you see in terms of Nifty 50 as we speak right now, we are not at the day's highest levels, but we are sustaining that 25,000 mark, which is a psychological support level that the markets have been watching out for as well. So gains of around 0.6% coming in there. With this, let's quickly pull up the heat map in terms of the sectoral indices to understand what the trends are indicating and what is it that's pushing us higher. You just have media and the PSU bank index, which is slightly on the borderline. It's media which is down around 0.3%, but PSU bank index is pretty much hovering between the greens and the reds. What's on the uptick? Auto 1.2% is the kind of up move that's coming in there. Today is the 26th. We are still a couple of days away from the May auto sales numbers that will trickle in, but ahead of that, smart moves that is coming in with regards to auto. There is that buying interest coming in there. Apart from that, IT is on the upside, 0.9% higher. In fact, we did do an entire show with e-clerks today in terms of whether the IT sector is out of the woods or not. Not the exact benchmark, but that will set you up as well. Energy, FMCG, consumer durables, and you have, in terms of other sectors, you're looking out for infra, all of them trading in the positive. So clearly, you are skewed towards the bulls right now as we speak in terms of the sectoral indices. Let's quickly pull up what the benchmarks are indicating in trade in terms of individual stocks, because overall in terms of stock specific action as well, Zomato is one of the downers as we speak. But if you see in terms of contribution, there you go. Zomato, that's Eternal, Sun Pharma, JSW Steel, Kotak Mahindra. These are the ones which are putting pressure. But what's holding up is the ICICI Bank, Reliance Industries, HDFC Bank, L&T and M&M. There is that switch happening between these 4 or 5 names in terms of contribution. But clearly, it's the heavyweights which are taking charge in today's session. In terms of broader markets, also interesting trends which Varsha will take us through, Varsha, because a lot of stock-specific action, and this is the last leg in terms of where earnings are concerned, right?
Yes.
And it is the smaller names which are seeing those gyrations.
Yes, absolutely. So to speak, let's pull up Nifty Midcap 150. Let's see what that's doing. Of course, mirroring benchmark indices. It's up almost 0.5% on the gainer side. When it comes to Midcap 150, you have Linde India, you have JK Cement. Now, JK Cement is actually buzzing on the back of earnings. You have Solar Industries, you have Hutco. On the loser side also, you have Bal Krishna Industries. Now, if you see over here, although weak set of numbers, but the interesting point here is company is actually moving into passenger car radial tires, which is a low margin business compared to off highway tires which the company deals in. So that's the reason you are seeing the stock is down almost 6%. You have Dalmia Bharat, Hitachi Energy, SKF on the loser side when it comes to mid cap 150. On the Nifty small cap 250, let's see what that counter is doing, is up almost 0.56% as expected. On the gainer side, you have Vaibhav Global, you have Finolex Industries. Over here, if you see Finolex Industries, numbers did beat estimates. You have Sterling and Wilson, you have Jubilant Pharmova buzzing when it comes to small cap 250. So overall, Hiral, as you rightly said, when it comes to broader markets, there's so much of stock specific actions based on Q4 earnings.
Absolutely. A lot of stock specific action is what you're seeing. In fact, let's welcome in Dinesh Sani, Senior Research Analyst at Invest for Edu. Dinesh, good afternoon and welcome to the show. and a pleasure to speak to you as always on NDTV Profit. This is Hiral on this side. My first question coming to you is, how are you looking at markets right now? 25,000 is that psychological support that we have been watching out for. That's where we are hovering at. Is this the time to buy, or would you say this is the time to still remain on the sidelines yet and do stock picking?
Thank you so much for having me on show. So, see, my overall view in the market is still positive. Why? Because there are several things which I am seeing as of now. Macroeconomics are overall volatile, but for now, I see it very calm based on the events which are happening in terms of USA, right? So overall, I see volatile, but for now calm. Plus, valuation wise, what I see is based on 1 year forward estimates. I think it is trading. Nifty is trading at 22.5 times. So I think this is very decent valuation as of now. And one major trigger which I can think which can boost the markets up is the flows from FIIs. These guys are now favoring emerging markets. And overall, what I can see, India is well positioned, and based on the vision we have for next 5 years of India. So I think there is a good headroom for India in medium to long term. For now, there could be some profit booking, but my view for the market for the medium term is very positive.
Thank you, Dinesh, for that view. Well, three stocks which are in focus actually are buzzing on the back of Q4 numbers. Let me just read it out for you. You have Anupam Rasayan, wherein good set of numbers, revenue growth, if you see, was led by pharma and polymer, and revival in agrochemical demand that the company has seen. Of course, only volume growth there. There was a strong business or strong performance from the tank industries also, which aided revenue growth, and EBITDA margin expansion was led by product mix and operational efficiencies that the company has seen. Second stock is Gujarat Narmada Valley. Let's see what that counter is doing, because over here, if you see the EBITDA margin expansion, margin were at 11.7% versus 6.9% last year. Huge uptick when it comes to margin because of the raw material cost is down almost 10%, other expenses is down 9%, and employee expenses also down almost 14%. These are the three reasons why you're seeing EBITDA margin uptick over here. Last on the list is Finolex Industries, wherein overall, if you see, the numbers would be a kind of weak set of numbers, but it did beat estimates. So because stock is up almost 6%. Now over here, if you see 5% lower revenue was there, mainly on the account of weaker realization that the company has seen. But because of this, stock is why is stock up despite such weak earnings? Because there was a modest volume growth of 2% in pipe and fittings versus flat volume for industry, and PVC margins grew 23 basis points, and PVC prices are expected to improve going forward. So because of this, Finolex is actually buzzing in train. Dinesh, I wanted to ask you about, Anupam Rasayan, because the company has seen good volume growth when it comes to agro demand, and also guiding almost 25 to 30% of revenue for FY26. And your view on Anupam Rasayan and also Finolex Industries, considering the weak set of numbers that the company has seen, but of course, beaten the estimates.
Sure. So I'll first talk about Anupam first. So Q4 was very strong. Let's agree that. And in the presentations, the management has mentioned that they are very confident in its ability to return to the historical growth rates which are prior to the recent slowdown. So this is a very strong comment from the management side, which are also boosting the sentiments. But if I talk about the valuations, I think it is a little bit stretched as of now. So if one is considering to enter in this company for a longer term perspective, I would suggest to at least wait for 1 to 2 quarters and see if it is able to grow at this rate as well. Second, you talked about Finolex Industries. Yes, on year, there is an impact of material cost we can see. However, on a quarter basis, there was a decent set of numbers. But I would suggest that based on volatility in material cost, so it will be very volatile over the medium to long term. So if investors which have a lower stomach for these gains or upsides and downsides, maybe they can step aside and watch this for 1 to 2 quarters, at least for 2 quarters, I would say, before entering into this position. Yeah, that's it. These two things.
Right, so that's with regards to Finolex, as well as few of the other names that we have been watching out for, Anupam Rasayan as well. But moving on, from the healthcare space, you have Narayan Health that is in focus again on the back of earnings. If you see in terms of the quarter, interesting one, revenues have seen a growth, margins have also improved to an extent, and the net profit has gone up by around 3.5%. If you see in terms of the stock purchasing gains of nearly 3%. Clearly what they've said is that the India unit has gained from domestic volumes as well as better realizations. And Cayman revenues have seen an uptick of around 50% on a year-on-year basis as well. In fact, let's quickly hear out what the management also had to say from here on. My colleague spoke to Sandhya J, the Group Chief Financial Officer of Narayan Health, about the company's capacity expansion plans going forward.
I don't think you will get any additional capacity in the current year. Of course, in terms of capex, we will have capex. Most of the land capex is already done. So there is no further large land acquisition planned unless some meaningful project comes up for us. But we will definitely be investing in terms of the build out of these capacities, that is the greenfield growth, as well as the typical replacement and maintenance capex that we do. So about 300 crores a year is what we spend on replacement, maintenance, new capex, etc. within our existing units. In addition to that, we may spend about 450 crores odd in terms of the greenfield, brownfield capacities that we are trying to create. But these are projects, so the way the spend will get scheduled may be depending on how the construction progresses.
Right, so that's with regards to where Narayan Hridayalaya goes. Dinesh, let me come to you with regards to Narayan Hridayalaya as well as the entire chain in terms of hospitals. Overall, the key theme that comes in over here is the kind of capex plans that all of them are sitting on from here on, and the division that happens between brownfield as well as greenfield between all of these. Where would your bets be, taking into consideration the demand supply situation in the country, where supply is still lower than the demand, and that's what the industry is actually looking at? How would you talk about this industry?
First, I'll talk about the numbers of Narayan Hridayalaya. I think based on year and quarter numbers, very good set of numbers. Of course, the 50% upside in Cayman revenue is very impressive. And if I'll talk about the net debt to equity, it's almost 0.15, 0.2 times based on FY25 numbers. So yes, of course, if I talk about demand and supply, yes, I think overall what we are seeing is that specifically in India, people are also coming in India for the treatments, and overall supply is in this segment is very high. So what I can see is that there would be a balance of maybe not in near term, but over the time, I think I can see this overall trend growing because people are getting aware, and everyone has a good amount of money for going for treatments, plus insurance is helping. So yes, overall the industry wise, I can see it's very strong industry. But if I talk particularly for valuations of Narayan Hridayalaya, it is trading at 28 to 30 times of EV EBITDA. So what I would suggest is maybe they can wait at least for first half, because valuation I can see is very stretched based on everything is should be priced in as of now. So anything, maybe liquidity or some major EPS growth in the next 2 quarters can boost the overall valuations. But for now, it is priced in.
Got that view. Also, next stock which is in focus is JSW Steel. Now, this is on the back of Q4 numbers that where revenue did meet estimates. Record crude steel was at 7.63 metric tons, while record steel sales were at 7.49 metric tons. Profit, the boost that you're seeing in the profit is led by the other income, and they're also raising 7,000 crore via QIP. In fact, we spoke to Jayant Acharya, who is the joint MD and CEO of JSW Steel, about the company's growth guidance for FY26. To listen in.
So on the guidance, we are looking at a 10% growth in this year in terms of volume, an incremental 10% on the back of primarily the India growth. On the pricing and the operational efficiencies pricing I talked about, we would see probably an increased price in Q1, and we would expect that to remain range bound during the year. However, the positive is that our cost efficiencies in various areas are kicking in. JVML, with the largest blast furnace will provide a lot of operational efficiencies vis-a-vis our existing operations. And we will see the cost being significantly lower, which will structurally build into the margins. The second thing, as you said, is the renewable energy component. Our renewable energy has ramped up sharply, and we would be having more than a gigawatt of renewable energy by the end of this quarter, and that again would reduce our cost. Our operational efficiencies on our raw material sourcing and blending will again reflect in our costs. So all in all, we certainly feel that we will have a better operating environment and operating margin for the coming year.
Right, so that's the word coming in from the management as well. But to an NDTV exclusive, in the latest from JSW Steel and Bhushan Power case, the government has actually started to review the gaps in insolvency as well as bankruptcy code. And remember, on May 2nd, the Supreme Court actually rejected the resolution plan that was submitted by JSW Steel, holding it illegal and in violation of the IBC. In fact, the Apex Court will also hear a plea submitted by JSW Steel of the judgment today. My colleague Shrimi has more details. Shrimi, over to you. What is the exclusive information that you're picking up, and what is the government actually looking at?
Yes, government is reviewing its insolvency and bankruptcy code regulation in order to prevent the repeated instances like JSW Steel acquiring Bhushan Power and Steel. What we've been given to understand that Finance Ministry is adopting three-pronged strategy, which includes certain amendments in the IBC, and some of these amendments would be brought in the upcoming monsoon session is the indication we are getting, and these are mostly with respect to the process and the execution of such deals, and those approvals like for example the Competition Commission of India approval, which is required prior to such resolution, could be also done away with, is the indication we are getting. However, Ministry is of view that there is no question of the robustness of the IBC. However, those gaps and the execution issues which has been highlighted by Supreme Court in the GSW matter, they'll try to sort of ensure and address those matter. In fact, the other one is with respect to having consultation with IBBI, the regulator, and the other stakeholders. In fact, all those ministries and departments which is being involved in such insolvency process, they will try to bring all of them on the same page. They're trying to sort of convey to have some commercial wisdom when it comes to insolvency process, and they will see whether there is a scope of further tightening of the regulation with respect to resolution professional in the CIRP, and also those involved with the code of conduct of these professional as well as committee of creditors. So all those discussions are already underway, and we would see some guidelines coming very soon, in a few months is the indication again we are getting. And the third one is with respect to the ongoing matter in the GSW's case, where the government may not be the party of the review petition. However, the whole idea of JSW and the other lender is not to kind of challenge the Supreme Court verdict on the liquidation part. However, they're trying to sort of have some leniency in that decision, in the name of public interest, where a lot of employee hard work is involved. The operational creditors are there, the creditors are there, so they're trying to have some sort of relief there. And government, on the other hand, is of course monitoring the entire matter so that whatever the issues which is concerning and emerged in this particular case will be addressed in the IBC, and some tweaking in this regard we would see in the upcoming monsoon session is what the hint we are getting from the government.
Shrimi, for getting us the details. And very interesting is where the company is actually evaluating legal options as well to retain the ownership and control of Bhushan Power and Steel. And overall, what they've indicated as well is that the company will recover its original investment of 19,300 odd crores in case of liquidation. In fact, the standalone business has not really used any tax credits from the company's past losses, so no tax reversals are expected as well going ahead for JSW. And that's Bhushan Power's profitability and matrix will continue to be consolidated by the company as of now as well. In fact, from what brokerages are also indicating, if you have to look at key brokerage notes, you have Morgan Stanley, which has maintained an equal weight. They have a target price of 1,000 on the counter, so we're pretty much over there. Apart from that, CLSA has maintained an underperform, and they've hiked the target price to 880, which is way below the current market price of the company, because it's mainly the uncertainties with regards to Bhushan is what they are looking at. However, in terms of the guidance, better profitability but volume guidance has been lower is what they've considered. And JP Morgan has maintained an overweight. They have the highest target price of 1,085, which is almost 100 rupees upside from the current market price as well. So that's with regards to JSW. In fact, let me ask Dinesh. Dinesh, how are you looking at a JSW, taking into consideration the proceedings with regards to Bhushan, the verdict that comes from therein? And apart from JSW, if you have to look at the steel companies overall, what is the overall setup looking like for a FY26 going ahead?
So since the developments are ongoing, I would reserve my comments for JSW Steel. But if I talk about the results, they were so based on year on numbers, so they were not expected whatever I'm expecting. But however, on quarter, I saw the overall improvement. But valuation, yes, of course, I think it is priced in as of now. Again, so still our view is to maintain the hold as of now. So overall, if I talk about the industry, I am very cautious based on the realizations which these companies get. So I personally don't track it very keenly, but the only reason I don't track it very keenly is because of the realizations and the impact which it has on the profit and loss statements, and based on that valuations fluctuate. So in our portfolios, we do not add these kind of companies related to commodities. So anyone has a weak set of stomach, so maybe they can be on the sidelines and watch these developments.
Right, got that view. Well, moving on, let's look at some of the weak earnings. You have Lux Industries, you have Afcons in focus today. The stocks are tanking in trade after posting their Q4 results. Now, Puneet joins in with more details.
Well, thank you for that. So definitely the last year has been a little tough for the innerwear segment, and apart from Page Industries, we've seen the more local as well as the domestic focused companies suffer, and Lux Industries is also one of them. Revenue, while growing 15% in this particular quarter, we've seen the EBITDA just grow 1%, with the overall margins down to 9.4%. versus 10.7% the same time last year, and subsequently the net profit is down 13% as well. Now in this particular quarter, one of the key verticals for the company is of course the innerwear segment, and that has seen gross margins come down by 190 basis points. We've also seen subdued consumption trends within the industry as well, and that's been impacted by inflation, and hence we've seen weak numbers from Lux Industries. They are anticipating a growth in FY26 with the increase in consumption, and that's also one of the key factors they mentioned is of course because of the tax breaks that have been given, with rupees 12 lakhs being tax free now. They are anticipating some consumption trends going forward. The second one is of course Afcons Infrastructure. Now this company is a recent listing done over the last past year itself, and while they have a really strong order book of about 36,000 crores in this particular quarter because of weak ordering as well as slower trends in terms of making these particular roads, we've seen the revenue fall by 11% in this particular quarter. We've also seen the EBITDA down 17%. Subsequently, margins at 9.1% are down by 70 basis points, and profits again are down 23%. Now the company is scheduled to host a conference call today, and one of the key aspects will be further order inflow going forward as well as the execution capabilities, because Q2 is generally a monsoon quarter, so we should anticipate recovery only in the second half. If that could be subsequent, that will be something to watch out for. But valuation definitely comfortable for Afcons, but Q4 results weak for both these companies in trade today.
Thank you so much, Puneet, for all the details. Dinesh, your view on Lux Industries and, of course, the sector as a whole, and also Afcon Infra. What are you making of these two stocks?
See, Lux Industries, quarter on quarter, it was a decent set of numbers. However, on a Y1 basis, margins were impacted as mentioned as of now. So valuations, I see it very decent. But still, again, don't just jump in based on the decent valuations. At least track this company, understand this company based on for at least for first half of this next year. And of course, Afcons, not a decent set of numbers based of course on YOY and quarter on quarter basis. So I don't see anything in this counter to see. Of course, based on what management will say and the order book execution, as it is rightly mentioned, because of rainy seasons, it will be only impact. The margins will be seen in second half of the financial year. So for now, at least for 5 to 6 months, nothing to see in these counters.
Right. So that's with regards to a few of the names that are buzzing in trade. But thank you, Dinesh, so much for joining us on the show and sharing your views with the stocks that we've discussed so far as well. But moving on to a quick update in terms of the monsoons, the city of Mumbai has begun to hop in the threat of sea waves amidst continuous rains. High tide with a height of 4.75 meters was seen in the sea, and these waves are at risk of filling water much higher than normal and in the residents of the beach. In view of this, the administration has actually started temporarily evacuating the Gateway of India, Marine Drive, Girgaon Chapati and other sea edges. NDTV Sujata Dwivedi joins us with the updates. Sujata, I know you are on the streets. How are the rains unleashing right now?
Intermittent rainfall is being recorded throughout Mumbai since morning, and now the IMD has predicted a high tide of 4.75 meters in the sea, because of which people have now been declared to empty these places. At present, we are here at the Gateway of India, and along with it at places like Churchgate, Marine Drive and Nariman Point, there is heavy rainfall that has been recorded since morning, and along with the rain, the city is now facing a high tide warning, prompting authorities to take these precautionary measures to ensure public safety. At present, if you see, there's a high tide in the sea that is taking place, because the water levels in the sea here is not usually being seen, and because it's a high tide of more than 4.5 meters, it can easily cross the wall, because of which these places have been emptied, and authorities have appealed to the public to avoid visiting beaches and coastal areas until the situation normalizes. Now, these lifeguards have been deployed along the coast, and police personnel are stationed to ensure safety and restrict access to potentially dangerous zones. And because Gateway of India was the place from where through the sea route people are often seen travelling to areas like Elephanta Caves as well as Alibag through boats, speed boats. For now, these services have been completely halted, and as you see, because of heavy rainfall, the entire tourists who come here on a large scale have been asked to leave from this very place since morning. More than 110 mm of rainfall has been recorded in this area, which is the Mumbai city area, and because of which people have been asked to be cautious, along with Mumbai personnel being deployed to ensure that nobody crosses the barricading that has been done. And also because the high tide is at around 11:45, we'll see that for the next few hours the condition of this barricading remains unchanged, and also because it's the gateway and people across the world come to have a look at this archaeological site.
Thank you, Sujata, for getting us the quick details or red alert that has been issued for Mumbai so far. But let's quickly slip into a short break. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready.
Market seesaw to trade back in the green. Nifty gives up the 25,000 crown but just at a few points shy. Defense and auto stocks are propping the markets up. And Eternal shares slide over 4% after major global indices like FTSE and MSCI cut shock weight. The street expects an outflow of $840 million from the flood food delivery giant. Balkrishna Industries too faces pressure. The stock is down over 10% as the company's Q4 profit misses estimates. Company's passenger car tire foray sparks investor concern on margins. And DV Slabs making some smart moves. The stock is up 4%, reaches 52-week high after the company announces inking of a long-term supply and manufacturing deal with a global pharma company. COVID-19 cases witness a rapid surge across the country with active cases crossing 1,000. Kerala tops the chart with over 430 cases, followed by Maharashtra with 209 active cases. And early onset of monsoon continues to spook Mumbaikars. A part of Kemp's Corner Road collapses, traffic movement restricted in entire Mumbai. Welcome back. You're watching Profit Buzzers on NDTV Profit. Let's quickly pull up Nifty 50 on the screens as well as Bank Nifty to see where we are at. We've broken below that 25,000 mark already. 24,972 is where Nifty 50 is hovering. So we are trying to head lower from here on, but where we close is going to be interesting from here on. And you have Bank Nifty, which is seeing gains as well. But again, a similar kind of trend. Giving up gains, we're trading with gains of around 0.2%. Broader markets somewhat mirroring what's happening in the benchmark indices. But let's pull up Radico Khaitan on the screens. That's the brokerage call of the day where MOSL has gone ahead and initiated coverage on the company. The stock is seeing gains of 0.7%. It did see a good spike and some cool off from there on as well. A target price of 3,500 rupees upside from the current market price. Harsh joins us to tell us what is making a Motilal Oswal bullish on a Radico Khaitan. Harsh, over to you.
Well, there's several pieces which is at play here because one, you have Indian-made foreign liquor, not too many players, it's difficult to penetrate the space, but it's also the premiumization trend which is playing out in a big fashion. You currently have around 3.1 crore cases which Radico Khaitan sells annually in or rather that number has played out in FY25, half of which is on the premium and above category, and therefore premiumization is a big trend at play, and along with it comes better margins as well. Why have margins not met what the management has guided for? That's because you have raw material costs which have inched up, especially on the glass side as well as on the EMA side, which is the extra refined alcohol. That particular pocket also has a higher cost currently, and therefore you're seeing margins which haven't come in as well as the management has guided, and that's probably the one piece which is which hasn't really played out in favor of Radico. But all of that to quickly unwind. 16% top line growth is what Motilal is penciling in on this one. They believe that margins will re-rate. They're valuing this at 60 times June 2027 estimated EPS. They are saying that this is expensive, no doubt about it. The stock has done very well over the last 5 years as well as the 10 years period. But nonetheless, they're still extremely bullish on this one. A 20% upside over the next 12 months is what they see on it.
Absolutely. Thank you, Harsh, for getting us the details. And in fact, we did do a story as well with my colleague Mahima indicating how IMFL has been picking up versus beer consumption in the country. So I think that's the space that MOSL is also betting big on. But moving on. Primary markets are starting to buzz again. Over half a dozen companies have filed for their IPOs in May. Overall, let's quickly look at what's happened. In calendar year 2025 so far, you have 76 IPOs that have been filed. And this is the highest number of IPOs that have been filed over a decade up till May 2025. What's interesting is the quantum in terms of the money that is being raised. Now, the money is around 19,000 odd crores up till May 2025, and if you have to compare this to 2024, that stood at around 48,152 odd crores. So in terms of the money raised, we're still almost, half or less than half, that is what you could say, in terms of where the money that is being raised is concerned. Now, the reason for this is the main board listings are slightly lower as compared to the SME listings. In 2025 so far, you have 11 main board listings versus 36 SME listings, whereas if you see back then in 2024, you had 29 main board listings versus 32 SME listings. So the quantum of SME listings has remained absolutely same. Main board listings has been lower. Whether that picks up or not is what we have to see. Now let's understand the kind of companies that have come in the month of May itself, which will be filed for the DRHB. That's Canara HSBC Life, Canara Robeco, Tata Capital, Urban Company. You can see the names on the screens as well. Mori Tech, Ravi Infra, Bill Projects. So majority of them are coming in the BFSI space. The quantum in terms of what they are going to raise is not known yet. So these are the ones we will be keeping our eyes on. But let's quickly understand the 6 IPOs that have come in the month of May itself. Firstly, Burana Weaves, 144 odd crores already launched. You have Bellrise Industries around 2,150 odd crores, which has already been launched. What has come in today is a Aegis Vopak, which has opened today, and Schloss Bangalore, which is Hotel Leela, 3,500 crores, which has opened today. Apart from that, Skoda Tunes and Unified Data Tech Solutions, again, a smaller quantum, but they are the ones which have been coming in the month of May as well. So the quantum is interesting. Number, again, it's a strong number for 2025 as a year. And if you have to look at 2024, again, it was a record year for the IPOs. 91 companies actually hit the IPO market and nearly raised 1.6 lakh crores. Now, whether calendar year 2025 will be able to meet that kind of a number is what we need to wait and watch and see, because right now, in terms of quantum, we are way lower. Whether the catch-up will happen in the remainder of the year is going to be interesting from here on. So that's with regards to what's happening in the primary markets. But one stock that has been in focus is Apollo Microsystems. Let's quickly pull up that counter on the screens and see what the stock is doing in trade. 0.3% lower as we speak. If we can also pull up a 5-day chart to understand the stock, the way the performance has been so far, 2.6 to 7%. There was a day when we did see a good spike coming in on this counter. In terms of earnings, revenues have seen a growth. Margins have also improved. Profits have come in at around 14 crores, which was up around 8%. And the order book positioning by December 2025 was around 2,500 odd crores. Adipali Krishna Sai Kumar, director at Apollo Microsystems, joins in to discuss how the quarter has been and how FY26 is looking like. Sai, my first question coming to you is, in terms of the fourth quarter, the numbers look pretty good. From here on, are you expecting a similar kind of performance in terms of FY26, or do you think there is something better in store?
Yeah, good afternoon. So, the numbers will keep growing, but I just wanted to, tell which we have been telling earlier also, that the quarter-on-quarter performance is actually not how it has to be taken as an annual performance of the company. But which in line to the guidance which we have been giving earlier also, the company will continue to post its growth at a CAGR rate of 45 to 50%, and with margin also expanding as the percentage of our core series production projects hitting onto the top lines actually. So, but yes, it was an interesting quarter. Always Q4 continues to be an interesting quarter, but this time Q3 quarter also has been very, very interesting. It's the highest ever recorded Q3, and overall this top line is the highest ever recorded top line for the company, and we are very positive. With the ongoing conflicts, the indigenous solutions of Indian defense are growing, and this is something that will build up a further traction and accelerate the traction for the company as well.
Hi, Sai. This is Anushi joining in. Now defense in particularly has been in focus, and there's been a lot of interest in terms of where the order pipeline is for some of the counters that are out there. Just want to get your understanding. What is the kind of order book at the end of FY25 we've clocked in, and what is the kind of inflows that you're seeing for the company for the next FY26-27 period?
So as of last week, we have close to little above 600 odd crores of order book, and this is something which will grow by 3.5 times by end of this financial year, with some large cap projects in terms of the production that we are expecting from Indian Armed Forces, and we foresee that we may start our export business sometime in the Q4 of this financial year. A lot of business development that we have done and activity done last year and last few months. I think we are expecting some export orders also in this financial year.
What is the kind of mix that you're looking for in terms of where the exports are concerned in the next 2 to 3 years? If you can give us an outlook on that.
So this year, I will not be able to give a clear guidance, of a significant export. But Q4 we may record some export business. But I think next year onwards, there will be some decent, good export business coming post Q2 onwards for sure. But in terms of percentage, it will not be a very, very large thing. Predominantly, we are an indigenous company, and most of the business will continue to come from Indian business. But by virtue of acquisitions that we have done recently of Ideal Explosives, the footprint in terms of the export market also we will be growing of the complete weapon systems and motor and other artilleries that we would be investing in the next few quarters. I think from next financial year onwards, the footprint in different continents will grow for the company as a consolidated top line is concerned.
Okay, so just a two-part question on that. Firstly, with the export percentage increasing over the years, just want to understand from which countries are you seeing more of these orders coming in from, and also what's the kind of margin picture that we should build in for exports? Is it expected to be better than the domestic orders which are there?
No, it's not about the margin pitch in the export is more something like that. The export point of view, when I talk about, there are some technologies which are up for export, which are non-weapon based things. There will be a decent margin. Which will be better than the current EBITDA levels what we have. But yes, in terms of the different areas where we are, we are very bullish in the Middle East and the African markets that our business will grow.
Okay. So my other question coming to you is taking into consideration, the recent geopolitical developments as well. The demand for indigenous defense solutions is what has got accelerated as well. And I think from what I read, a lot of company systems were successfully tested and demonstrated during this period, which has probably generated good amount of interest. Taking this into consideration, if you have to look at the next 2 years, because usually the delivery in terms of order books, the gestation is slightly longer for defense players, what is the kind of top line growth that you're expecting? And secondly, how much will that translate to from a margin perspective? Because the kind of investments that you're planning probably will put a cap on the operational front.
Yeah, that's a very interesting point actually. So the kind of capex that we are putting, that will have definitely a bearing on, at the EBITDA level. But the EBITDA level margins overall will be growing, and you will continue to see that the overall EBITDA level margins will increase, and in the PAT levels also you will be seeing a significant, maintaining the levels and also improving the levels. Not a very huge improvement, but yes, there will be an improvement. But at the same time, you can also observe that a preferential round is going on. We have received an exchange approval last week. We will be sitting on a huge equity also, which will improve the overall interest levels and other things, being the capital employed also. But this year, the profitability of a different product mix, being a production projects, will be increasing. I think there will be an expansion in the margins in the gross profit level.
So, Sai, one question, from what you've stated, around 45 to 50% CAGR growth over the next 2 years in terms of revenue, and this would exclude any contribution from the recent acquisition. If you have to take the recent acquisition into consideration as well, what would that translate into? Because I'm talking about Ideal Explosives then.
Yeah, so 45 to 50% is a standalone guidance that we are giving. In terms of the consolidated balance sheet, the revenues will double for sure.
Okay, so it's a 50% of a growth that you're looking in terms of with the addition of Ideal Explosives. Is that correct?
No. You mistook it. 45 to 50% CAGR, we will continue to growth on a standalone basis.
Okay.
If you take consolidated as a balance sheet, the revenues will double compared to the previous financial year. That's what I mean to say.
Understood. Also, so that's as far as, where the top line growth is concerned. I just want to get a picture on the capacity expansion plans also that you have in terms of whether Unit 2 is, Unit 3 is, if you can share about the progress on that front.
Unit 2 partially we started occupying, and from Q2 onwards, the full capacity, we will be, taking up actually, and some of the, RF, front, will be fully moved on to the Unit 2. Unit 3, stage by stage, we will be occupying for the phase 1 project from September onwards.
Okay, so that's as far as where the capacity expansion is concerned. Now, I just want to get a mix in terms of your R&D. If you are seeing now, that has been in the 8 to 9% of range in the last few fiscal years. If you are looking at this time, the mix was around 6%. Just want to understand for FY26, FY27, what is the kind of percentage of mix that you eye out for the R&D expenses which are supposed to take place?
Compared to the other industry peers, I think in this particular space in the weapon systems, in both listed space, there are hardly any companies who are there in the listed space doing purely weapon system electronics. With the different variety of spectrum of technologies that we do, both on onboard and onboard side, non-system side, we record highest percentage of 7, 8, 9%, in terms of the revenue in R&D. This time, there's definitely, you have seen from 371 to 560 crore, there's a huge leap, in terms of the revenue. So, the percentage wise, if you see, there is a dip. But in quantum of investment wise that we have done, definitely we have done, much larger than what we have invested in the previous financial year, FY23. So FY23 to 24, in terms of the quantum numbers, it is high percentage, because the revenue got increased. But in this financial year, something like 75 to 100 crores is the investment, we have done a roadmap, and we will be developing something very, very critical technologies, some very sensitive and extremely sensitive technologies that will be developed. The team is very, very, strong that we have in R&D, and, we are augmenting our design, team in this financial year, on a very serious note.
I think that, this is going to be a space that the investors are going to watch out for as well, taking the upcycle into consideration from here on. But thank you, Sai, so much for joining us on the show and sharing your views. Interesting gains that investors have made if you have to look at a one-year performance as well, not only for Apollo, but also with regards to defense as a sector. But moving on from the defense space to hospitals, you have Rainbow Hospitals that is in focus as well. Let's quickly pull up the stock and see what the counter is doing in trade, because in terms of earnings, it's a moderate performance, unusually quiet season is what you're looking at, and 35% of the business has remained low during this period. In fact, Varsha tracks this space also pretty closely. Let's also welcome in Vikas Maheshwari, Group Chief Financial Officer at Rainbow Hospitals. Vikas, overall, from what the street is looking like, the word is that it has been a moderate performance, quiet season. 35% of the business has remained low during this period. How would you look at the quarter versus your internal expectations? Has it met or missed?
Yeah, very good afternoon to you and your viewers. Yeah, you are correct. As a management, our expectation is always high. It has been very unusually, the quarter four was slightly below our expectation, but that doesn't mean that, the overall growth trajectory or the plan gets impacted. If you look at our 3 years or 5 years CAGR, where we have grown ourselves 16% CAGR, whether you take 3 years or 5 years. We have been listed for almost 3 years now. And if you take 5 years, then we have a 20 quarters. If you take 3 years, we have a 12 quarters. 1 or 2 quarters or 3 quarters in this, the whole journey would have been muted. But overall, we have been able to catch up the growth by way of growth of our IP volumes or OP volumes, plus complemented by the bets which we have continuously keep adding that. So I think the growth trajectory remains same. We are still very confident that we will deliver mid-teen to high-teens growth in the coming years.
Hi Vikas, this is Varsha here. Great to have you. Like you said, mid-teens to high-teens growth when it comes to revenue in FY26. Just wanted to have your view when it comes to margins, EBITDA margins for FY26, because you are adding lots of beds. So what is your guidance when it comes to EBITDA margin considering the bed addition that you're doing?
Yeah, it's a nice questions. If you look at, last year, we started with 3 new units starting, and we have seen 0.9% of the EBITDA, which gets, compensated. This year is going to be very, very busy. Next 6 months, you will see 3 new facilities getting added. So there will be some impact on the margins. As we have seen in the last financial year, which has just gone by. However, whatever the 3 units we have opened, they are on the right trajectory. Out of 3 hospitals, 1 has already become EBITDA positive and 2 are on the path of becoming EBITDA positive. So that loss, what we have done in FY25 will come down or become positive. And then these 3 units which we are opening next 6 months, there will be some drag. So plus minus, whatever the EBITDA margin we have seen, I think we should be there plus minus 0.5%. We should be there on the EBITDA margins.
Guys, just stay with us. We need to address the flashes at the bottom of your screens in terms of JSW, the Bhushan Steel case. The Supreme Court has acknowledged the complexity and the financial. I'll just get on all the details as well. But what they're saying is the bench has not passed any conclusive judgment yet. Secondly, what they've indicated is that the permitted filing of a review petition since time is not over. Overall, they've directed a status quo on the NCLT proceedings to avoid irreversible steps like liquidation. And they've also acknowledged the complexity as well as the financial entanglements involved. If we can just quickly pull up the stock on the screens and what's happening on this one. They've also warned that no effective order should be passed by NCLT until the Supreme Court disposes of the review. And that's a positive news coming in for a JSW Steel, and that's the reason why you're seeing that kind of a spike that's coming in on the stock as well, which is seeing gains of 2%. So absolutely, the hearing so far by the Supreme Court bench is in favor of JSW Steel, where they have not passed any conclusive judgment yet. And they've said that they're permitting filing of a review petition since time is not over. And they've directed a status quo on the NCLT proceedings to avoid irreversible steps like liquidation. In fact, they also acknowledged the complexity as well as the financial entanglements that could be involved in the entire transaction. And they warned that no effective orders should be passed by the NCLT until the Supreme Court disposes of the review. In fact, in terms of where the conference call also goes, what JSW Steel had also indicated is that they are not really going to look at anything major on this front right now. They are only going to look at the Supreme Court hearing once they file for petition. In fact, I do have my colleague Shrimi, who's been tracking this space pretty closely. Shrimi, what's the latest update that you have?
As you rightly mentioned that, Supreme Court has maintained a status quo, especially on the, liquidation of the Bhushan Steel, and it's an interim relief clearly for JSW here. And what, the court order is still not made public, but the verbal, judgment which has been given out clearly says that the Supreme Court, will maintaining the status quo on the entire liquidation, which they actually ordered on May 2nd in its important judgment here, and say that it will prejudice them since they are intending to file a review. Now, remember, JSW, after that May 2nd order, filed review petition along with the lenders, and they have been trying to, saying that there should be some leniency in the matter, if not, status quo. So it's a kind of relief for them at this point of time in terms of, giving them some more time to understand the entire process and how to go about it. And what we are also getting sense here is that they are, seeking that leniency not against the liquidation, which was the order, the May 2nd order, but rather saying things from the public interest that, remember, all those operational creditors which were involved in the entire process and the creditors and the amount which was involved in this entire process is in public interest, and that is what the petition JSW has actually moved, and this is the kind of interim relief which is coming in at this point of time, where they are maintaining the status quo. And in fact, they are trying to get sense on the next date of hearing. It's not clear as yet, but they have to come up with some sort of remedies that how they are going to go about this Bhushan Steel, the entire matter, and how this will pan out after this status quo is we are, watching that, and we are kind of getting sense that they will come up with some sort of options there.
Thanks, Shrimi, for getting us the details. So this is coming as a relief for a JSW Steel. In fact, let's also look at all the banks that were involved in this, who could have been impacted. So from an IOB who had an exposure of around 760 odd crores, Central Bank of India, South Indian Bank, PNB, Bank of Maharashtra, Canara Bank, Union Bank, from the larger ones, SBI, Bank of Baroda. These were the larger names that had exposure with regards to where JSW goes. And no major reactions that are coming in terms of the banking majors. But the most interesting part right now over here is the interim relief that has come in for a JSW. And, when in the conference call as well, what JSW had clearly indicated is that they will probably wait for the Supreme Court order. And from here on, that is what it has turned out to be. The stock is seeing a good spike. 2.4% is the kind of gains that we are seeing on the back of the Supreme Court order. But they've clearly said that they're acknowledging the complexity and the financial entanglements that have been involved as well. In fact, if you talk about the case background, Bhushan Power had over 45,000 crores in terms of obligations when the insolvency proceedings actually began. And JSW Steel's 19,700 crore resolution plan was the highest offer that had come in to the creditors as well. In fact, at that point in time, the Supreme Court's rationale was the court ruled JSW Steel's plan violated insolvency and bankruptcy code provisions, and the committee of creditors was found to have erred in approving the plan. In terms of consequences of the ruling, they were looking at liquidation order, where Bhushan would undergo liquidation proceedings, returning to the NCLT for this purpose, and JSW Steel would probably have to hand back control and possession of Bhushan Power and Steel to the financial creditors. And JSW Steel had demanded a refund of the 19,300 crore payment from the banks, and the COC was obliged to refund this amount, having previously assured the Supreme Court that they would do so if the plan was rejected. So that was the overall backgrounder as well. In fact, we do have HP Ranina, who's joining us on the phone lines to discuss and give his view on this. Mr. Ranina, good afternoon and welcome to the show. Your first comments in terms of the Supreme Court bench which has come in on JSW Steel case, where they've said that they've not passed any conclusive judgment yet, and they're permitting filing of a review petition since time is not over. and a status quo on NCLT proceedings has been directed to avoid irreversible steps, I beg your pardon, like liquidation. How would you look at this?
Well, I think it's a very good order. This is a vacation bench which is hearing the matter. They cannot take a final view. And therefore, what they have said is that it's better to keep the liquidation proceedings on hold, simply because it will have so many other consequences if they are allowed to go ahead. Therefore, the court has taken a very fair and equitable view. And looking at the balance of convenience, they have said that you keep the matter on hold. They told the NCLT to keep the matter on hold until the review petition is filed. Now the question is, when will it be filed? It's going to be filed as soon as they decide. But currently the Supreme Court is on vacation, and the Supreme Court will function only from the second week of July. So they have enough time to file the review petition and then ask for an early hearing as soon as the Supreme Court bench is able to convene when the court reopens in July. So how soon will it take? I think it depends on various factors. The other urgent matters which are pending before the Supreme Court by the same bench, all those will be considered. But the good news is that the liquidation proceedings have been kept on hold. So whenever the Supreme Court decides the final review petition, the matter will then go ahead. There is enough time now.
So, Mr. Ranina, when you say they have enough time, what's the maximum time do you think this can go on for in terms of the filing the review petition, number one? And two, where do you see this moving? Because when the court is saying that they are acknowledging the complexity as well as the financial entanglements that could be involved in this, and no effective order should be passed by the NCLT until the Supreme Court disposes of the review. How do you see JSW Steel responding to something like this now?
Well, JSW will now have to file the review petition definitely at least a week before the Supreme Court opens in the first week of July. So by the 20th of June, they should file a review petition. And then as soon as the matter is, the court reopens, they can ask for an early hearing. They have to make an application for an early hearing. So depending on which bench is sitting at that time, which is going to hear this review petition, they will ask for an early hearing. And as I mentioned earlier, depending upon the other urgent matters pending before the Honorable Supreme Court, they will decide. So I don't see any time limit, but the only time limit is that they should file their review petition latest by 20th of June, so that by the time the court reopens in July, they can press the matter for an early hearing.
Okay, so that's with regards to timelines that we should be watching out for. Now let's take a scenario where this is not in favor of JSW Steel, hypothetically. What happens then in terms of proceedings from a banking perspective? Do the banks have to really wait for liquidation and to refund all the monies? How would it work according to you?
Well, let us assume that the liquidation proceedings are allowed to be continued. Then obviously the banks will have to wait until the liquidator is able to give them back the money after disposing of the assets on completion of the liquidation proceedings. On the other hand, if the liquidation proceedings are totally set aside, then there is no difficulty, because then the scenario will continue where JSW will be liable to pay off the bankers for the loans that they have taken. So it depends on whether the liquidation proceedings are going to be proceeded with or not. And if they can show that they need not go ahead with the liquidation proceedings, for example, if JSW were to take a stand that will go by the scheme which was earlier approved, of issuing equity shares instead of optional convertible debentures, then possibly the Supreme Court will completely stop the liquidation of the Bhushan Steel.
I think, and that's when things remain unchanged as well. But thank you, Mr. Ranina, so much for joining us on the show and giving us that bit of information to understand what could be the next steps from here on. In fact, I have my colleague Somit also, who's standing by with a couple of details in terms of what he's picking up and in terms of impact. Somit, over to you.
Nilesh, Bhushan Power was an important acquisition for JSW Steel. They acquired the capacity of around 2.5 million metric ton back then for a cost of around 19,350, which was infused by way of equity and convertible debentures. Now, currently, if you look at Bhushan Power, forms around 12% of the consolidated EBITDA of JSW Steel, and of the total capacity of JSW Steel, that is 28.2 million metric tons. Bhushan Power forms around 3.5 million metric tons, and this is to be extended to around 5 million metric tons by FY27. So already the capital expenditure is ongoing for that expansion. Moreover, the company has spent close to 4,500 crore rupees on the acquisition, on the expansion and betterment of this plant of Bhushan Power. So a lot of expense has been done from JSW Steel as well. And as I mentioned, that it forms around 12% of the consolidated EBITDA. And as per analysts, if at all they have to give away Bhushan Power and Steel, then the impact on the SOTP could be anywhere between 51 to 94 rupees per share, which is nearly 5 to 9% of the total market price or the total share price of JSW Steel. Now, back when the announcement had come in, we had seen a sharp 6% fall. Today, given the fact that the announcement is a bit positive for JSW Steel, we are seeing some kind of a rebound, around 2.5% up in trade currently.
Right. Thank you, Somit, for getting us the details. So 2.5% is the kind of gains that we're seeing on the counter, trailing nearly at the day's highest levels. But an interesting development right now in favor of JSW Steel, and it has intensified. I think from what Mr. Ranina was also indicating, that they will have to file a review petition by the 20th of June is what he's looking at. But completely out of time. With that, it's a wrap on this edition of Profit Buzzers. Lots more lined up on the other side. Please stay tuned to NDTV Profit. Thank you from Varsha, the team that put this show together, and myself.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve.
Hello and welcome to NDTV Profit. You are watching Profit Top Trades and I am your host Puneet Zaveri. Let's first look at how the markets are doing before we move on to our corporate conversation of Ashok Leyland. We've seen the markets largely do very well in trade today, up almost 133 points. We've also breached the 25,000 mark again today in trade. While there has been some sell-off from that point, largely maintaining a positive view. It's been roughly about 180 to 200 point kind of a range on the Nifty, and we've seen somewhere right bang in the middle right now as well. It'll be very interesting of where we close. If we can close about 25,000 and maintain that going into trade tomorrow as well. Let's also look at the sectoral heat map now, because we have seen again a day being marked by some few key sectors, Nifty Media being the only one in the red today, while we've seen a positive momentum again come for something like a Nifty Auto, the Nifty Metal also up in trade, and it's supported by the news flow which we did at the end of the show as well of JSW Steel getting that reprieve from the Supreme Court as well. Let's also look at the mid cap and the small cap, see if they are in line with the benchmarks of how they are doing. A positive 100 points for something like a mid cap 150 again. It's been trading at a narrow range both for the small cap as well as for the mid cap, but it's positive that all three indices are in the green. Finally, let's look at the BSE 500, and there you'll see a very interesting chart. A lot of names reacting to at least earnings or news flow, and we've seen Finolex Industries being one of the big gainers today. That's also backed by the company's earnings that have come. While there's a margin pressure of 200 basis points compared to last year, it's better than what the street had anticipated, hence the 6.8% move on this thing. Linde again backed by earnings. Actually, Glasscoat has just been in another stratosphere altogether, because it's very positive earnings. We saw that up move 20%, another 10% move there, and again continuing their momentum into this week as well. Data patterns again almost up 5%. On the losing side, there is Balkrishna Industries, and we'll discuss that as well, because while the earnings were largely negative and the stock was expected to be down because of that, they've announced their entry into the passenger car radial tire space, and it's a space which is very, very competitive, and that's one of the key negatives as well. The other one I just want to mention is, of course, Ashok Leyland, and we did speak to Mr. Sheenu Agarwal, who's the MD and CEO of Ashok Leyland as well, to talk a little bit about the earnings, as well as a little bit more about what the outlook is for FY26. Let me go to Mr. Sheenu Agarwal now. Good afternoon, sir, and thanks so much for joining in. I just want to start off first with discounts, because we have seen no kind of discounts going in for the environment currently, and that's a key positive for you. But how is also the LCV market shaping up for Ashok Leyland going forward?
Listen, we have, I think, spoken about it very clearly that we are not going to indulge in any extraordinary discounting, right? So, because that we believe is not a good way to gain market share, right? Market share has to come basis the strength of the product and the efficiency of our service, right? And therefore, even in the short run, if we cannot increase market share, that is fine. As long as our roadmap of market share in the medium term is very, very clear. So as I said, the two most important things in gaining that strength that will convert into a better market share is a superior product where customer sees more value and is therefore willing to pay more for it. And the second is a very efficient service operation. Wherever, the truck demands or needs a service, we are there, and we can do this service turnaround much quicker than what we are doing right now. Therefore, directly adding more profit to the customer, right? So these are our two very simple, straightforward strategies. They sound more simple than they actually are, but there is a lot of effort that is going around both of these levers.
Mr. Agarwal, if you can just give us some view on the LCV market a little bit more, because you've seen what are your market share goals, if you can share that. We've seen new products being introduced in the 2 to 4 ton category. That's something where you operate in. Are you seeing expansion into even smaller LCV going forward? How do you see this market for LCVs?
Yes, on LCV side, our view is very, very clear. 3 points I will say. One is that you go anywhere in the world and look at any market, whether it is Europe or America or China or ASEAN or anything else. The LCV market is generally 3 times the size of the medium and heavy duty truck market. Now in India, the heavy duty, medium and heavy duty truck market is, let us say, roughly 400,000 units, and the LCV market is just about 600 and a few thousand units. units, right? So it's just 1.5 times. But overall, like I said, globally it is 3 times. Therefore, we think as India progresses, as India's economy becomes more mature and grows, this LCV demand will be really much better in the future. So that is one point, and therefore our focus on LCV and to expand our LCV business is definitely there. The second is that we are covering only 50% of the LCV market right now because we are only in the 2 to 4 ton segment. Now below 2 ton there is a pretty significant size of the market that is there, and even above 4 ton there is market opportunity. So our second lever is that we want to expand our product coverage of LCV from 50% to 80%. Now in this respect, in January of this year, we had launched a new product which is called Sathi, which is first time our entry into the mini truck market, right? So we are not positioning ourselves exactly as a sub 2 ton product, but we are in the first stage. We are targeting all those customers who are trying to migrate from a sub 2 ton product into the 2 to 4 ton product. So this is positioned slightly lower on the price ladder from those product, which is our key product in this segment. And in future also we will continue to expand our market share. You will see many number of LCV launches from us in the next 2 to 3 years, and many of these products are already in the pipeline. So that is the second point. And the third point is that in 2 to 4 ton segment where we have been present for last 10 years, we have been able to increase our market share to 20% now, which makes us number 2 player in the 2 to 4 ton segment. Now that gives us a lot of confidence that if we do a few more things or right things, we should be able to target 25% market share from the existing 20% or so in the 2 to 4 ton segment. So I think this is what our view on the LCV market is. This is what our intention is.
Mr. Agarwal, how is the electric bus market shaping up for you? Any kind of outlook on market share that you're looking at? Is electric the way to go for the last mile mobility year on as well, in terms of alternate fuels as well, for both large as well as medium CVs going forward? If you can just give us some color for all these alternate fuel strategies as well.
Yes, actually, all the electric bus and electric light commercial vehicles we do in our subsidiary called Switch. Now, Switch had 2 parts to it. One was that there was an entity in UK called Switch UK, which was in losses. We were actually making about 2 to 3 million pounds of cash loss every month in Switch UK. Now, one bold decision we took a few months back was to shut down the operations in UK, manufacturing operations in UK, and move those to a more cost-efficient location, right? So that is the first step. Now, what this will do is this will cut down our monthly losses of this 2 to 3 million pounds. I just want to clarify that this does not mean that we are exiting the UK or the European market, because we think that we can serve it much better actually if we have a lower cost-based production, right, which we are now doing, but we are not exiting the market. So that is the first part. Now the second part is Switch India, where we have this e-bus, electric bus business, and also the electric LCV business. Now India is doing really well, and this story is unfolding in even better ways than we were expecting. Now last year we said that Switch India, our first goal is to make Switch India EBITDA positive by end of year FY25. Now that we have already achieved. So Switch India, in fact, in Q4 has achieved a double-digit EBITDA margin, which is fantastic. Now that gives us a lot of confidence that Switch India, we can make it PAT positive in FY26. Now PAT positive is important because if Switch India becomes PAT positive, it will generate enough cash for it to sustain itself, which means that it can afford to do its own capex without requiring this additional equity infusions from Ashok Leyland. So I think Switch is now taking shape, in many ways. This electric bus is going to be a high growth business in India. We see every day announcements from the government or other people that they are really focused on electrifying the the bus fleets in India, and Switch is very, very aptly positioned. Now, on the LCV side, although the transition to electric will take some more time, it will be slower than the transition in the buses, but we are fully ready. We had already launched 2 products last year, which are doing very well, and we are going to launch another 2 or 3 products over next 2 years. So we are very well placed as far as electrification is concerned.
Mr. Agarwal, if you can also fill us in on your capex plans for FY26. The company is also has 4,000 crores of cash in the books now. So anything you can tell us about that as well?
So listen, since we have a very good cash position now, we feel very confident that we should be able to grow the company much faster in future by investing this cash in the right places. So one is the capex of Ashok Leyland itself. On an average, if you look at last few years, our capex used to be around 500 crores. But as we are improving on our cash position in FY25, our capex was close to 1,000 crores, which means we have doubled our capex in the year gone by. Now, moving forward, of course, with all sensibility of a business case, but we will continue to accelerate our investments in products and technology. So that is one. The other part is what I earlier said on the after sales service. We have these 1,000 touch points, and our ambition or aim is to get to a very different levels of service experience for our customers in these 1,000 touch points. So some capex may also go into that direction. And then if there are any investment requirements, although we are trying to make all subsidiaries self-sufficient in the next couple of years, but until they achieve that position, some of this money can also be invested in some of the high growth subsidiaries that we have.
Finally, Mr. Agarwal, what's the CV outlook for India going forward? Will you grow in tandem with the industry for FY26?
Our outlook is very, very positive. We do think that all the microeconomic factors are pointing in the right direction, whether it is the lowering of the interest rate, whether it is, uptick in the government capex, whether it is forecast of a good monsoon, whether it is the high age of the fleet, which has reached almost 9.5-10 years from a normal of 7 to 7.5 years. I think all of these are pointing in the right direction. We are also looking at some healthy growth in the core sectors, which directly affects the CV demand, such as steel, cement, etc. Right? Even mining and construction, we think, would be a good uptake this year. So we remain very positive about FY26. We think the growth could be in the mid-single digit right now, but we think there could be some surprises in store as well.
Well, Mr. Agarwal, thanks so much for joining in and wish you the best for FY26, and we look forward to our next conversation. But now let's move on to and welcome in Gaurang Shah as well, the Senior Vice President of Georgia Investments. Gaurang, thanks so much for patiently waiting by. Just wanted to start with your view on Ashok Leyland. It's getting at a point where they are anticipating growth in FY26. Do you have any view on the stock?
So we've been tracking this stock. First of all, thank you very much for having me on the show. Good afternoon to all of you all. We've been positive on the stock for a pretty long time. And the numbers for not only fourth quarter, but even for third quarter was something that went in line with what our estimates were. And more importantly, what we had penciled down in terms of fourth quarter earnings. The verbatim that you were just having with the management augurs extremely well with our thought process, and it only reinforces our confidence on the positive buy-side coverage on Ashok Leyland. So I think there's a lot of opportunity as the management was listing down, and I think that should turn into a larger opportunity.
Coming to you on JSW, still a big decision, in fact a positive decision that has come in from the Supreme Court side. They have ordered status quo on NCLT proceedings to liquidate Bhushan Power. Now we understand that Bhushan Power contributes around 12% to the consolidated EBITDA. More than that, they have contributed around 4,500 crore rupees in the capital expenditure so far post the acquisition. So how are you seeing this decision that has come in from Supreme Court for JSW Steel, and going forward, what are the possibilities that you have considered that could happen with JSW Steel, whether they'll have to give up Bhushan Power or not?
So status quo is not a resolution, right?
Right.
We need a final outcome in terms of a verdict. And we were in conversation even when the issue of the Honorable Supreme Court had put a stay on further developments as far as JSW Steel was concerned with respect to Bhushan Power and Steel. At that point of time, also, I had maintained that we have a positive coverage on JSW Steel. I beg your pardon. And we continue to maintain a positive coverage. I think a final resolution should throw a lot more light and clear off all the uncertainties that persist as of now.
Right. Well, sticking with the metals sector, the fall in alumina prices. Now, this is going to be this will have some impact on the aluminium producers in the first quarter of FY26. But what will be the impact? Well, for Vedanta, it could be a positive impact, while for Hindalco and Nalco, it could be on the negative side. Now, why this is happening now? Alumina prices, if you see, have fallen suddenly owing to the surplus in the market. From the peak of around $671 per ton that we had seen, it has come down to around $370 per ton. And analysts are expecting alumina prices to remain in the range of around $350 to $400 per ton. Now, alumina is a raw material for aluminium, and Vedanta is a net consumer of alumina, while Hindalco and Nalco are net suppliers of alumina. Now, Vedanta, if you look at low alumina prices, will lead to better EBITDA in the first quarter of FY26. And in fact, if you remember, the fourth quarter numbers were impacted owing to the higher prices. So this could reverse for Vedanta in the first quarter, given the fact that they are a net user or net buyer of alumina in the market. But when it comes to a player like Nalco, alumina realizations in the fourth quarter stood at around $600 per ton, and in the first quarter this could come down to less than $400 per ton. So a clear impact of around $200 per ton could be seen when it comes to Nalco. And if you look at Nalco's financial, is the chemical segment which represents the alumina business of Nalco, and they are also a net seller of alumina in the market, similar to what Hindalco does. In fact, in Hindalco, if you look at, they benefited from higher alumina prices in the second half of FY25, given the fact that they're a net seller of this product. But this could reverse in the first half of FY26 because we have seen a sharp drop. Now, in fact, if you look at the quantity wise, though aluminium product contribute more towards value, but quantity wise, alumina is the most selling product for Hindalco in the fourth quarter, and this could clearly reverse in the first quarter, given the fact that we have seen a sharp fall in the prices. Gaurang, coming to you on this sharp fall in alumina prices, any view how do we look at Vedanta, Hindalco or Nalco for that matter?
So near-term impact would definitely be felt, where the prices have dropped from $600 to about $330, and then I believe that impact will be there. But looking at long term, again, as a disclosure, we have coverage on Hindalco, Nalco and Vedanta, all three of them. I think this should stabilize as we go into the future.
Right, Gaurang, thank you for joining us and giving us your perspective about the markets and the stock that we discussed. Well, with that, it's a wrap on this edition of Top Trade. Stay tuned and keep watching NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah. Now, in terms of how we're doing fairly well in trade. We're flirting in around the 25,000 mark, at least on the Nifty 50 index. We're up around 0.5% thereabouts. The Nifty Bank not contributing significantly, as you can see on your screen. Let's quickly pull up the Nifty 50 in terms of the heat map and how that one's shaping up. Right at the very bottom is an eternal down 4.5%. Lots of pressure on the back of outflows anticipated all through this week. But what's doing well is the auto pack, the two-wheeler, four-wheelers, Bajaj Auto as well as M&M respectively. You're looking at JSW Steel on the back of numbers as well as a possible Bhushan Steel resolution coming to fruition in some format is keeping the street enthused with regard to that one as well. And then you have a bunch of other stocks which are doing fairly well in trade for themselves. So that's how it's really shaping up. Let's look at the sectoral heat map as well. And within sectors, I'd like to quickly carve out a couple of them. One is the Nifty Auto, not surprisingly, is up 1% in trade. The Nifty Defense, and I want to point this out from an intraday perspective as well. If we can quickly pull that one up from an intraday perspective, from the very bottom, it's gone up 1.3+%. So very strong traction that we've seen mostly midway through the day of trade, but now sustaining 1.3% higher on the Nifty Defense, which is the top sectoral gainer as well. IT is the other one which is doing fairly well for itself, 1% higher, and metals have done well pretty much through the day. Again, on the intraday chart, metals looking extremely resilient, 1% up as well. What's not doing well again is the financials, which are staying away from all the action in trade today. Pharma is the other basket, which is okay, slight positive bias, and then you have media, which is the only sector trading in the red, but not by much. So frankly, just a mild negative bias, if I can call it. But let's look at the advanced decline very quickly, and that's how it's shaped up. The advances still doing fairly well for themselves, or rather the breadth still positive, which is again positive, but Neeraj, the broader markets therefore also not really negative, which is in some form or shape looking good, right?
Yeah, I mean, and a lot of individual pockets doing well, despite the fact that the volatility index is a bit high in trade today. But 0.5% for the small caps yet again is welcome, despite the fact that the Nifty IT is the one which is actually leading the markets higher. We have the broader markets being active, which is, well, not too bad. A lot of individual pockets of strength. So pipe companies, for example, doing very well. You pull up an Astral, pull up a Supreme, maybe pull up an Apollo Pipes, and I think that entire bucket has done reasonably well for itself in the session today. Not too many losers on the Nifty 500. So top loser is Sarda Energy, which is down just about 0.5%. And beyond that, a few others, Balkrishna Industries and Heikel, of course, stand out. This is a BSE 500, of course. Balkrishna Industries and Heikel stand out. But on the gaining side, look at it. BEML, GVTND, Emcure Pharma, yet again, another 8%. GNFC, reacting to results. There is strength in Linde India, again, reacting to numbers, I presume. Though I don't think Linde numbers looked really terrific, but the stock is duly reacting. And then a Divi's Lab has a 3.5% uptick as well in the session today. So a lot of individual movers in the session. Nilesh Jain, Head AVP Tech and Derivative Research at Centrum, joins us right now on the show. Nilesh, how are you approaching trade this afternoon with this uptick that we're seeing? Let's start with the Nifty and the kind of move that it had on Friday. Do you believe there is more in store? Is it safe to trade this right now?
Very good afternoon, Neeraj. Good afternoon, everyone. So today, if you see the data on derivative front, since we are in the monthly FN expiry week, so data on the put side, 25,000 witness a fresh put writing, fresh addition today. The call writers are also active at 25,000 call strike. So it's a kind of a tug of war kind of situation at 25,000 strike. So it is important for the Nifty to take out 25,000 level decisively for further momentum to continue on the back of short covering towards 25,200 to 25,300. The chances and the probability is very high that Nifty will break 25,000 hurdle and move towards 25,200 in this week itself. So structure wise, yes, the setup looks positive. Back to back second consecutive days of gain, and Nifty has already reclaimed and surpassed is all key moving averages as well. Although we have a cause of a worry because of the IV, which is witnessing a spurt today of 5%, and it has moved beyond 18 levels, so it needs to cool down below 17 for further momentum to continue and bulls to regain the control. But as of now, the setup looks positive. Broader markets are looking positive. So stock specific action should be in focus. So we are recommending two buys. So first of all, within auto space is looking positive. So within auto space, Bajaj Auto is something that we are liking. This particular counter has outperformed and witnessing a high top and bottom formation on daily time frame chart as well. On derivative front as well, we have seen a good build up on the long side. So Bajaj Auto looks positive for 9150 kind of target on the upside with a stop loss below 8810. It's a buy. Apart from that, L&T is another stock where we have seen a good breakout coming in with a big consolidation of almost previous 5 months now. So good setup in L&T looks positive for a follow-up move to continue towards 3750 target. Stop loss can be placed at 3605.
Okay. Some of the pipe companies are fairly active in relation trade today. Astral is up 3.5 now. Supreme up couple of percentage points. Is there a trade here?
Right. So Astral Pipe, this particular counter is looking very attractive. We have seen a lot of underperformance in this particular counter, but it has formed a good base formation in the zone of 1250, 1260. So looks positive for a follow-up move to continue towards 1550 to 1600 with a stop loss below 1440. Astral Pipe can be bought at current level and on declines as well. But as you have rightly pointed out, across all pipe stocks, we are witnessing a spurt. Even if you see Venus Pipe, this particular stock has given a good breakout from a falling trend line. So a follow-up move can be seen towards 1550 to 1600 here as well with a stop loss below 1420. Venus Pipe is also looking positive on the chart.
What do you make, Nilesh, of an Eternal? What do you make of a Divi's, both in different directions, but quickly give us views?
So Eternal, this particular stock, in fact, has faced resistance at 240, 245 levels, and historically we have seen this particular level of 245 has acted as a very strong resistance zone, and from the same we have witnessed some profit taking. Looks more sort of a consolidation now. I don't see any major further crack from here. There could be a possibility of some support coming in near about 220 to 225 zone. So it's an avoid, although as of now better to wait for a reversal candle before buy, but it's an avoid at present level. But Divi's Lab, yes, it's a buy on decline. This particular counter is looking very strong on the chart. We have seen a good breakout coming in from the levels of 6400 recently, so buy, but wait for some dip towards 6600 to 6500 with the stop loss below 6300. It can be bought for a positional target of 7000 plus.
And what do you make of some of the defense names? Something like a Data Patterns, a Solar Industries, both worked up 3.5 to around 5% in trade. What's the sense like on some of these names?
Right, so Data Pattern, this particular stock, in fact, is looking positive, showing some bit of traction with a good volume participation as well. So this particular counter is looking positive for a follow-up to continue towards 3,100 to 3,300. At present, the risk and reward is also favorable because the support is placed at somewhere around 2,700. So from a little positional perspective, this particular counter can be bought.
And what about some of the steel counters? JSW, Tata Steel, is there a view coming in there?
So JSW Steel, in fact, overall metal space as a whole has given a good breakout today. In fact, the recent momentum is also looking strong. So within this space, the outlook looks positive. Counters like Steel Authority, JSW Steel continues to remain our preferred bet within the metal space. So specifically from the steel space, JSW Steel, this counter looks strong for 1050, 1070 kind of target. With a stop loss below 1005, this particular counter can be bought. And within aluminum space, Hindalco is something that is showing strength and looks positive for further upward towards 680 to 685. With a stop loss below 645, Hindalco is also a buy.
Okay, let's stay on an interesting conversation around SIFs. And for a lot of you who are trying to understand what is this, remember the product category got a nod from SEBI about maybe 3 months ago, or maybe slightly longer than that. And we were waiting for the first of the products to come on stream. And I think we've found that because Edelweiss AMC has decided to launch, or at least has got the SEBI nod to launch SIFs with a new platform, which they're calling it Altiva, if I'm not wrong. So what kind of investors would fit into the SIFs category as a product category, whether you should invest into it or no, the benefits and the negatives, if you will. Get in two people to speak about this. Firstly, Radhika Gupta, MD and CEO of Edelweiss MF, who is launching that. And of course, parallel to give us that advice is also Kshitij Mahajan of Complete Circle. Both of you, thank you so much for taking the time out. Radhika, now we spoke about this product category when it first got unveiled about 4 months, 5 months ago. I don't remember the exact time, but then, and we were thinking as to when do investors get a chance to now start putting money into it if they deem fit. You are first off the pedal. Tell us a bit about this.
No, we're very excited about the brand approval for Altiva. And of course, it is the brand approval. After that, there's a process of product approval, but we're hoping over the next couple of months. And I think SEBI's been very supportive and kind in terms of creating the infrastructure and speedy approvals. But we're hoping within the next couple of months, at least from us, you should see a SIF in one of the categories out soon. So I think that's the timeline that investors have. Since the Altiva announcement, we've sort of been flooded both from the distribution community and the investor community on when is this coming out, when can I invest? And I've told people product approval hopefully coming soon. As you know, Neeraj, they've defined 7 categories under which you can apply for SIF licenses, equity, hybrid and fixed income, and then there are subcategories within each. So we intend to file in one of the categories and hope to get our approval.
Can you tell us a bit about this, Radhika? Because no, I mean, I should have done my homework, but I don't know. So what are these categories? Why are you choosing this particular category? And what kind of investors should approach, for example, the category where you are investing, where you are launching versus some of the others available?
So let me simplify this in a way that mutual fund investors understand, because
Sure.
everyone understands mutual fund. SIF is just a mutual fund scheme with a little more flexibility than traditional mutual fund schemes allow. Flexibility primarily in terms of use of derivatives and in terms of alteration of subscription and redemption. So, how frequently you can subscribe, how frequently you can redeem. These are the two broad and some concentration limits. So, a SIF is a mutual fund with specific flexibility, and in return for that specific flexibility, the regulator says, well, take money at a 10 lakh minimum. All other mutual fund regulations actually apply to SIF. People sometimes think SIF is a different platform like AIF or PMS. Actually, it's part of the same trust infrastructure that a mutual fund is part of. It also has the same taxation treatment that a mutual fund is part of. So that is actually very, very important. Now, mutual funds have three categories: equity, debt, hybrid. SIF also has equity, debt, hybrid. Within equity, there's an all cap kind of construct. There's a sector rotation kind of construct. There's a X top 100 kind of construct, which is your mutual fund mid and small cap. In each of that, there are categories and mandates. The only difference is in a mid and small cap fund on the mutual fund side, I can't do a naked short. In a SIF, which is an X top 100 SIF, I can do mid and small caps, but I can also go short. Similarly, in the hybrid category, there's an asset allocator, there's a long short, and then there are two fixed income options. Our likely filing is going to be in the hybrid category. And the rationale for that is we believe that there are a lot of risk-taking solutions out there. It's not that we won't participate there, but between AIF and PMS and equity and mid-cap and small-cap, lots of that is out there. There is a need for more tax-efficient, absolute return, fixed income plus kind of solutions, particularly in the kind of times we are in. So that's the customer need that we are looking to solve.
Point taken, Radhika. This is Harsh also joining in. Kshitiz, let me come to you and thereafter take a question with Radhika as well. Kshitiz, I want to first understand from you who exactly, firstly, what's the kind of interest you're seeing? And second, who exactly are you promoting this to in terms of customers, investors, etc.?
Well, hi Harsh, hi Radhika. So, complete. We run a portfolio management service also, and we run a wealth management service also.
Yes.
Now, there are many clients who approach us wherein they want to have, and one can make out that with the unique number of demat account holders in countries around 12.5 crore and mutual fund folios around 5.25 crore. Mutual fund is the most simplest way and most easiest way to invest in equity markets. But yes, people are looking at, because of this recent rally in the markets, the new generation coming in the market and looking at a plus returns, and everybody's eyeing what else they can look at as an investment opportunity. So my view is that many people, they come up to us, but they don't have that 50 lakh as a total sum to participate in equity, and they want a professional managers to manage it. And there are many people who will now look at this category where there's a professional management, where there is no capping off in terms of they have to look at 50 lakh, you can do 10 lakh, and 10 lakh also per pan you can do into multiple scheme as per the given fund house different offerings. So I think there are a lot of youngsters who are looking at this scheme. There are a lot of people who want to take risk, but with less amount, they are looking at this side of investment platform. So you will see a common interest which is coming up from many people, and we can actually see from the way there's a lot of interest which people are showing in unlisted market also. So things will happen now where you have all type of categories which will come up. Radhika was talking about the hybrid category on what they are coming out with. But yes, there will be interest on direct equity, category, focused 8-10 stock category. Many other things will also come. So where you have F&O also, where you have some participant play through hedge strategies also, long short funds also. Normally a long short fund which you have to do is through 1 CR ticket through IF route. But here you can do through 10 lakh rupees also. So there are interests which are with the people, but they don't have maybe that much capital. Maybe they don't want to allow, or they want to participate with that much capital. So I think a lot of interest will come through this.
Radhika, the minimum investment is currently capped at 10 lakhs. Give us some perspective as to why that is so. If it's largely similar to a mutual fund, then why cap this at 10 lakhs?
So I'll make a couple of points on this. One is that, yes, it is similar to a mutual fund, but I think there are two things that are different. One, the use of derivatives is not for hedging. Now, I could, in mutual fund world, I could long stock A and I would have to short stock A in the same quantum. Here I can short stock B. Derivatives come with their own sense of understanding and nuance. And I think that requires a savvier investor. For instance, when you go short a stock and you are wrong on that call, actually the size of your short position increases. When you go long on a stock and you're wrong on that call, the size of the long position comes down. So derivatives have their own complexity that I think it's important for people to understand. SIF is also a lot more open in terms of what you can do in terms of credit exposures. Not all funds, unlike mutual fund, have daily liquidity. So the equity category will have daily liquidity, but the hybrid one and fixed income one will not have daily liquidity. So it's important, and mutual fund has acquired a very clear branding that my money is there when I need it in 2 days. This is simple, as I say, dal chawal stuff. So I think it's important that we segregate the category. But that's why, by the way, SIF also requires a separate brand name. You can't launch SIF as Edelweiss MF SIF. I'm launching SIF as Altiva SIF. So I think the regulator has been very clear that this is like mutual fund, but it's a different cousin. So different audience, different brand name, so that you're very, very clear. I would say that compared to, since Kshitij mentioned AIF and PMS, 10 lakhs, that too at the AMC level, really opens up your customer set. When you're talking AIF, which is 1 crore, you're talking about a consumer who has a liquid net worth of 10 crores because he or she's not going to put more than 10% in a single AIF. When you're talking SIF, you're talking about a consumer who probably has a liquid net worth of 1.5 crore. The difference between 1 and 10 in terms of consumer set is very, very wide.
Fair point. Kshitij, Neeraj here, just one final question here. And for people who want to become, let's say, have the risk ability of investing in a PMS, I mean, okay, would you say that instead of a mutual fund investor who is investing in a long only product, this might be more suited to, let's say, a person who's got the risk appetite or a affinity, forget a risk appetite, I'm guessing PMS also are pretty cool now, but the affinity of investing in a PMS, which is a slightly more niche product than a mutual fund, but does not have the ticket size of 50 lakhs or an AIF's ticket size of 1 crore, and does this become a product for her or him?
Neeraj, yes, I 100% echo that. Many people are looking at doing something more than mutual fund. Looks like they think that mutual fund is a very simple product, but I think last 6-8 months have been a great lesson for most of the people around. I think it's not even MF is also not an OTC product, but yes, people with risk appetite are looking at participating into a different set of products, which is little more complex and little more alpha generating. That's what they feel, and that's how the SIF category will gain from it. So many youngsters I'm talking to, and they are looking at that. Let's say if you don't have time to manage our own portfolio, and they want to have some strategies where they, as I mentioned earlier, they want to have a long short exposure, or they want to have a strategy where they want to have focused exposure. So, but they don't have that type of money to put in AIF or PMS. So, what should we do? So, I think this category will solve that purpose for many of the people. But people who are watching us, I must say that you have to go back and review your risk appetite, because in good markets, risk appetite becomes very high. But in bad markets, it's come back to where you actually belong to. So I'm saying that you have to adjust your expectation from this category because it's starting in, and let's say how things will work out, how things will shape up, and that's how the category size, the minimum ticket size is kept low. And you can further divide this category on PAN level between various offering of AMCs.
Very interesting. Look forward to how this evolves and how this develops and how various manufacturers look at this, as well as, of course, those which are more client-facing like Kshitij, and how they kind of pitch this to the investor community. Thank you so much, both of you, for coming in and helping us break this down. But that's one option, of course, for you. for those looking at a 10 lakh plus ticket size. Okay, Nilesh still with us. Let's quickly switch focus. Nilesh, what should one make of the Nifty Bank at this point? It's a muted move today. Do you believe that some bit of outperformance getting built in? Is that something that you would consider at this point?
See, Harsh, today, although we are witnessing some bit of underperformance in the Bank Nifty compared to the Nifty index, but overall setup is hinting that Bank Nifty is poised for another rally, and we may see a new record high coming in the Bank Nifty very soon. So overall setup looks positive. After this pause, maybe in next 1 or 2 days, we may see a breakout coming in above 56,000 mark, and Bank Nifty is inching towards 56,500 to 56,800 from a very short term perspective. So it's a good opportunity. If at all we see any further dip towards 55,300 to 55,100, use that particular dip to accumulate, to build a long position. Keep a stop loss below 54,650, and on the upside, as mentioned, we are expecting a new record high towards 56,500 from a short term perspective.
Right. Nilesh, anything within pharma that catches your eye?
So we discussed about Divi's Lab, which is trading at all-time high. So structure-wise, there is still some more room left in this particular stock, and 7,000 plus kind of levels we may see in this particular stock with a stop loss below 6,400. Any dip from here can be used as a buying opportunity. So Divi's is something that is we are liking.
What about real estate stocks, Godrej Property, Macrotech?
Right. So, in fact, the realty space is also looking strong. Few selective names that we are liking. So, first of all, Lodha. This particular stock is looking attractive. We have seen a good momentum recently, and we have also seen a kind of a golden crossover coming in where the 50 DMA has crossed 200 DMA on the upside. So, this particular stock look positive for 1500 plus kind of level from a short-term perspective. Stop loss can be placed below 1400. And another stock, that is DLF, which is also looking positive. This particular counter has passed its 200-day long-term moving average. So further momentum can be seen in this particular stock towards 110 to 130, and the stop loss can be placed at 760.
Okay, thank you so much, Nilesh, for all of the views. We'll let you go on that note. And what we're going to do is slip into a very short break. But before that, listen in to views coming in from Aditya Suresh. He's talking about how earnings are not your friends at this juncture. That's what he's saying. Managing Director and Head of Equity Research at Macquarie Capital. Listening.
Earnings, we still believe at today's juncture is not your friend, right? So expectations are full. We still see cuts to earnings, whether it be fiscal 26, fiscal 27, which is still to be absorbed in the market, right? So that's kind of one dimension. Even just calling out this quarter, when you think about kind of whether it be net profit growth, X of say something like a Bharti Airtel, you're hardly looking at any net profit growth for all the companies which have reported. But we're still sitting at, as a market, let's say 12-13% kind of growth in earnings, right? So there is still that uplift in and inflection earnings, which us as a broking and a community is calling for, but that's not really been the trend.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Welcome back. Thanks for staying with us on India Market Close. Now, that time of the show where we take it across to Somit, who brings in all the chatter coming from dealing rooms this afternoon. Somit, what are you hearing?
Well, multiple stocks. Firstly, it's ITC, which remains in focus. Dealers are indicating that there is a potential buzz of a block deal that could happen in the company very soon. British American Tobacco, which is also known as BAT, owns close to 25.4% stake in the company. Might look to offload some of its stake. They have appointed bankers. The stake value could be could well as be around 10,000 odd crore rupees for coming in from BAT in ITC. Second stock on the list is IRFC. There's a strong buying interest is what dealers are indicating from a DI desk for IRFC, for Axis Bank and Adani Enterprises. Strong buy flows on FI desk is what dealers are indicating for both these counters. And when it comes to Bajaj Healthcare and EPAC Durables, dealers are indicating that smart investors have started to accumulate both these counters on expectations of strong Q4 numbers. In fact, Bajaj Healthcare will be reporting its numbers today and EPAC Durable will be reporting its numbers on May 27th, that is tomorrow. Apart from that, it's the pipe manufacturing companies Astral, Supreme Industries and Phenolix Industries, which are also buzzing in trade. Another buzz is on the street that PVC prices have been hiked by around 1.5 rupees per kg, but this is more important given the fact that this is the first hike that we are seeing in the last 5 months where prices were continuously on a declining trend, and this increase in price might benefit pipe makers in terms of inventory gains and margin benefits as well.
Interesting. So Sumit, I believe Reliance is one of the principal players when it comes to this PVC pricing.
Right.
So they're
the price maker.
Price makers. So has there been one price hike and is there promise for more? Any insights since you track Reliance so closely?
Well, yes, there has been a price hike right now. Dealers are indicating that prices could move much more going forward, given the fact that even in fact the management was saying that the government is working on some anti-dumping duty that could come in for PVC. So these factors coupled with increased demand could lead to much more price hikes as well going forward. Also, we have recently seen an uptick in crude prices as well. So that could also play in as one of the factors for increasing PVC price. But yes, this is the first price hike that has come in the last 5 months.
Yeah, this is interesting. And by the way, viewers, in fact, just before we thank Sumit, hear out Hiranand Savlani of Astral, who spoke to us to understand about he kind of mentioned about these prices for PVC and polyester and the impact on volumes.
When this BIS standard will be implemented, there are high probability that a lot of unorganized player will suffer, and that volume will shift to the organized player. Secondly, the many PVC player from China, which is dumping the material in India, that will also stop sizably because they will not be qualifying for the BIS, so they will not be able to export the products to India. So that will lead to the polymer price rise. So that is going to help to the industry. Secondly, government industry players of PVC, they already initiated the anti-dumping duty. So that can also come in the near future. It is very difficult to quantify the timeline, but definitely this year we are expecting that is also going to be there. If that will also happen, then the low cost polymer which is dumped in India by China, that will stop. And that also going to give the rise to the polymer price. So if any of the things will happen in the coming time, then the dealer and distributor will rush to the restocking, and that itself is going to give the good volume to the industry. And that is what we are expecting in the current year. And the natural volume growth of the 7-8% of the industry will be there. So then double-digit growth will not be a big challenge if any of the things will happen.
So viewers, this is important. Also remember why, and thanks Somit for pointing this out, but this is important because if PVC prices start moving up, then dealers which were destocking, because if prices are going down, they lose the pricing. So dealers which are destocking might start restocking, and that might drive volumes for companies like Astral, Supreme, etc. And hence the PVC pricing is very important from a pipes company perspective. No surprise there that Astral is up 3%, Supreme is up 2%, Phenolics is up about 7%, so pretty strong going for the pipe companies. But some news flow, Harsh, on IndusInd Bank as well.
Yeah, the executive vice chairman of the microfinance arm of IndusInd Bank has resigned, is what sources are telling us. What they're saying is that he has resigned effective immediately, and this is of course Neeraj, not surprising given the fact that first we've seen the deputy CEO resign, we've seen the CEO resign of IndusInd Bank, and essentially there would have been pressure given the fact that there were certain accounting irregularities even in the microfinance portfolio, where interest income was classified as other income and the like, or other income was classified as interest income and the like, and all of those. And hence it's not a surprise that there's already a cleanup which is started. Just not sure for how long this is going to go on for. Stock, of course, not reacting, at least at the moment. We're in around that 800 number, which it has been at pretty much through the day. But nonetheless, this is something that we must mark, that two other officials as well handling loans have seen an exit. Also, exits follow findings that there were large accounting discrepancies in the microfinance portfolio. Let's actually bring in Subhana for giving us the complete understanding of what she's been hearing. Subhana.
Yeah, hi. So sources have told my colleague Vicky that J. Sridharan, who is the Executive Vice Chairman of Bharat Financial Inclusion, has resigned with immediate effect. Now, J. Sridharan is the Executive Vice Chairman of Bharat Financial Inclusion, which is a subsidiary of IndusInd Bank. It's a microfinance subsidiary of the bank. Now, what sources have also told Vishy is that two other officials handling loan data have also been asked to leave, and exits have been following. These exits have come as there have been large accounting gaps in microfinance business of the bank. Now, in the Q4 results, also we saw that the bank the bank announced that there was 170 crore worth of loans. That there was an accounting gap in that. In addition to the 674 crore loans, that there was an accounting gap over there. Now, this has come on top of the fact that there were a lot of accounting errors within the bank that we saw which the board last week said that that they suspect that this could be a fraud. Now, in total, this leads to over 3,000 crore worth of accounting irregularities that the bank has submitted. So this is a new development that has come to light, and the board has also said that they have submitted applications for a new CEO. They will submit applications for the new CEO by 30th June. So this is a developing story. We're yet to hear more on that.
Okay, Subhana, thanks so much for this, and interesting. No big reactions on IndusInd right now, but clearly one more high-level exit from a key business area. Okay, now before we get in our technical experts on board, I think it's also important to highlight one more piece of news and one more stock that is, well, technically at the start was in the eye of a storm, and per se because all the other stocks were doing well, but Eternal wasn't, and it still isn't. So some estimates or some calculation by Somit suggests a number of close to $850 million of outflow this week, Somit.
Well, yes, Eternal will be in focus given the fact that both MSCI and FTSE have cut their weightage on the stock. Now, because of this cut in weightage, there could be outflows of close to $840 million this week, and this cut in weightage is because the company had earlier announced that they're looking to reduce their FPI limit to around 49.5% from 100% earlier. However, this cut, now this was pretty much expected by the street, but the announcement that has come in on Friday post-market, it's quite different than what the earlier announcements were. Now, why is it different? For FTSE, if you look at their usual headroom related reduction happens in a phased manner, but this will happen in just one shot, which means that in one shot their weightage will come down, and in one shot we'll see all the outflows coming in for Zomato. And for MSCI, there was no changes announced last week when they had announced this index reject, so the street never expected any announcement to come in at least till the next review, which was in August 2025. But out of turn, MSCI has come out with this announcement where they have also reduced the weightage of Zomato, and this is what has surprised the street, and that's the reason why we are seeing this kind of a downtick in the share prices. Now, if you look at the outflow amount for FTSE, the outflows are expected to be around $380 million, which will happen on May 27th, and for MSCI, the outflow is expected to be as much as $460 million, which will happen on May 30th, 2025. Also on Friday, the stock had gained 5% because the street was not expecting any immediate action of this changes in weightage to happen, and that's the reason the stock had perked up, and then this sudden reaction has come in, and that's the reason the stock is down 5%. But do remember, this is just a technical factor. Fundamentally, nothing's so far wrong when it comes to Eternal, which was earlier known as Zomato.
Interesting. Okay, so that's with regard to Eternal. Of course, that's our stock of the day, 4.5% lower in trade as we speak. Let's quickly go across to Himen. In fact, Himen Kapadia, DR Choksi Finserv joining us, and we also have Siddharth Khemka, Head of Research at MOFSL, also joining us. Welcome both of you gentlemen. Good afternoon. I want to quickly first take it to you, Himen. I mean, what's the take like? Let me first start off with the index, the Nifty and the Bank Nifty. Give us your views on that one, and then a quick maybe 30-second view on Eternal as well.
Okay, a very good afternoon to you, Harsh. Thank you for having me on the show. It's always a pleasure. The Nifty is tired. We've had a 3,350 point move. The correction needs to be deeper in terms of time and price both. That's not happening. So how would we analyze this? Either the undercurrent is too strong, or there's a consolidation phase happening between 24,500 and 25,100. So a breakout on either side, we'll see something happening. So it's in a no trade zone. I'd say neutral, but after such a move, if we'd seen some of the gaps being filled, maybe come to 24,100, that would have given more conviction on the next round of the move. Bank Nifty stronger, better looking than Nifty. And as far as Eternal is concerned, it tried to overcome the 240, 242 level, didn't. So it gave a breakout flop. So 220 support, that breaks for the downside.
Siddharth, quickly, do you have a view with regard to an Eternal?
Yeah, hi, good afternoon. So I think, yes, if you look at what you said clearly, some of the current fall is due to the technical factors where the street was already expecting the cap in the shareholding, and that led to this news of the expected outflows. What we believe is that the recent underperformance by Blinkit, by Eternal, is largely due to the operational performance, and we have seen that post the fundraise by all the three quick commerce companies, Zomato, Swiggy, and as well as Zepto in the unlisted space. The competition has heated up. There is a lot of discounts and cashbacks that have been given by some of the competition, leading to pressure. And on its part, Zomato has, you can say, preponed or has fast-tracked some of the dark stores, operational, so the new dark stores, and that is leading to the pressure that should continue in the near term. We see that any new dark store, they take at least 4 to 6 months to become break even. And if you have bunched up of a lot of new dark stores, they would put a lot of margin pressure. So having said that, view clearly on Eternal is that near term, for the next 1 or 2 more quarters, we could see continuous pressure in terms of earnings. But the long-term story, we are very positive on. We believe that quick commerce offers a very strong growth or a high growth opportunity in the Indian market, where there is a structural shift in how people are buying the staples, as well as a lot of other commodities, other goods that would be available within the 10-minute delivery module. So within the 3 players, Zomato is the best suited with the food delivery business, very stable, generating cash, and with the market leadership that it has. So we have a positive view on Zomato. We have a buy rating and a target price of 260. Swiggy, we do have coverage, but we see that the operational business and losses could continue for some more time, at least until next year, and hence we have a neutral rating there.
Okay, so that's the view coming in with regard to Zomato and Swiggy from a fundamental perspective. Himen, your picks for this afternoon, let's get that out of the way.
Yeah, I have 2 buy calls, Harsh. Firstly, a buy call on Hindustan Zinc. I like metals for the next or maybe even the rest of this calendar year. Hindustan Zinc is moving in a symmetrical triangle on the weekly chart on the cusp of a breakout. A buy at 450, stop loss 425, target 500. It's made a base. All the mechanical indicators on the daily and weekly charts have given a crossover buy. Like I said, in the cusp of a breakout. Second one is LTTS, Harsh. It's a recovery, not a rally, but we are playing for a bounce. Deep correction, 6,000 to 4,000. Same logic applies here for the 55-day exponential moving average. Oscillators buy, turnaround on the anvil. Even the weekly charts are shaping up better. So buy LTTS at 4510, stop loss 4410, target of 4710.
Okay, so those are our picks coming through. Let's shift focus though to 3 stocks in particular that are in focus on the back of Q4 earnings today. Puneet joins us with the details. There's Balkrishna Industries. Puneet, you've picked Finolex Industries and Afcons Infra. Talk to us about those numbers and stocks obviously buzzing.
Well, definitely, I mean, 3 interesting picks as well, because we've seen Balkrishna, of course, report earnings that were a miss, 25% down in terms of net profit. But I think the larger news flow that's impacting the stock today is the company's decision to enter the passenger car radial as well as the truck and bus radial space, which is essentially tires for the 4-wheelers as well as the truck and bus segment. Now, why this is a negative is because it's a very hyper competitive space that's been backed by players which have been in the industry for the last 3 decades, players like MRF, Apollo Tyres as well as SEAT, and competing against them with nothing as of now that we know of in terms of premium niche categories that the company might enter in is something that's impacting the stock. It's also one of the most expensive stocks in the tire space because of the company's margin profile of over 25% versus peers which are below 15% margins. Now the company is actually entering a space where the margins are like peers between 12 and 13%, and hence this move is slightly puzzling for the company at this point of time because they are expanding the geographies but also entering a new space with no defined strategy in terms of capex or in terms of news flow of where the company might enter has hampered the stock today. We've seen a clutch of brokerages also cut target prices, as well as we've seen Novama actually downgrade the stock to a hold from a buy earlier, and they have a target price of 2,700 rupees. But largely that's for the first one, Balkrishna Tyres. The second stock is Finolex Industries, and again an interesting one because despite reporting 200 basis points of reduction in EBITDA margins for Finolex, the stock is almost up 8%, and that's largely because the results weren't as bad as expected, because the other pipe makers have already come out. We saw with the positive reaction on Astral as well, where the PVC prices have now largely stabilized. This was the first such quarter where they had stabilized, and hence margins of 14% for the company are actually pretty positive. The other aspect is for the pipe segment specifically, the margins actually grew by 21 basis points, and hence the positive reaction. And finally, again, as you rightly mentioned on Afcons as well, we've seen a disappointing set of numbers for across the construction space and the road space, and Afcons is another one which is impacted because of that. Revenue fell 11%, and that subsequently dragged the EBITDA as well as the profitability. The key aspect is also the other expenses that were higher in this particular quarter. The cost of construction has now gone up to 40% of sales versus 37 on a YOY basis, and hence that's the impact. But largely, company has a very big order book of 36,000 crores, and that could be something to watch out for in terms of order inflow as well as execution. But these are the three stocks buzzing on the back of news flow and earnings as well.
Thanks for that, Puneet. Siddharth, coming straight to you with regard to at least one of these. With regard to Afcons, Puneet seemed to indicate that there's some bit of headwind with regard to road construction companies. Why do you feel that is so, and do you feel that this near-term pressure could unwind fairly quickly as well?
So yeah, Harsh, if you look at last almost a year now, the government capex has been on a slower growth path, and even last financial year, the order booking from NHAI only bunched up towards the end of the year. So there is definitely a lot of you can say especially from the government capex, like slowdown affecting the capex or the infrastructure companies. And in the near term, we have not seen any uptick. It could happen as we progress into the quarter. Some of the positives from a government perspective has been that GST collections has been pretty strong. Now we have also got the RBI's dividend to the government. So I think gradually the purse strings should open up, and the normal capex that the government has planned in the budget that should pick up.
Okay. What else? Today, for example, Siddharth and Hemen, good having both of you. Today we were talking about Friday we were talking about the insurance sector. Today we're talking about the pipe sector. So two sectors on which we thought we wanted your views on. So Siddharth, to you first. PVC prices moving up, that's led to a spurt in some of the pipe companies. Have you guys heard something to this effect? Are you constructive here in the bucket, and if so, which stocks?
So hi Neeraj, unfortunately we're not covering this space that well, so don't have much view there.
Got it. Hemen, 3% up for Astral, couple of percentage points up for Supreme. Any thoughts on a trade possibility into any of these or some others? I mean, it could be Finolex, it could be Apollo Pipes, what have you.
Oh, I think Neeraj, Supreme and Astral that you mentioned, very deep correction. On pure technicals, Astral becomes half, 2450 to 1250. I wouldn't say a dead cat bounce, that is the wrong way to put it, but it's very clearly a strong recovery after a protracted decline. So chasing Astral, if it has gone from 1240 to 1500 plus in 4 weeks, I'd say wait for a cool off. That does not mean that we're going to not go to 1650. I think that's where we are going. Similar with Supreme Industries, Neeraj. Supreme Industries also virtually fell off a cliff. 6400 to sub 3200 became half, and now we are bouncing back. Almost a similar move. I think further upside seems like a very distinct possibility. I would once again wait for a small cool off. Wouldn't like to chase it. Finolex cables is not a pipe thing, but that is looking different. And Finolex industry that you mentioned, Neeraj, is also looking promising, but same story. 155 to 213 for 5 weeks. No, all of these are looking good. They all have headroom, but I'd wait for a small cool off, if any, to go long.
Got it. The other set of companies, just very quickly, is insurance. Big spurt in Friday's session. Siddharth, a lot of conversation around how things are changing at the margin, at IRDAI level, maybe at premium levels, etc. New highs for HDFC Life. Some of the others have moved higher too. Do you guys like anything in this bucket?
Yeah, I think this has been one of the space where last few years, especially post the pandemic, some of the companies were consolidating, things were not, companies were unable to find their feet, and then there were a lot of regulatory changes and hurdles and stuff like that. But I think finally they have been able to manage to find the feet. And if you see in terms of growth, that is something again picking up, especially something like the top leaders we like, HDFC Life as well as SBI Life. HDFC Life has a well-balanced product portfolio. We see that the persistency ratio have shown consistent improvement across segments. The company has also revised its commission structure to limit the impact of regulatory changes on VNB margins by introducing a clawback provision and also deferring or reducing the commission. So overall, companies are now able to digest whatever regulatory changes are there and now back to the core business. Even if you see the Q4 numbers for HDFC Life, the margins were stable. The management has indicated a slight improvement over the next few quarters with a stable product mix. And what we are expecting a 19-20% VNB CAGR over the next 2 years, with the margins tend to improve marginally. Stock has definitely moved up in the recent past closer to our target price. So for HDFC Life, we have a target of 850 in fact. So around you can say 5-6% more upside left. Stock has sharply outperformed in the near term. The other is SBI Life Insurance, where we have a 2,000 rupees of target.
Okay, so those are your life insurance counters in focus. Let's though go across to another one which we haven't spoken about much but is doing extremely well in trade. There's a BEML. Numbers came out on Friday. We've seen a surge, 13% up in trade today on the back of very strong earnings but guidance. That's what's really standing out. Hiral here with the details. Hiral.
Thank you. So second consecutive session of gains that is coming in with regards to where BEML goes. Now, a couple of points. Strong earnings wherein the Q4 performance was strong, but apart from that, they've actually hit a record number in terms of their annual profits for FY25 of around 294 crores, which is up around 4%. In terms of operational efficiency as well, they've achieved a strong growth there, where the margins have improved to 13.2% from a 11.98% in the previous year. Lastly, if you see in terms of the order book as well, their current order book stands at around 14,610 crores, wherein they've said their FY26 executionable order book is going to be around 4,233 crores. So that's a strong one coming in there. They're looking at expansion as well, where they've secured land in Madhya Pradesh and Chhattisgarh, where they will be setting up manufacturing facilities, and these will be for rail and metro and mining and construction and equipment. As Harsh mentioned, FY26 guidance as well, an order book of around 22,000 crores is what they are looking at in terms of FY26, and this is something that they've mentioned in their previous conference calls as well. And the analysts are expecting the rail and metro segment to gain momentum in FY26, wherein they are betting big on Mumbai Metro and the Bhubaneswar Metro. So a combination of strong earnings, strong guidance, and the sectoral tailwinds that the company is sitting on is what is working for a BEML currently.
Well, whatever is working, Hiral seems to be really working, but thank you for that. Himen, let me come to you with regard to a quick technical view on this one before I take Siddharth's more comprehensive fundamental view.
Sorry, could you just please repeat the stock?
BEML, Himen.
Well, after such a grandiose move today, no rocket science, we are in a short and medium term uptrend. Same story, 5,400 to 2,400 Harsh. Very deep correction. It took months and now we are back. I think most of the majority of the PSUs, railway, defense, banks, not banks, but all of them have corrected deep. Further upside, very distinct possibility. We walk into a virtual roadblock at 4,523. And in this current move in 3 weeks, it moved from sub 3,000 to 4,200 plus. So everything is hunky-dory, and the way I see it, even the longer term charts are getting back on track. So looks great. Once again, on declines makes more sense.
Okay, and Siddharth, if I can quickly come to you with regard to this one as well. Do you have a view with a BEML? Is this 13% kind of move justified in your opinion?
So Harsh, another stock where we don't have house coverage or any view on BEML.
Okay, you also have Gillette's numbers actually flashing at the bottom of your screen. 9.5% move on the stock price. Let's quickly pull up Gillette. Not sure how much of that move. There you go. It's largely an immediate move and a results reaction. 60% higher profitability that Gillette has clocked. This quarter, it's not been a Colgate that's delivered, but it seems like a Gillette clearly has. Revenue up roughly 13 odd %. Siddharth, this one, would you at all be positive? How would you play consumer within this cohort?
Hello.
Siddharth?
Yeah, so
please go ahead.
You can hear me. Yeah, so I think again another place where we don't have coverage, unfortunately. But if you look at Colgate numbers, were very disappointing, and we have not seen that kind of growth, at least in some of the core staples businesses. So the only hope is that with the monsoon being good and with the improvement of the income levels during the year, staples should start showing some recovery.
Okay, talking or rather sticking with this entire theme of consumer, the paints industry has seen roughly 10,000 crore of capex, but the market leader Asian Paints is losing ground. It's fast evolving as a sector. To give us better perspective on all that's happening, we have with us Sajid Mangat. Talk to us about what you're observing within that paint space. What's changing?
If you look at the fourth quarter numbers, and I think almost all numbers are out except for one, Shalimar Paints. I think it's going to be it's expected today. What we are seeing through that sector is a pain with respect to pricing. There is a huge volume issue, volume market share gain, which everyone is trying to do. Within the paint sector, what we have seen in the last 1 year is that the top leader in the paint sector, which is Asian Paints, has lost its revenue market share from around 58.5% at the end of FY24 to nearly 54.5% at the end of FY25. Now, there has been some gains that happened in the Q4, but what it basically means that the hyper competition which is coming into the paint sector, especially in the segments like premium and the luxury segment, is eating into the market share or revenue market share of the leader there. We have other players which are coming into the sector like a Berger, like a Kansai Nerolac and others, Birla Opus. These all companies have undertaken a lot of capex. Birla Opus is undertaking a 10,000 odd crore of capex, which is expected to be fully operational in FY26. And we have Berger and Nerolac, which is also venturing into high-end products, which is in the premium decorative paint segment. And as a result of which there is a hyper competition which is happening in this segment, and we are seeing a market share loss for the leader there, especially from a top line point of view, because there is, while everyone is trying to maintain the volume market share, there is a pricing competition which is coming in, and that's where many of the companies are facing margin issue. In Q4 numbers, if you look at, Asian Paints ended the Q4 with a market share of nearly 55.3%, but it still lost nearly 3.5% market share from what it had in FY24 end. We have other paint majors which have garnered market share towards the end of FY25, which includes Berger and the Kansai. And if you look at the disruptor in this segment, which is Birla Opus, there were three new paints company which came into the market, which one being from JSW, which is mainly into industrial paints, but Birla Opus being into decorative paints, ended the financial year at 3.5% and Q4 with a 6% revenue market share. And Birla is looking at a double-digit market share in FY26. So there is going to be more competition and pain ahead for many of the incumbents who are trying hard by spending on marketing and distribution to maintain the revenue market share in this segment.
Okay, so that's with regard to paints and so many things changing in this space. Siddharth, how are you viewing all of the developments that are playing out, and would you at all dare to, if I can call it, play this, or would you just sit back and watch everything unfold?
Yeah, definitely a lot of competition coming up in the paint space. Even demand has not been that strong. So we have been underweight on Asian Paints. That's the only stock under coverage, apart from Grassing, where you indirectly play the Birla Opus Paints business. So clearly, there is a weak demand. Intense competition has been a key risk, and that is impacting some of the incumbents, including the Asian Paints. We have seen some of the larger players also exiting the business, which is now being sold, ExxonMobil. So clearly, what we see is that competition would continue to impact at least for one more year. The only player space or the player that we like in this space is indirectly through Grasim, where within a year and a half of launch, they have garnered a good market share. 5 of the plants are now up and running. The sixth one will be operational in the first half of the next half of the current financial year. And we see that they have already crossed 10% revenue market share. They're positioning themselves as the third largest decorative paints company. So the only downside is that Grasim core business, which is your VSF and chemicals, that are experiencing some margin pressure due to global challenges. Rest apart, I think the profitability will be visible soon, especially in the paint business with market share gains, and that's the only stock that we like within the paint. So one can play very us through Grasim, where we have a buy rating and a target price of 3170. Asian Paints, we are.
Siddharth, apologies for this, but I believe your audio, there's a bit of a challenge, so not able to completely gather that. We'll probably just quickly check that and maybe get back with regard to a view. But what we're going to do right away is probably slip into a very short break. On the other side, we'll get you top BTST ideas and we'll talk a little bit more. There are a couple of stocks which are really buzzing, something like a Divi's Labs. We'll get you a bull versus bear on that one. So interesting last half hour. Stay with us. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? Welcome back. You know what we're going to do? We're going to shift focus. We're going to stick to Divi's Labs now. Stock is trading over 3% higher post yet another significant order win that's come through. Varsha's here with a breakdown of both the bull case as well as the bear case. Varsha.
Thank you for that. So yes, Divi's has secured another significant long-term manufacturing agreement. Now this is, according to Citi, this is likely for Merck's a peptide product which treats high cholesterol. Now the interesting part is customers itself funding this 600 to 700 crore of capex for this project. But the generic business which Divi's is into is facing a pricing pressure due to intense competition, which could actually impact overall margin for the company. The cumulative investment for the three projects that the Divi's has stands at around 2,000 crore, and Citi believes that this can lead to potential upside of 50% to revenue from FY25 base. But the new projects may have potential delays which could push back the revenue for the company. The company has deepening pipeline when it comes to GLP or diabetes product, which is the hot topic when it comes to pharma. Divi's also have a contract for companies like Eli Lilly's GLP-1 and Merck's peptide product. But the key downside risk when it comes is the potential of innovators to bring down this in-house production on a larger scale, which could impact companies like Divi's. Divi's may benefit from the significant talks of around sectorial tailwinds, which is known as China Plus One strategy, but persistent supply chain and logistic disruptions could actually hamper the growth and could pose operational challenges, which was actually highlighted during the Q4 FY25 con call also. So overall, good set of numbers is expected in FY26 when it comes to Divi's from especially these 3 large projects. The interesting point over here is customer is itself, funding this capex of around 600 to 700 crores.
Okay, so that's the take with regard to Divi's Labs, the bull versus bear case. Thank you, Varsha, for breaking that down. I want to first come to Himen, because Himen, I want to take your view, because you had given this a target price of 7,000 eventually, but you had given us a year in terms of the stock getting there. We're very, very close to that 7,000 now. We're less than 5% away. Would you say that you will likely see better upside on this counter?
Yes, Harsh, I think it looks good. It spent half a dozen months consolidating and finally gave a breakout. So yes, I think 7,000 is on the anvil, and 7,000 can be overshot. But I believe that some amount of profit booking at the first target makes sense. But yes, long story short, I believe it is headed higher. I think it is headed towards around 7350, 7400, Harsh.
Mr. Chokalingam also joining us, economics research. Mr. Chokalingam, what's your take on Divi's? Because certainly doesn't trade cheap. And I know for a fact that you generally don't like high PE multiples, but what about this one? Just with regard to the tailwind, both in terms of the way they do their R&D and the specializations that they have, plenty of potential from a business perspective. How do valuations therefore justify?
Yeah. So I just want to add one supplementary point. I don't like IPE unless there is a proportionate increase in the profit on year-on-year basis. So that is a supplement I wanted to add. So it's trading at over 80 PE. I would be comfortable if profit is growing at around, if not at 80%, at least 40-50%. But it is also true, Divi's Lab in the last 10 years, it always remained overpriced. It still created a lot of wealth for the investors. But having said that, still I won't be comfortable, because if you see FY25 results, year-on-year profit growth has been around 23% in Q4. So even if you assume that the company grows at 30-40%, I'm not comfortable in giving you a buy call at a PE of over 80 times.
So let me rephrase maybe my question. Would you sell at this point if you've bought at lower levels?
Yes, I would sell this stock.
Okay, point taken. All right. So that's the slightly differentiated view from a fundamental and technical perspective. Himen still positive, while Mr. Chokalingam not so much.
Yeah, well, and that's a bucket of stocks in which there is, you could argue, fair degree of interest. The other set of stocks which have actually had a good move, Harsh, the last few days have been these wind energy companies, right? So today Inox and Inox Wind have news, but Suzlon as well for the in today's session, if I'm not wrong, has actually had a pretty decent uptick, 3% higher. So from lows of 55 all the way to 64. And in IW and IWEL, it's essentially the case of the NCLT approval for the merger, as a result of which there is an arbitrage in favor of IWEL, to be honest. But both stocks are doing well. Mr. Chokalingam, do you like them at all, or would you look at cheaper alternatives?
I would look at larger players rather than small players in renewable energy space. So I would look at players like even Adani Power or Adani Green or Tata Power rather than buying small and mid-sized companies. That is because I firmly believe that the competition going to be extremely intensified. Even Reliance Group getting into green energy, there's going to be a lot of competition, and therefore I would prefer, the very large companies in this space.
But Mr. Chokalingam, Suzlon is 90,000 crores of market cap. It is not a mid-sized company but a small company by any means.
Yeah, I would stand corrected. Definitely, it is not a small company, but I still believe that competing with large industrial houses would be a difficult thing going forward, and also considering the current valuations.
Okay. Hemen, is there a trade into any of these, or would you book profits if you were long?
Inox Wind is breaking out today, Neeraj. So that looks promising after some time. Suzlon has formed a rounding bottom. We are going to 70, 80 and 90. So Suzlon at these levels also, 51 to 66 in 4 weeks. So maybe it sounds like repetition. I'll be more comfortable buying it around 60. But yes, coming back to your question, I think further upside is there in both the stocks, Neeraj.
But the Adani Green 2 is up about 2.5%. And remember, viewers, I mean, in some sense, Inox Wind and Suzlon are making the equipment to be given to the wind power generation companies for generating wind power. So in some sense, in that sense, slightly differentiated business. But keep in mind that the Adani Green of the world too have actually a good move. I wonder what Vari is doing, because Vari took a slam dunk on that US tariff development. Currently at about 2801. It's kind of okay, not too bad. Okay. JSW Steel is the other stock, and then Radico Khaitan is the other stock. Just want to mark both of those. In JSW Steel's case, up 2.5% because there is a relief for the stock from the Supreme Court, in that the Supreme Court has told the NCLT not to pass any further orders with regards to BPSL, and which was an asset that they acquired and were asked to return. So I think as a result of it, JSW Steel has had this big positive move in the session today. So good start, or good end to the day actually for JSW Steel, 2.5% higher for this one. Any thoughts here, Mr. Chokalingam, on JSW Steel and the fact that the scare around BPSL might be a bit lower now with today's Supreme Court order?
Yeah, I believe it is maintaining the status quo, but I don't think it's a final verdict. If it is a final verdict, then definitely it's a great positive news for JSW Steel, which is proven to be one of the most efficient steel companies and done phenomenally well in the last 20 years. So if it can get back Bhushan Steel under its fold, I am sure the growth momentum will be maintained. Then it would be a strong buy.
Got it. Okay. The other one is, of course, Radico Khaitan, and Motilal Oswal has initiated coverage with a target price of 3,000. The stock isn't doing anything, but it's worth highlighting. Puneet Johnson with the rationale of the note. Puneet.
Well, thank you for that. It's an interesting time where this is coming. Valuation not cheap actually at all. But they mentioned that the company's focus essentially on product innovation is key, and that's the reason, one of the key reasons they're initiating coverage. They've also said that the company is aiming to becoming one of the key and finest liquor companies in India, and consistently expanding its distribution reach as well. The company currently has pan-India presence. Brand equity has also been built with continuous investment over the past few years, and mentioned that while there has been a miss on the margin, they mentioned that specifically that this is largely due to industry headwinds, and they're expecting a better margin profile going forward as well. Another key interesting aspect is the India-UK FTA that Motilal Oswal is highlighting for Radico Khaitan. They see that the duty cuts are likely to aid growth going forward, And again, as mentioned, while the valuations are quite rich for the company, the robust growth potential is something that augurs well for them. So they are expecting a 30% EPS CAGR for the company over the next few years, estimating that valuation, the 60 times price to earnings, currently bakes in some of the growth, but not all of it, and hence a 30% EPS CAGR over the next 2 to 3 years does help with the valuation comfort. So that's one of the key aspects for this note, and hence Motilal Oswal putting their positive view on Radico Khaitan.
Okay. Thanks for that, Puneet. Hemen, lying low, Radico Khaitan, but some of these stocks had a bit of a up move in the recent past, right? Allied Blenders, Radico Khaitan, I think Piccadilly. Is there a trade in any of these?
I think Neeraj, Allied Blenders looks interesting. I don't have too much of data to go on, but whatever data I have suggests we're in an intermediate uptrend, and it's threatening to convert this into a longer term uptrend. So Radico Khaitan, I'm not saying it's a double top, but we walked into resistance from the previous high. I think it would need some time to consolidate before it makes a clear move up. While Allied Blenders, it's a cooler within an uptrend. So on a small decline or even current levels and slightly around 380, I think Allied Blender looks much better comparatively.
Okay, so that's the view coming in. Switching focus to Narayana Health. In fact, we spoke with the management earlier today. Strong set of numbers, stock perked up by around 3% odd. Here's what they had to say about FY26 and the growth trajectory expected. Listening.
We do anticipate to improve margins like we have done for the past 3 years in FY26 also. Without guiding, a lot of it will come through the same measures which we have taken, which is more throughput through the same infrastructure. No new infrastructure is coming online, but we do aspire to grow within the same capacity, which means we will continue to exercise the throughput levers. So we are hoping that the India margins will see expansion on the hospital side. Of course, we will continue to have cash burn on the insurance business side, and Cayman may broadly be stable in terms of its margin performance. So on an overall basis, maybe we will have a more stable margin performance, but definitely on the India hospital side, we are aspiring for margin growth.
All right, so that's the management of Narayana. Mr. Chokalingam, would you at all be constructive with regard to this name within the healthcare space? And if not, how would you play healthcare? Give us your view.
Yeah, it's been doing very well. One has to accept it. Valuation is slightly stretched. That's a problem for me. But still, one can hold it. It's trading at around 44p on trading basis. Though the growth in Q4 or full year FY25 on year-on-year basis doesn't justify this kind of valuation. Being in a defensive nature of business and past track record, I would give a hold. In case stock falls, more than 5%, then one can consider buying Narayana Hrudayalaya.
Okay. Himin, your first quick take with regard to Narayana?
Virtual roadblock at 1860 Harsh. I think it's overbought. The stock goes from 200 to 1850 in the last 5 years. I prefer to stay away.
Okay. And your BTST, STBT for today, Himen?
Okay. It's a BTST on IndusInd Bank. One can buy around 800. Stop loss 793. Target 814. BTST. Harsh.
Okay. While we are speaking as office space solutions, numbers coming in, 46% uptick in revenue on a YOY basis. You're seeing EBITDA up 73% YOY, and you're seeing largely a decent set of margins also coming in, 34 versus 29, more than decent, you would call it. In fact, impressive to a certain extent in terms of that YOY margin number. Profitability sitting at 11 crore versus 1.3 crore same time last year. So decently strong set of numbers coming through for office space, but stock up 0.5% odd in trade. Mr. Chokalingam, quick question for you. Would you play real estate Would you play logistics? How would you play it if any? Are these two themes on your list?
Yeah, definitely, but I have not tracked this office space solutions. Extremely, we are bullish on logistic and real estate. We would suggest stocks like DLF, and indirect to play on real estate is Nesco, which I have been recommending for years. And in logistic, Gateway District Parks and Balmalari Company. These are other two stocks we keep recommending.
Okay, so those are a couple of names. Mr. Chokalingam, I don't think I quite caught whether real estate is on your mind. Are you positive real estate?
Yes, definitely positive.
Okay.
The kind of money supply growing in the system and a lot of money made in the stock market in the last 3-4 years. I think there is a lot more room for real estate sector, to improve. And some of these companies are lucky enough to, have a land bank which they bought at a much lower price few years or several years ago. So therefore, selectively, yes, I am extremely bullish on real estate space.
Understood. Okay. Himen, I wonder what the take with regard to an IT is, because we spoke to an e-clerks earlier today, got the view that from a fundamental perspective, and I will take Mr. Chokalingam's view, there's still some more desired before growth starts to kick in. But Himen, your quick take with regard to some of the IT stocks and your favorites within that pack?
Okay, basically a 16,000 point fall in the Nifty IT index, Harsh. So we are seeing a recovery. The recovery is probably not run its course. So I like BSoft and LTTS amongst a lot. I feel there is some more bounce left. I wouldn't be very excited, but like I said, the move is not yet over.
Okay. Some of the mid-sized IT and IT related names, Nucleus Software, for example, had a fairly strong uptick as well after the numbers. Mr. Chokalingam, anything in the smaller names that has stood out for you?
Yeah, I'm very optimistic on small and mid-sized IT companies because the large companies are not able to grow in double digit or even near 8 to 10%. They are all growing at 2 to 4% in dollar term. So therefore, I may be wrong, but I have a strong conviction that what we saw in 2014 to 2019 is likely to get repeated. That is a lot more consolidation and acquisition in the small and mid-sized IT companies. Now, after the tax was hiked, for buyback, so large IT companies are reluctant to come out with aggressive buyback as well, which means a lot of cash is held by the large companies. So putting these two trends together, I believe there is an opportunity for further consolidation in the IT space. So there is a possibility for re-rating of valuation multiple for some of the beaten down small and mid-sized IT companies.
Chokalingam, which ones?
Among these, we recommend Cyient. I am extremely bullish on Cyient because it is the cheapest stock compared to the peers in terms of PE as well as in terms of enterprise value to annual revenues. And there is one more added comfort. It has got 3 verticals. One is IT services, other one, Cyient DLM, which is into engineering. Third, recently floated the 100% subsidiary, which is engaged in semiconductors. So that gives me a lot of comfort in this stock.
Okay, some stocks which are moving around and some which are news. Himen, as we start wrapping up, here's the key movers, right? BEML up 16%. Maybe we've spoken about it, but if not, give me a view there. Give me a view on Shilpa Medicare, which has this news flow of an approval, and that stock is up about 12.5% in trade. And lastly, Subros, which is up about 9.8%. So any of these three?
I spoke about BEML with Harsh.
Okay, yeah, sure. So let's talk about the others, Shilpa Medicare or a Subros.
Okay, Shilpa Medicare, we're running into 950 and this level is important. So it's also the all-time high. I have a feeling we'll consolidate a bit over here, but the setup seems that in the next few months, the stock looks set for an all-time high, Neeraj.
All-time high would be what levels, Himen?
Yeah, the all-time high is around 875.70. I believe, 959.50. I believe we crossed that.
So you open a positional trade here, right? You're saying?
I would open a positional trade $50 lower.
Acha, $50 lower, not right now. Okay. Some of the others which are doing very well, Hemant, Camlin Fine, there is IFB Agro, there is Sandhar Tech, all of which have 10, 11, 12% gains to themselves. Anything on the charts?
Camlin is going to 250. Long-term uptrend was good, is good. Sandhar is fine. Intermediate uptrend, buy on decline, not bad at all.
Okay, Mr. Chokalingam, if I can quickly come to you with regard to some cement counters. The JK Cement, very, very positive numbers in that sense. What's the view like on cement? Are there any favorites in your bag?
One should hold both JK Cement and JK Lakshmi Cement. It's a really phenomenal. I've been tracking them for the last 5 years intensively. Whatever is the condition in the cement industry, they remain as outperforming in terms of performance, and also a lot of build-up in renewable energy as a captive power. So these are good to hold. Otherwise, I would recommend a buy recommendation on KCP Limited, which is a small cement and a diversified company. We also personally hold the stock.
What about something like a Quest Corp, something like a Team Lease? Mr. Chokalingam, do you have a view with regard to a couple of those?
I would not buy these stocks, particularly Quest Corp. The result was not up to expectation. And secondly, we all know that there is some slowdown in the employment opportunities in the urban centers, which could be negative for these kind of companies.
What about a Web of Global, Mr. Chokalingam?
I haven't tracked that.
Okay, point taken. Point taken.
Yeah, well, so lastly, as we wrap up, companies on which there were some very positive announcements and cannot talk about a defense name. Hemant, as we wrap up, Garden Reach Shipbuilders, one of the most traded stocks in the last 2 or 3 weeks, lying low today. Is there a trade here? Hemant?
Yeah, sorry. If I can sidestep that question, Neeraj, GRSE, I won't have a trade. I would have a trade on Cochin.
Okay, mention your trade on Cochin, Hemant, very quickly.
Yeah, I would have a long trade on Cochin at around 1800, stop loss $75, target 300.
Okay, thank you so much, both of you gentlemen, for coming in, speaking with us, and especially rushing through all of those views over the last 10 minutes. So thank you for coming in. Let's quickly look at how the Nifty is settling in at, I'd reckon around the 25K levels. There you go. So just about 24,995. So not a bad day of trade per se. The Nifty Bank has seen a bit of an uptick versus maybe an hour or so ago. So maybe some action there. Let's look at the heat map on the Nifty. One firmly sitting at the bottom is a Zomato, or Eternal now as it's called. And those sitting at the top also fairly solid. The top three, Bajaj Auto, M&M and JSW Steel, have been sitting at the top for a while now. So those three definitely in focus. Some flavor of IT within the top performers, at least in trade today. So auto and IT really leading the pack. Let's look at the sectors, and likely we'll see that we've closed for the day. Defense is of course the top performer, but you have IT and auto up 1% each. FMCG too has had a fairly good day for itself. Metals are up around 0.8% thereabouts. All the sectors trading in the green. The Nifty Media, which was down around 0.2 odd%, has now flipped to the green and is up 0.5% at close. Let's look at the advanced decline quickly, and that will indicate how the mid caps and small cap indices have done as well. Fairly decent in terms of advanced decline, 3:2 in terms of the ratio, broad level. Let's look at the Nifty small cap and mid cap, and around 0.5% higher on the Nifty mid cap, fairly range bound day of trade. The Nifty small cap as well, 0.5% higher, very range bound day of trade for both of those indices. Again, all positive, because we needed something like this, a decent day of trade, very range bound, and at the same time closing in the green and hitting key levels as well where the Nifty is concerned. So it's a decentish kind of day. Let's look at last off the BSE 500 top gainers, top losers. Those are some names Vaibhav Global was up 7.5%. Phenol-X, Gillette on the back of numbers was perked up as high as nearly 10% as the numbers came out. And HLE Glasscoat is one which has obviously done very well over the last week or so. Stock is up 6% in trade today as well. GNFC is the other one which has done well. Hykel, Balkrishna Industries are some of the stocks which are languishing. Eternal also making it to the list of the biggest losers on the BSE 500 today. Quickly on what to watch out for tomorrow. And those are all the dividend announcements which are likely to materialize. But outside of that, you'll have the other one. There's a buyback of Infobeans Technologies, which will likely get executed. And then you have all of those numbers which are expected to come out. DCX Systems, a Dynamatic, and InfoEdge will be the other big one to look out for. Outside of the PSU basket, where NMDC and a BDL will also come out with numbers. But what we're going to do is we're going to focus in on the macro, because that also in focus as India became the 4th largest economy globally. But core inflation is expected to remain low on slower growth, believes Pranjal Bhandari, Chief India and Indonesia economist at HSBC. Listen in as she explains her growth expectations on the Indian economy.
My sense is that the average of next 6 months, we could see inflation actually average about 2.5%, which is way lower than the 4% target, simply because food inflation has fallen. And not only is it because of items like vegetables, but it's durable items like pulses, wheat, rice. After a very long time, state granaries are full of food. And once that becomes the case, and that can keep a lid on inflation for like a 1 to 2 year horizon. So food inflation looks to be in a good place. And then you have core inflation, on the back of slightly weaker growth, on the back of the currency now having rebounded a little bit, on the back of imported disinflation from China, falling commodity prices. My sense is core inflation will also remain quite low. Now, when inflation is so low for so long, it helps in many ways. One, it helps the RBI to have a loose monetary policy. It's been cutting rates. We are expecting 3 more rate cuts in this cycle. It's giving a lot of liquidity. We think that will generally continue. Second, it provides higher purchasing power. And this purchasing power is very important for the informal sector. When prices fall, they feel rich, they buy more.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
Hello and welcome. Good afternoon. You're watching Market Express and I'm your host Malika Mishra. Let's get straight into the show. Markets end the day in the green, but in what was largely a range-bound trade. The Nifty climbed up to 25,000 in early trade and slipped back to the to end the session just below the 25,000 mark. The 30-pack Sensex ended over 0.5% higher, ending Monday's session over 82,000. All sectors concluded in the green with healthy gains. Defence, IT, auto, FMCG and metals led the sectoral pack. PSU Bank, Pharma and the banking sectors gained the least. NTPC's Q4 profit surge is 23.4%, fueled by over 4% revenue and EBITDA growth. A 2% year-on-year rise in power generation drives revenue. Despite squeezing margins, brokerage firm Nuvama names NTPC its top power utility pick. JSW Steel achieves record-breaking Q4 production with net profit doubling compared to the previous year. However, revenue falls short of analyst estimates. Exports reach an all-time high of 7.63 million tons of crude steel, with steel sales surpassing 7 million tons, contributing to a 10% volume growth. During the con call, the company announces plans to acquire 3 new mines in Karnataka by Q2 of FY26. And the Supreme Court's special bench directs a status quo with no conclusive judgment for allowing JSW Steel to file a review petition against the Bhushan Power liquidation order. The court holds NCLT proceedings to prevent irreversible steps, citing complex financial issues. Unwinding the 5-year-old resolution plan could impact JSW, banks and creditors. Now, former promoters' frequent NCLT pleas for liquidation raise concerns. Fairness is emphasized with the review's outcome to decide the case. No actions are permitted until the hearing, which is likely in the month of June. And brokerages weigh in on JSW Steel post Q4 results. Morgan Stanley maintains an equal weight with a 1,000 rupee target, citing BPSL uncertainty and weaker overseas subsidiary performance, but sees improvement ahead on rising steel prices. CLSA keeps an underperform rating, raising the target to 880 rupees, while highlighting better profitability but lower volume guidance. JP Morgan stays overweight, hiking the target to 1,085, stating that BPSL judgment won't derail JSW Steel's long-term growth story, with the company expected to surpass 20% market share in the coming years. And JK Cement reports a stellar Q4 with profits soaring over 64% and margins rising by more than 4% compared to the prior quarter. The impressive performance is driven by strong pipeline growth and significant profit after tax increases. Bolstered by these strong earnings, the company announces a dividend of 15 rupees per share. Anupam Rasayan reports strong Q4 earnings driven by pharma and polymer growth, along with a recovery in agrochemicals. Tanfac Industries contributes significantly, with Anupam holding a 25.8% stake in the company. EBITDA margins expand due to product mix and operational efficiencies. Revenue also rises 24.7% to 500 crore from 401 crore rupees earlier. EBITDA jumps 55.8% to 144.3 crore from 92.6 crore, pushing the margin to 28.9% from 23.1%. Net profit surges 44% to 44.5 crore rupees from 30.9 crore earlier, and the company targets 25 to 30% revenue growth in FY26. GE Vernova TND India's shares jumped 10% to a 4-month high, hitting the upper circuit after a strong Q4 FY25 performance. The company posts a net profit of 186.5 crore, nearly 3 times the previous year's 66.3 crore, while revenue climbs 26% to 1,152.54 crore rupees. EBITDA surges 127% to 252 crore rupees, with margins almost doubling to 21.9%. It also announces a final dividend of 250 rupees per share for FY25. Gujarat Narmada Valley reports a mixed Q4, with revenue dipping to 2.6%. Revenue dipping by 2.6% to 2,055 crore rupees, while net profit surges over 62% to 211 crore rupees. EBITDA jumps over 65% again to 240 crore rupees, lifting margins to over 11% from about 7% earlier. The company announces a dividend payout of 18 rupees per share. Employee expenses rise 14%, raw material costs increase by 10%, and other expenses grew by 9%. Phenolic surges in trade despite a weak Q4. Revenue dips 5.2% to 1,172 crore, while EBITDA falls 18% to 171.4 171.3 crore rupees, pushing margins down to 14.6% from 16.9% earlier. Net profit remains flat, inching up just about 0.2% to 164.6 crore rupees. Despite muted earnings, optimism surrounds the stock as pipe and fitting volumes grow by 2%. PVC segment margins improved by 23 basis points to 13.2% with expectations of better pricing ahead. Shares of Gillette India rises over 8% in trade as the company reports a strong quarter, marking a 60% rise in net profit in Q4 of FY25. The revenue of the consumer company grew by over 12% too. EBITDA surged by 40%, indicating substantial improvement in operational efficiency. Margins also expanded to 29.4% from 23.7% earlier. Narayana Health posts strong Q4 results driven by growth in its India and Cayman operations. Domestic volumes and better realizations boost revenue while margins expand. The company announces a final dividend and continues its expansion plans with bed capacity set to increase significantly. Divi's Laboratories secures a major agreement to produce advanced intermediates for a global pharma giant with the customer funding 600 to 700 crore in capital expenditure. Now, this marks the third dedicated capital expenditure announcement totaling to 2,000 crore rupees, set to boost FY25 revenue by over 50%. The deal strengthens Divi's pipeline with high-value products from top pharma firms. Moving on, Balkrishna Industries stock tumbles 10% today despite a robust market due to a weaker than expected Q4 profit after tax hit by forex losses. The company plans a strategic entry into premium passenger car radial and commercial vehicle radial tires, initially targeting the domestic replacement market. Balkrishna aims to bolster its presence in these new tire segments to drive future growth. And also Eternal, formerly known as Zomato, braces for a passive outflow worth $840 million due to a significant cut in foreign ownership limit from 100% to 49.5%. FTSE's direct weight reduction triggers $380 million in outflows on May 27th, while MSCI's judgment, unexpected until August 2025, adds $460 million on May 30th. Unlike phased headroom cuts, FTSE implements a full reduction, amplifying the market impact. Lux tanks in trade as subdued consumption demand and inflation weigh on Q4 performance despite a 15.6% revenue increase to 817.7 crore rupees. EBITDA sees only marginal growth of 1.4% to 76.6 crore rupees, with margins slipping to 9.4% from 10.7% earlier. The net profit declines by 13.4% to 48.1 crore rupees, reflecting ongoing market challenges for the company. Afcon's infra tanks in trade as net profit slips 23% in Q4. Revenue rises 11.4% to 3,223 crore rupees, while EBITDA grows 17.3% to 294 crore rupees. But margins dip to 9.1% from 9.8%. Net profit also declined by 23.4% to 111 crore rupees, reflecting pressure on profitability. The company's order book stands strong at 36,869 crore rupees. And BEML is witnessing another strong surge in trade today following stellar earnings and solid guidance from last week. The company is reporting a record annual profit of 294 crore rupees in FY25, with improved operational efficiency lifting margins to 13.2%. BEML is securing land in Madhya Pradesh and Chhattisgarh to expand manufacturing for rail and metro and mining and construction equipment. Analysts are expecting the rail and metro segment to gain momentum, pushing the company's order book towards 22,000 crore rupees in FY26. The paints industry is witnessing a 10,000 crore capex boom, bringing fresh competition and market shifts. Asian Paints is losing ground as new entrants like Birla Opus challenge the premium segment, while Berger, Nerolac and Indigo gain market share through pricing and marketing strategies. Demand is staying soft, forcing firms to focus on price cuts and lower raw material costs to sustain growth. As all players target the premium market, the industry leader is struggling to defend its dominance. Motilal Oswal initiates a buy on Radico Khaitan with a target of 3,000 rupees, citing strong product innovation and an expanding distribution network. The company continues to scale up, driving double-digit volume growth despite margin pressures from industry headwinds. Radico leverages free cash flow to reduce debt with scope for further balance sheet strengthening. The India-UK Free Trade Agreement could provide an additional boost with potential duty cuts, while rich valuations reflect its robust growth potential. And LIC is likely to report steady growth in Q4 of FY25, with total annual premium equivalent rising by 8.84% to 20,052 crore rupees, reflecting top-line expansion. The value of new business can increase by 11.86% to 4,083 crore rupees, indicating improved profitability. However, VNB margins may decline 165 basis points to 17.71% from 19.36% on a quarter-on-quarter basis, signaling some pressure on profit margins despite overall growth momentum. Aurobindo Pharma is set to post Q4 earnings today, with revenue expected to rise by 8.13% to 8,197 crore rupees. EBITDA is projected to grow by 10% to 1,827 crore rupees, while net profit may jump by 11.7% to 1,013 crore rupees. The company benefits from a recovery in the US through new launches and generics, while its injectable business boosts top-line growth. European operations remain steady, but EBITDA margins could face pressure due to new plant-related expenses. The initial public offering of Aegis Vopak Terminals was subscribed over 6% on its first day of bidding on Monday. The company announced a price band of 223 to 235 rupees per share for its 2,800 crore IPO. The company intends to use the net proceeds from this IPO towards repayment of outstanding borrowings, funding capital expenditure towards acquisition of the cryogenic LPG terminal at Mangalore, and for general corporate purposes. The issue is scheduled to close on May 28th. And Schloss Bangalore, operator of luxury hotels under the Leela brand, is set to launch its IPO from May 26 to May 28. The issue is priced between 413 to 435 rupees per share, with a lot size of 34 shares. The total IPO size stands at 3,500 crore rupees, comprising a 2,500 crore rupees of fresh issue and 1,000 crore of offer for sale. At the upper price band, the company's market value reaches 14,527 crore rupees. And also today, in today's trade, rupee closed stronger against the US dollar, which settled at 12 paise stronger at 85.1 against US dollar. Rupee closes stronger against US dollar. Market momentum remains strong, but earnings may not be the driving force at this stage, warns Aditya Suresh of Macquarie Capital. He signals potential cuts to earnings to estimates for FY26 and FY27, highlighting caution ahead. A key shift in global markets has been the Trump dynamics, influencing the dollar and shaping investor sentiment. HSBC expects core inflation to stay low amid slower growth, forecasting an average inflation rate of 2.5% over the next 6 months. 3 rate cuts are anticipated in this cycle, reflecting economic adjustments ahead. At the last SEBI panel meeting, MSC and NCDEX dissented to the idea of having just 2 expiry days for derivatives. They suggested that each exchange should be allowed its own weekly expiry day, saying this would promote fair competition, support new entrants, and avoid an uneven playing field. The committee has asked both exchanges to make detailed submissions to SEBI. And SEBI considers settling NSE cases under the consent route, allowing resolution without admission of guilt. The regulator weighs 2 options: NSE withdrawing its dark fiber case from court and filing for consent, or SEBI issuing a no objection certificate with conditions, including proper disclosure in the dead herring prospectus. Now, the move is seen as a crucial step toward NSE's long-pending IPO. Allegations center on preferential access for select brokers via dark fiber, with discussions ongoing to resolve regulatory concerns. In a major boost to the government's fiscal position, the Board of the Reserve Bank of India approved a record surplus transfer or dividend of 2.69 lakh crore to the central government for the accounting year 2024-25. The transferable surplus for 2024-25 has been arrived at on the basis of the revised economic capital framework as approved by the Central Board in its meeting held on May 15, 2025. RBI has also said that changes which are made is to further strengthen the framework. IndusInd Bank is facing fallout as J. Sridharan, Executive VC of its microfinance subsidiary Bharat Financial Inclusion, resigns with immediate effect. Two other officials handling loan data are also leaving following findings of large accounting gaps in the micro-lending business. The exits are raising concerns about financial transparency and regulatory scrutiny in the sector. The developments could impact confidence in the bank's microfinance operations. Citing International Monetary Fund data, CEO of Niti Aayog BVR Subramaniam said that India has overtaken Japan and has become the fourth largest economy in the world. He also said that India has an economy of $4 trillion and may soon surpass Germany to become the third largest economy if we stick to whatever is planned. Gold prices are slipping, with spot gold down 0.3% to $3,346.59 per ounce, and US gold futures falling 0.6% to $3,345.7 following US President Donald Trump's decision to delay a tariff hike on EU imports to July 9. In India, 24K gold is trading at 9,764 rupees per gram, 22-carat gold at 8,950 rupees per gram, and 18-carat gold at 7,323 rupees per gram, according to Good Returns. The decline follows a 2% surge in gold prices on Friday, driven by safe haven buying after Trump's initial 50% tariff threat, though he moderated the stance on Sunday. And crude oil prices rise as President Donald Trump extends the deadline for a trade deal with the EU to early July. However, OPEC Plus plans to increase production, offsetting the positive impact of the tariff delay. Bullion trades near $3,350 an ounce after gaining nearly 5% last week, while Brent crude climbs for a second session, hovering around $65 a barrel. In conversation with NDTV Profit, Radhika Gupta, the CEO at Edelweiss, spoke on special investment funds. She explained that SIFs are like mutual funds, but with a bit more flexibility in terms of use of derivatives and subscription. And also, just like mutual funds, SIFs too have three different kinds: equity, debt, and hybrid. And COVID-19 cases witness a rapid surge across the country, with active cases crossing 1,000. Kerala tops the chart with over 430 cases, followed by Maharashtra with 209 active cases currently. Overnight and continuing morning rain has brought the financial capital Mumbai to a standstill. IMD has alerted red alert for the city and orange alert for areas like Raigad, Ratnagiri, and Pahalgam for the next few days. Low-lying areas of Dadar, Sion, Parel were the most affected areas in Mumbai due to rain. The BMC has urged the citizens not to step out of their homes if it is not necessary. RJD Chief and former Chief Minister of Bihar, Lalu Prasad Yadav, expelled his elder son, Tej Pratap Yadav, from the party for 6 years. Lalu said ignoring moral values in personal life weakens the party's collective struggle for social justice, adding that the conduct of Tej Pratap was not in line with the family values or traditions. This is seen as a key move as Bihar is already gearing up for the polls due in November. NCP Minister Chhagan Bhujbal is the newly inducted minister in the Fadnavis cabinet, as the food and civil supplies portfolio held by him previously as well. The department was without a minister after NCP leader Dhananjay Munde, who helmed it, resigned in March this year. The multiple-time MLA from the Yeola in Nashik district was sworn in as a minister on May 20th, marking his return to the cabinet after being overlooked during its first expansion in December last year. US President is once again turning up the pressure on major tech and manufacturing companies. In comments made earlier, the president indicated that new tariffs could be imposed on companies like Apple and Samsung if they manufacture their products overseas and could begin as early as in June. But condition remains that if they manufacture in the US, no tariffs would be applied on them. Temporary but big relief for Europe from tariffs as Trump agrees to extend deadline on imposing 50% tariffs until July 9th. The deadline was extended after Commission President Ursula von der Leyen and Trump had a successful discussion on the phone. The EU had been slated for a 20% tariff under those reciprocal rates announced in April, and a temporary pause took the rate down to 10% through July 9th. And Trump calls President Vladimir Putin absolutely crazy. The comment comes from the UN easing the uneasing tensions between Russia and Ukraine, killing thousands of innocents and leading to major losses. President Donald Trump said he is considering new sanctions against Russia after Moscow launched a second night of deadly missile and drone strikes across much of Ukraine. Trump also said that the Russian president is killing a lot of people and he doesn't know what the hell happened to Putin. Chennai Super Kings ended their tournament with an 83-run win in their last match. Playing against Gujarat Titans, Chennai batted first, putting up a target of 230 runs with a loss of just 5 wickets in 20 overs. Dewald Brevis was the highest run scorer, scoring 57 runs in just 23 balls. Chasing the score down, Gujarat Titans succumbed to 147 runs, losing all the 10 wickets in just 19 overs. The Suns never ceased to set for the Sunrisers Hyderabad this tournament. The Orange Army defeated Kolkata Knight Riders by 110 runs. Batting first, Hyderabad put up a score of 278 runs in just 20 overs. Henry Klassen was the highest run scorer, who scored 105 in just 39 balls. Kolkata Knight Riders lost all their 10 wickets in just 18.4 overs, suffering a massive defeat of more than 100 runs. Both the teams have been eliminated by his edition of IPL, but have showed their temperament quite extensively. Xabi Alonso will be presented as Real Madrid's new head coach later today. This comes after he signed a 3-year contract with the club. Club confirmed that Alonso would be Carlo Ancelotti's successor, taking charge from June 1st. Now, his first challenge will be to lead the team at next month's Club World Cup. And with that, it's a wrap on Market Express, but do stay tuned as there's Profit 360 with Sanjana Chauhan lined up for you right on the other side.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
headlines you start your day with.
The market ends higher as Nifty Sensex jumped by 0.5% to gain for the second session in a row. All sectoral indices close in the green. Small and mid-cap indices mirror the benchmarks. Supreme Court orders status quo in the JSW Steel Bhushan power case, pauses all liquidation steps, says no effective order to be passed by the NCLT until the Apex Court rules on the review petitions. Yet another setback for IndusInd Bank. Sources tell NDTV Profit that Executive Vice Chairman of the bank's microfinance subsidiary, Bharat Financial Inclusion, has resigned with immediate effect following the large accounting gaps in the company. IMD issues a red alert in Mumbai, Thane and Raigad as monsoon arrives early. Continuous rain brings Mumbai to a standstill, leaving several areas waterlogged and disrupts transport and flight services. Sources say SEBI may pave the way for the NSE IPO, but with conditions, considers two ways to the exchange so that the IPO goes through. Active COVID cases in India across the 1,000 mark. Kerala reports the highest number of cases at 430, followed by Maharashtra that reported 209 cases. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Over the next 30 minutes, we're going to bring you the latest updates on markets, key national developments and major global headlines. So stay with us for all of the action and let's take a look at how the markets fared today. Benchmark indices started the week higher with Nifty and Sensex gaining 0.5% each. Indices also touched a one-week high. Bajaj Auto and JSW Steel emerged as the top gainers in the Nifty. All sectoral indices closed in the green. My colleague Harsh now joining us with a detailed market roundup of the day.
Well, 150-point jump for the Nifty 50 and welcomed back the 25K mark. We've closed just about that number on the Nifty 50 index. Well, it was aided by auto and IT. In fact, look at the top gainers on the Nifty 50. We'll quickly flash those. JSW Steel perked up 2%, but outside of that, there was a Bajaj Auto and an M&M, both of which have done very well in trade today. And then you had some of the other auto names as well. Hero Moto was up 1% as well. So some of those contributed to the gains on the Nifty. In terms of the top loser, it was Eternal with possible $850 million of outflows slated through this week. That one was in focus as well and under pressure, nearly 5% lower for the day. Let's talk about some sectors. Defense was one of them. From the lows of the day, the defense index was up 1.3%. So very, very sharp rebound that we saw intraday on that index. So that was one. The other one, of course, within that basket was also a BEML up 13%. After strong commentary kept the stock in focus, second straight day of solid gains for a BEML. Let's talk about some other sectors as well. IT, auto, we spoke about auto, but IT was the other one with 1% plus of gains today. And then there was FMCG also, with some names doing very well. Nifty FMCG was up 1%. No losers on sectoral indices. The breadth was also good. Overall, a decent day of trade. When you're looking at the market breadth, it was largely 3:2 in favor of the advances. Decent kind of breadth. 0.5% higher on the Nifty. Mid cap, small cap, fairly range bound day of trade for both of those. All of which pointing for a good, strong consolidation which is at play. So all of that positive. Overall, of course, there were some earnings which disappointed and therefore the BSE 500 showing some losers over there, including the likes of an Eternal making it to the top losers on the BSE 500. But more winners than losers, more good than bad today for sure to start this week off. So positive for the way in which today has played out.
Meanwhile, the Supreme Court has pressed pause on the JSW Steel Bhushan Power case, choosing caution over quick decisions. While no final verdict has been passed as yet, JSW Steel essentially has been given the green light to file a review petition. Let me go across now to my colleague Aishwarya for a deeper dive into what this means for JSW Steel, the banks, and essentially all those involved.
Well, the JSW Steel and Bhushan Power case, a crucial hearing was underway at the Supreme Court today. It was heard by justices and a bench of Justice B.V. Nagaratna as well as Justice Satish Sharma. Now, the first few thoughts and views coming in from the bench side, they have ordered status quo as far as the JSW Steel Bhushan Power case is concerned, and have also said that NCLT proceedings should be avoided because liquidation would mean an irreversible step. So NCLT has been directed not to pass any effective order until the review is heard. The court also noted the complexities and the financial and legal implications of this particular case as well. The resolution plan was implemented about 5 years ago, and reversing it could disrupt multiple stakeholders is what the court emphasized as well. Now, Supreme Court has not yet passed the final judgment. As of yet, JSW Steel is allowed to file a review petition, and the matter could be taken up soon after the court opens up after the break, maybe probably in the first week of June or so. The court also emphasized in its closing thoughts that fairness and due process should be allowed as far as this liquidation case is concerned that the company is running into. Liquidation, if done hastily, could severely impact banks, creditors, as well as JSW Steel. Those are the words coming in from the bench presided this particular case as far as JSW Steel and Bhushan Power is concerned.
Thanks, Aishwarya, for that. And even as the Supreme Court re-examines the JSW Steel Bhushan Power deal, the government is now moving swiftly to plug procedural gaps in the IBC framework. This is what high-level sources have in fact told NDTV Profit. And for more on this, let me go to my colleague Shrimi for the details on the centre's three-pronged strategy and what could change in the next phase of insolvency reforms.
Yes, government is reviewing its insolvency and bankruptcy code regulation in order to prevent the repeated instances like JSW Steel acquiring Bhushan Power and Steel. What we've been given to understand that Finance Ministry and MCA is closely working to on three-pronged strategy, which also include the amendment in the IBC law, particularly from the execution and the implementation side of the law. However, Finance Ministry is of view that there is no question about the robustness of IBC. However, the things like execution, which has been highlighted by Supreme Court in this particular case, needs to be addressed, and for that slew of amendment would come in the upcoming monsoon session is what indication we are getting from the sources. The another one, the strategy, they are in touch with the key stakeholders, particularly the IBBI, which is a regulator, where they want all these stakeholders, all the departments and ministries to come on the same page to sort of exercise the commercial wisdom and to have a different view when it comes to, insolvency firms. And in fact, they are saying that they are also looking at the scope of whether there is more tightening is required as far as resolution professional role is concerned, and also the code of conduct with respect to the creditors. Now, the third and the last one is the ongoing case of the JSW in the Supreme Court, where the Supreme Court has today, maintained the status quo on the whole liquidation of BPCL. So that is an interim relief, which is clearly coming in. However, government is not the party to that review petition. However, all the department and ministry is reviewing this case very, very closely, and in fact, they are saying that this will be in a large public interest, so they will definitely watching the entire resolution deal and will continue to see how this will pan out.
Absolutely, the government in a wait and watch approach. And in yet another setback for IndusInd Bank, sources have told NDTV Profit that the executive vice chairman of its microfinance subsidiary, J. Sridharan, has resigned with immediate effect. My colleague Shobhana, who's been tracking the story very closely, now joining me on the phone line with more. Shobhana, this comes amid serious concerns over accounting gaps in the micro-lending business. What does this fallout essentially mean for IndusInd Bank and the governance practices?
Hi. So yes, it's a big development. the Executive Vice Chairman of Bharat Financial Inclusion, which is the microfinance subsidiary of IndusInd Bank, has resigned with immediate effect. Now, this is an important development because IndusInd Bank has been the talk of town, with its accounting gaps in its microfinance loans, in derivative trades and other assets and liabilities. Now, what sources have told my colleague Rishi is that two other officials that were handling the loan data, they were also they have also been asked to leave. And these exits obviously have come because there were large accounting gaps in its micro-lending business. Now, last week when IndusInd Bank had announced its Q4 earning results, the non-executive chairman of the bank's board, Sunil Mehta, had said that the bank had incorrectly had booked interest income and fee income over the past 3 quarters of the financial year ended FY25, which they have reversed in January. Now, the bank, they also said that, there were some microfinance accounts that were wrongly being classified as standard. These have been moved to NPA. So, overall, the whole microfinance accounting gap had caused the bank, an adverse impact of nearly 2,000 crores. It's a big development because the MD and CEO of IndusInd Bank, Sumant Katpalia, and the Deputy CEO, Arun Khurana, had resigned last month, as a result of the review that had come from the investigative firm PwC and the internal review that the bank had done. So it's an ongoing development. It's an ongoing story, and what the chairman of the bank had also said during the analyst call, that they're looking for another CEO, and they have submitted the names of the new CEO candidates to the RBI, and they will announce the new CEO name by June 30. So yes, it's an ongoing story, and we're tracking it.
Right, Shubhana, thanks so much for that. A senior executive at IndusInd Bank's microfinance unit has in fact exited, and we'll continue bringing you the latest developments from that. Moving on, an unseasonal downpour has led to the summer season taking a rain check. Overnight and continuing rain through the day has brought Mumbai to a standstill, leaving several areas of the city waterlogged, disrupting transport and flight services. A red alert has been issued for Mumbai, and many low-lying areas in Kurla, in Sion, in Dadar and Parel have been affected. The weather department has said that the southwest monsoons arrived in Maharashtra on Sunday, making it the earliest onset of the annual rainfall season over the state in 35 years. Let me quickly go over now to my colleague Jui now, who's joining me from Dadar. Jui, take us through the situation there. We understand that Dadar is one of the areas that is prone to flooding during Mumbai's monsoons.
Absolutely, if you go to see, Mumbai is facing heavy rainfall since midnight, and right now where I'm standing is the Dadar area. As you likely said, Dadar is an area which has seen flooding even if it rains for a little time. But today if you go to see, it is raining since midnight, and this has resulted to waterlogging in many parts of the city. If you go to see, especially the Hindamata area of Dadar, Hindamata is an area which has a history of waterlogging records, but from past 2 years the waterlogging in Hindamata had stopped due to the pumps that were installed in that particular area. But now if you go to see, after 2 years, Hindamata is the first place that has recorded waterlogging with this rain which has started from midnight. Waterlogging not only in Hindamata, also in Sion area, in Gandhi Market area, and also on the railway tracks has been witnessed by the Mumbaikars today. We have seen traffic jams on the highways, Eastern Express Highway as well, where there was a huge traffic jam and many cars on this highway was stuck in this traffic. Actually, if you go to see, this rain has not only affected the rail travel, the road transport, rail transport, but also the underground metro. The Metro 3 that was inaugurated by the Chief Minister just 2 weeks ago has witnessed water leakage. The roof has started leakage in the afternoon, when Mumbai has witnessed heavy rainfall, due to this, water had also locked on the metro tracks, and resulting on shutting down the metro station. So the crores of rupees that was spent on Mumbai metro have literally been wasted in water. The BMC had claimed that the pre-monsoon works are completed and Mumbai won't be facing any waterlogging this monsoon. But from past, if you go to see, this is the first time that Mumbai is witnessing heavy rainfall in the month of May from past 75 years. It was happened in 75 years ago that Mumbai had witnessed heavy rainfall in the month of May. But now pre-monsoon has also started, and this has affected Mumbai and the transport facility in Mumbai. So yes, the next 2 to 3 hours have been given red alert by the IMD. Also, people have been urged not to get out of their houses if it is not necessary. So now the next 2 to 3 hours are really very crucial for Mumbaikars, not only in Mumbai but also in Thane and Palghar district.
Thanks, Joey, for that very insightful and deep update coming in from Dadar. I also have Sujata now joining us live from one of the metro stations, the Acharya Atre Metro, if I'm correct. Sujata, this is one of the metro stations that was newly inaugurated, but just a few hours ago we received an alert saying that now the metro services have in fact been disrupted. They will only go up to a certain station. Could you give us all of the details, and where exactly is the flooding taking place with regards to the metro lines?
Well, certainly, and Mumbai has been lashed with severe rainfall since morning, and one of the major impacts is on the Aqua Line, which was inaugurated just a few days ago by the Chief Minister of the state, and he clearly mentioned that this is a marvel if we talk about the infrastructure connectivity in Mumbai, and rightly, connecting. Cut to today, we see that the metro line has been shut for now because of severe waterlogging that took place within it. However, MMRC, the organization which is responsible for the construction of this metro line, has now come up and cleared and put up a statement saying that it is this particular part that you see is the exit point of the Acharya Atre stop, and this is in continuation of the third part which goes up till Cuff Parade. So this is not operational as of now, and because it was under process, there was some finishing work that was left, because of which we saw that there was waterlogging that took place. This is what the MMRC has to say. However, for now, the entire operations of the metro service at this particular stop has been stopped for now, and also they are of the view that for now this will be suspended for a few days. However, the metro Aqualine services from Worli to JVLR RA, which is the initial two metro connectivity that were operated, that were inaugurated, are currently underway, and they are operational for Mumbaikars, for people to go and do their tour. So for now, this particular metro stop has been shut. Now, talking about Mumbai, the flood-prone regions, there are several of them. However, BMC was of the view that they have been successful in identifying them and to work upon them, but that is clearly not the case, because this year, and especially on the initial day of rainfall of monsoon, we saw that a majority of these areas were flood-prone, and we could see waterlogging, we could see these bus, they were completely stuck in these water, and there is no way out for them. So, however, BMC every year keeps on trying and making statements that they are trying to work upon it. Sure. However, the work on ground seems way too weakened, because of which today, not only in Mumbai suburban but also in several Mumbai city regions, we saw these waterlogging situation taking place.
Sujata and Joey, thank you so much for those very comprehensive updates coming in from Mumbai. Let's remember, this is as the city has been lashed by the onset of an early monsoon. Both of my colleagues highlighting there that while we are seeing this onset of these early monsoons, train services have been disrupted. Other public transport services have been disrupted. We're seeing several areas waterlogged as well. And let me quickly go across now to this ground report that my colleague Paras filed earlier in the day from Juhu area in Mumbai.
After the first rain, there has been lot of waterlogging in many areas of Mumbai. We are standing at Juhu Beach, which is the famous place in Mumbai where thousands of people visit every day. But now, after the red alert which has been issued by Weather Department, the normal people have not been allowed to come inside for their safety. There has been many precautionary measures which has been taken by BMC and other agency, where you can see lifeguard has been placed, Mumbai police has been placed over here. They are telling everyone to not come inside the gate of Juhu beach because it can be risky. If you can see the waves, they are massive waves coming over in Juhu beach area. This is a very famous place where thousands of people visit every day. So now what is important is that some major 2 to 3 hours will be very much important for Mumbai and rest of the region, which has been said by weather department, because it's raining heavily in some places in Mumbai.
Right, Paras, thank you so much for that, and all of my colleagues giving us those updates from different areas in Mumbai. We'll continue tracking what's happening with regards to the monsoon and get back to you with all of the developments. Now, moving on to an NDTV Profit exclusive. The SEBI may issue a conditional no objection certificate to the National Stock Exchange for its IPO. Now, this may require clear disclosures and listing key cases as contingent liabilities. My colleague Shrimi now joining us with more details.
Yes, indeed, SEBI is weighing on and exploring and considering rather two options for the NSE IPO and for the public debut of NSE. In fact, what we've been given to understand that one of the options which is being considered is, giving no objection certificate with some caveat. Now, caveat may include that they have to disclose the entire matter and case in the draft prospectus, and in fact, they will tag this case as contingent liability is what sources tells us. The another option which is there and exploring is with respect to withdrawing the ongoing case with the dark fiber which has been going on in the Supreme Court, and take that matter and settle that matter under the consent route. Now, consent route is something where entities can disgorge without accepting the charges. Now, we have to see whether SEBI and NSE will be on the same page on this consent route. So these two options at this point of time they are exploring and they are in talks with. Now remember, Tuhin Kanta Pandey, SEBI chairman, has recently said that the IPO, the NSE IPO plan is progressing well, and they will soon, kind of disposed of all the matters which has been there and hanging for several years. So clearly it's a positive news, and it will give a clear idea that one of the case which has been lingering of the preferential access with respect to brokers through co-location by using the dark fiber connectivity will be, consented under the mechanism if NSE would be, coming through the consent route. But for now, this is a clear-cut news coming in where this is giving a fair idea that NSE IPO is not too far, at least what the source is indicating us.
That is, in fact, very positive news. Thanks so much for that, Shrimi. Moving on, the Metropolitan Stock Exchange and the NCDEX have opposed SEBI's proposal to limit weekly derivative expiries to just 2 days. Instead, they argue that each exchange should be allowed its own expiry day, promoting fair competition and market flexibility. Let me quickly go across to my colleague Charu for more on this.
NSE and NCDEX are the two exchanges which approached the SEBI committee dealing with the expiry day proposals and said that they are not in favor of these new proposals restricting the weekly expiries to only 2 days. Now, it is their case that this is only going to help the bigger players in the market, the bigger exchanges, and is going to take away the loaf from, smaller exchanges. However, it was SEBI's view during the meeting that in order to facilitate fair competition, which is also important, we cannot forget that there were once a lot of expiry days, that is any weekly day was allowed previously before the October curbs on F&O volumes came, and that led to a lot of hyperactivity in terms of the volumes, and this is not the case scenario that can be sort of repeated. And after listening to their concerns, the committee members said that they are free to make submissions to SEBI and basically appeal to SEBI by making detailed submissions and requests and explain how even their proposals or their benefits are going to help the investors and market stability in long term, and maybe SEBI can look into it and make a decision or tweak its already made decision about the 2 expiry days. So we'll have to see how any sort of tweak takes place, or if there is anything done to facilitate these smaller exchanges.
Right, Charu, thanks so much for that. And moving on to giving you a COVID update. India has recorded 1,009 active COVID-19 cases today, with Kerala, Maharashtra and Delhi emerging as the most affected regions. Now, the health authorities are closely monitoring the situations as cases fluctuate across different states. Central COVID dashboards show updated COVID case figures, with total cases across the country being 1,009. And let me give you the state-wise breakup. We're seeing 104 in Delhi, 83 in Gujarat, 430 in Kerala, 209 in Maharashtra, 15 in UP and 12 in Bengal. So this is the update that we're getting in right now on the COVID-19 cases in India. And Trump's one big beautiful bill has sparked a legislative storm in the US, but it could also have a ripple effect on the Indian economy and impact lives of Indians. One of the facets of the bill is a 3.5% tax on remittances set abroad by non-US citizens. Let's hear from former diplomat Prabhu Dayal on how Trump's big beautiful bill will impact India. And for the full conversation, don't forget to tune in at 6 p.m.
It is an internal law of the United States, and if they want to put a 3.5% tax, there's nothing we can do to stop it. Nonetheless, I wouldn't dismiss it as being trivial. It is certainly going to impact the savings and remittances of these H-1B visas holders, and incidentally, some of them don't know what to do because some of them have the hope of getting a green card and then staying on longer and eventually maybe even getting citizenship. But some have to come back. They don't get any extensions on the H-1 visas. They are not able to get green cards. So this 3.5% tax is going to impact them. There is a certain amount of unhappiness. And I wouldn't just take it away as something which is inconsequential.
That's right. Don't forget to catch the rest of that conversation at 6 o'clock this evening on The Big Question with Tamanna Inamdar. And for that, it's a wrap on Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Hello and welcome. You're watching KYC Know Your Company and I'm Harsh Saita, your host. I'm going to today talk about the IT index. Now, in terms of the way and the manner in which the IT index has performed, it's done very well from the lows. From 32,000, we've rebounded quite well. While the macro does not seem to be improving in significant fashion, at least on ground at this point. Commentary also did not see a material improvement. And that's exactly why we've brought in eClerx Limited to talk to us about IT and what are the trends playing out in IT. Now this entire small and mid cap space in IT is evolving and is very, very interesting. Some stocks have rebounded all the way to 20-25% and all the way to back to their highs or towards their highs. And that's why it's starting to look very interesting, and it's important and relevant to zoom out and know whether there's actually expected to be a recovery here. What are management seeing, and what is it that's transpiring in the US? There's plenty happening on tariffs. Is there a tailwind with regard to US macro? Once tariffs start to possibly, or the concerns start to ease out, which it has, could you start to see an unwind with regard to all the pessimism in the US? That's the other thing that we will try to understand from management. The third piece is, let's look at eClerx specifically. What's making it unique? What's helping it stand out? Or is it just another IT company within that IT basket? Are margins eroding is my next question, and they have been. The margins were well north of the 20 to 23% number. Now they are sub 20%. So clear erosion with regard to margins, and is that a concern? And the last piece is, what are growth prospects looking like for the coming year and for the medium term? What should one pencil in terms of growth? And therefore, in that context, how do valuations stack up? All of this we'll try to break up on today's KYC. Let's first start off and look at what the company does. And eClerx is a pure play IT company incorporated in the year 2000. It got listed in 2007, or more so 2008. It provides business process management, automation and analytics services. That's broadly its service offering. It caters to what kinds of businesses? Financial services, communication, retail, media and manufacturing technology companies. So all of those is what it caters to. Last off, and more importantly, how's the breakup in terms of industry? And you're seeing the numbers, of course, Q3, Q4 and full year FY25 largely stable. And therefore, let's just look at the FY25 numbers, which is the column, or rather the row right at the end. Look at that. BFSI is around 43%. Communications is around 26%, and communications includes media and basic technology as well. Then there's high tech. High tech plus manufacturing is around 16.5%. You have fashion, which is roughly 9%, slightly different, but largely in that retail basket. So retail, fashion and the like. Then there's emerging businesses, which is roughly 5%. That's how it's broken up. So a very high reliance on banking, financial services, communications, media, telecom. That's broadly how it's split. So something to keep in mind. Now, in terms of currency contribution, dollar is largely the predominant contributor. Nearly 80% of its top line comes from the US. Euro is around 8%. So Europe to some bit of exposure, and then there's small exposures from the UK as well as others. That's how it's split up, and that's how you'll see even the geographic concentration. There you go, around 78% from the US, 14% from Europe, which would likely include the UK as well, and then there's 8% rest of the world. So US concentration is extremely high, and that's why we've picked this one. It's an interesting one. Now, in terms of offshore, that's days of sales outstanding, broadly flat, nothing to be too concerned about. Let's look at offshore voluntary attrition. Now, what exactly is an onshore service and what exactly is an offshore service? I'll try and quickly split that. The onshore services is when a US company is availing services from an Indian company having a US presence. So it could be an Indian company listed in India, but having a subsidiary in the US, having people in the US, the 2,000 odd people or 5,000 odd people in the US are servicing the US based company. This is offshore. So this is people sitting not in the US but in India. And that's broadly what eClerx does. And the offshore, and you look at the numbers in front of you, 15,000 versus just about 600 which are onshore. That's largely the split. And in terms of what the attrition is like as well. That's the other concern I have. Attrition has gone up. So I want to understand from management whether that is going to be a concern. 24% attrition is what the company has clocked in FY25. We're going to speak with Srinivasan Nadathur, the CFO of eClerx, but let's try and first, as we always do, understand the metrics behind eClerx and what it has done over the last 3 to 5 years. These are the rating parameters for eClerx, typically with all IT companies. We'll start off with the income statement, balance sheet, cash flow, and thereafter look at return ratios. You also have shareholding, street cred, street coverage, and valuation. So that's how we'll kind of break it up. And let's quickly get you our views. Let's look at the numbers to start off with. In terms of the income statement, you look at the top line growth, it's roughly around 16% on a 3-year CAGR basis. Revenue in FY22 was around 2,100 odd crore. Currently sitting at around 3,400 odd crore. In terms of the size, it's extremely small, and therefore, would you want it to grow at a faster clip? For sure. So that's where some of my pessimism comes from. The other piece is with regard to EBIT. Look at that EBIT growth, just 7.5%. So your top line is not translating to profitability. That's how your EBIT trend has been over the last 3 to 4 years. So you're not seeing a very sharp increase with regard to EBIT. And therefore, if I can take you back and look at the margins, you look at how the margins have evolved, they've been on a continuously falling trend line. 26%, 23%, 22%, and now you're at 20%. So sitting on a lower margin number. And therefore, if we look at the first graphic again, the net profit has actually gone from 418 crore to 541 crore, which is just about a 9% CAGR growth. Not significant, right? And you're looking at a company which is sub 20,000 crore in market cap. So you want it to grow faster, you want it to grow towards the 1 lakh crore, but at this rate, it's not going to do that for a fairly long period of time unless something strategically shifts. And for the moment, we are not seeing that, at least on the income statement. And that's why I give this one a thumbs down. But the balance sheet looking fairly good. Let's look at the net worth of the company. It's sitting at around 2,300 odd crore. That's on your screen. And it has a fairly decent amount of cash and bank balances, as would understandably be the case with IT companies. They always come out with solid amounts of cash. They distribute that cash across the board. And therefore, it's looking like a decent balance sheet as such. No concerns, no debt whatsoever. So fairly clean, a thumbs up with regard to the balance sheet. Now let's look at the cash flow. The cash flow, again, an interesting one. And this time what we've tried to do is we've tried to get you operating cash flow to PAT. I want to understand how much of that profit after tax number is reflecting in operating cash flow. And look at that, 101%, 103%, 121%. So very strong operating cash flow flowing from the profit after tax straight to the company. Some part of that is getting distributed, of course. They have done a buyback of nearly 400 crore in FY25 at the start of the financial year. And therefore, you will continue to see distributions come in because as is the case with most IT companies, the cash coming in is very strong, whereas the amount of capex required is not that large. And therefore, a positive even with regard to the cash flow. No concerns. Even receivables, we spoke about the days of due or debtor days. That also is not fluctuating in a significant fashion. Now let's look at the return ratios. And as is usually the case, you will have a fairly solid set of return ratios which are coming through. The only downside here is it's on a falling trend line. You want it to start to go up. Rather, it's coming down. That's the one concern. But nonetheless, you're holding steady. When you're looking at, and I'll tell you why I've given this a thumbs up. When you're looking at the broader universe of companies, you'll largely see that ROCE above 20% is very healthy. But when it comes to IT stocks, ROCE of 20% is nearly a given. And as it scales, the ROCE ought to inch up. Now, this one is on a slightly difficult glide path with regard to returns and margins. And therefore, you're seeing a fall with regard to ROCE and ROE ratios. and therefore you're seeing a bit of concern there. But when you're looking at it from a broader universe perspective, your return ratio is very healthy at 21, 22 odd percent. But there's again no reinvestment happening in the business, right? And second, a large part of the cash flow therefore is coming straight out as dividend. So those are some things that you want to keep in mind when you're looking at the return ratios. Let's look at shareholding now. The shareholding, promoter holding is around 54 odd percent. FI is around 10%, but it's fallen from the 12% number same time last year. DIs have increased their holding from 23% to 25%. But broadly, why the thumbs up is because the promoter holding is fairly strong and fairly steady at 54 odd percent. Now let's look at the street cred. You look at the 6-month performance, you look at the year-to-date performance, it's a fairly muted performance. But you look at the 1-year performance, 54% up, and you look at the 5-year performance, it's very solid at 11x, and that's where you start to see the outperformance shine. So in the near term, it's been a bit of a drag, yes, for sure, but over the longer period of time, it's done very well for itself, and therefore, we'll give this one a neutral because of the near-term headwinds it's seen. Last couple of metrics. Let's look at valuations now. And again, this is a very interesting piece. We'll come to street coverage in just a minute. Let's look at valuations first. You look at the way it stacks up in terms of valuations. Now, these are all its peers. You're seeing eClerx at 25 times, 5-year average is 20 times. So it's already trading at a 25% premium. You have First Source, which is trading at 33 times. It's currently sitting at 44 times. So very strong growth coming for First Source. That's being built in by analysts. 33 times 1 year forward, but the 5-year average is 36. So still some scope for upside. Look at Hinduja Global. It's trading at 47 times, 5-year average is 28 times, and a Birla Soft is trading at 19 times, 5-year average is 22 times. Now, Hinduja Global is not trading at 47. I'm going to change that. It's Newgen Tech, which is trading at 47 times, 5-year average is 28 times. That's how the valuations essentially stack up. You look at other companies. They're looking cheaper compared to their 5-year averages. That's point number one. But at the same time, eClerx in absolute terms is trading at a lower valuation compared to others. But it's also offering lower growth. There's some bit of headwind on the margin as well. So you want to look out for all of those factors when you're deciding in on valuations. We're giving this a neutral. There's no comfort per se with regard to valuations. It's obviously trading at a premium. But at the same time, it's a slight discount to some of the other IT stocks, and therefore, if it significantly outperforms from a results perspective, you could well see this stock re-rate. That's something that I would want to be looking out for if I were to be looking at the valuations versus some of the others. So something for you also to look out for. Neutral with regard to valuations is what we're calling it at this point. And when you're looking at how analysts and the street is viewing this as well, there are just about 10 analysts covering the stock with just a 7% upside. 8 buy calls on this one. So largely, there's no comfort with regard to upside either. So we've given a neutral, and that is reflecting here, and hence we took street coverage post valuations. So just kind of caps all of this out. Let's look at the summary of how all of this stacks up. You're seeing balance sheet, of course, healthy, and no doubt cash flow decent. Return ratios compared to the larger universe, I did mention that, is a thumbs up for sure. Shareholding is a thumbs up. Street cred, street coverage, valuation, more to be desired, especially on that street coverage and valuation. So we've given this a 5.5 on 8. Now, we'll focus in with regard to the management. I earlier spoke with Srinivasan Nadadhur, who's the CFO at eClerx. Here's what he had to say with regard to Trump tariffs first, because the road ahead for the company is going to be largely based on how the US performs. So a couple of questions on the US to start off with. Listening. Right, in conversation with Mr. Srinivasan Nadadhur, who is the Chief Financial Officer at eClerx. Welcome, sir. First off, I want to understand from you what the impact with regard to US tariffs is likely going to be, because you have such a large mix coming from the US in terms of business?
Thank you, Harsh. Thanks for having me on the show. So we primarily are a provider of IT services, and therefore first order impact is nil. But we do have clients in high tech and retail, and they may have some impact because of tariffs to their business, and therefore there may be some second or third order impact for us. What that means as of now is not very evident to us, but we do know that a lot of their management bandwidth is being consumed on how to manage the new situation that has arisen in their businesses.
That's interesting, sir. And you know, if I can couple that with the way in which demand is shaping up from the US, because you're so skewed to the US, is demand in the US showing any sign of recovery whatsoever at this point, just given all the headwinds that are there and in combination that some of the businesses there are facing?
Actually, our pipeline remains strong and it has improved over the last 1 year. And other than the fashion and luxury segment, which for us is a very European focused business, we are seeing good demand in all the other parts of our business, including the US. So at least on the demand front, there appears to be not much of an impact that we can see today.
Okay. And is there a conscious call to try and go and make the other geographies slightly larger? And is there a preference, or is there a preference to go more towards the US? What is the internal preference like? What's the strategy like?
Our internal preference has been always to make Europe and other East Asian companies, East Asian geographies larger. Having said that, we've seen a lot of growth, and this has been the preference for maybe the last 4 or 5 years. But the growth from the US has been very strong for us. So I would say that, as you rightly pointed out, we still continue to be heavily reliant on the US.
So what can you extrapolate from this? How should the next 3 years probably play out? How would you play this very difficult headwind cycle that the US is seeing in terms of numbers?
It's hard to give specific numbers on what the next 3 years would look like, but we've always been focused on, firstly, we are a small company, so maybe that impact for us may not be as much as that for larger companies who are reliant on larger mega-sized deals. So our focus will continue to remain on solid delivery and execution, and to remain close to our clients and try and add value in whatever that they are trying to do through technology, through AI, and so on. So that basic fundamental aspect of our go-to-market strategy, that remains unchanged.
And what's the thought process behind employee costs? They've continuously climbed. When you're looking at the last 5, 6, 7 year trend, employee costs are trending higher. And that is in some fashion impacting your margins as well. At what point does that peak out, stroke bottom?
So there are a couple of reasons for that increase. One is that over the last 5, 7 years, the percentage of revenue that gets delivered onshore, that has nearly doubled. So maybe 8 years back, it was about 10%. Now it's about 20%. So that is one main reason. And the second is that we've started over the last 2 or 3 years to invest more on analytics and technology skills. And these skills, as you would know, are more expensive. We will continue to invest in AI and technology skills. The onshore component will stay where it is. So we may see a gradual, maybe a very slowing down of that increase. But again, if I think we will want to invest more in technology and analytics because we want to make that a larger part of our portfolio.
And therefore, would you say that margins at this point have bottomed, or there is still some way to go, maybe a year or so? And these AI costs that you will incur, will you expense them, or will you, and of course as an extension to that, previous question that I asked. Would you expense them? Would you capitalize them? And therefore, what will the impact on margins for that be?
So as of now, everything, the investments are fairly small, so it's all being expensed. There is no capitalization. To your first question on what the margin range for FY26 and maybe future is going to be, I can talk about FY26. So we give a 4% range on the EBITDA margin, including other income, which is about 24 to 28 is what we had said for FY25. We ended up at 26%, right in the middle. And we are continuing in the same range for FY26 as well. There are a couple of headwinds. So we opened delivery centers in Lima and in Cairo. So there may be some headwinds, but as a percentage of the portfolio, it is likely to be small.
What are the new age growth levers that you're looking for? Or how do you take this from 3,500 odd crore in terms of top line to 7,000? Would it just be consistent 10-15% kind of growth compounding, or would there be new levers that you look for to push the growth baton?
So we are looking at a couple of things. One is to strengthen sales operations and effectiveness. So there's a lot more focus on how we are selling, what we are selling, whether there are conversations that are maturing, how much time it is taking for deals to move to down the funnel. So that is one. The second is we have digital services, we have technology, and we have customer experience services. These we want to cross-sell across our entire portfolio, across our entire set of clients. And the third aspect is that we want to sell more larger deals and not just focus on smaller deals. So these are the three areas that we are working on actively.
And how do you stand out to try and win those?
I think it will be what has set us apart till now has been execution and delivery, and that will continue to remain our basis for selling.
Is there a plan to build moats? What really helps you stand out? Is it the relationship with the client that you have? Is it the niche that you've created within the sector space? How does that work?
So the moat is essentially the kind of domain that we are working in, and that tends to be high complex, high touch domain. So we have very close relationships with clients. We work in domains that are more complex, require a higher level of skill. And that's something that we will continue to strengthen even in the future.
And what about segments? You work across a wide board of segments: financial services, communication, retail, fashion, media, entertainment, manufacturing, travel, leisure, technology. Where is it that currently you're best placed to capture the largest available opportunity?
So in BFSI and in cable media telecom, these are two areas where we see significant pipeline growth. Those have been the growth drivers for us even in FY25. So we expect that at least in the next 2 to 3 quarters, growth will be led by these two industries.
Okay, you'll continue to deliver value to shareholders through buybacks, or is there a larger plan to maybe invest to go into inorganic expansion? Is that at all on the table?
It is on the table. So we continue to look for opportunities, and as and when something interesting comes along, we will use the cash for inorganic.
How large would it be? In what segment, space, pocket, geography?
Geography will be developed countries. In terms of size, maybe 10 to 20% of our revenue is the maximum that we will look for. And in terms of capability, it will be something that adds to what we already do. So either in the data space, analytics, or technology.
What does this new setup, new delivery center in Lima and Cairo bring to the table for you? Does it bring, of course, new set of opportunities, but how large would those opportunities be? How much would it add in terms of top line, maybe over the next year and maybe over the next 5? What's the thought process?
So
This has been driven on the back of client demand. So clients want us to deliver from multiple geographies, and that's what we've addressed through these centers. It also gives us the capability to service multilingual requirements in a more meaningful way. So something like Spanish, which we were not able to do at scale earlier, which we'll now be able to do. It's hard to, again, see where this goes in the next 5 years, but we believe we have a reasonable amount of visibility for the next year or so. We've started small, but hopefully these centers will continue to expand.
Are there more centers in the pipeline? Is there more demand coming from customers? And does this cause margin headwind, at least in the near term?
There'll be some amount of headwind in the near term because of these two new centers, but I think because they are small, the impact on the overall book is not likely to be much, and we believe that we can manage the drag on margin. At the moment, we have no plans for opening anything more. I think we need to get these couple of centers up and running at scale before we decide to go in for anything more.
Well, out of time, frankly, on this one, we spoke about attrition as well, and he suggested that it's fairly normalized. There are no concerns whatsoever with regard to attrition. But completely out of time on this edition of KYC. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, we speak about a whole range of topics related to money, related to personal finance, investments specifically. And today I'd like to talk about bond yields. Not the most interesting topics to a lot of you, I understand, but this is very important from the perspective of building a strong portfolio. And that's because you have to have a certain amount of fixed income in your portfolio, and understanding how bond yields move and everything that is panning out in the economy, both here as well as everywhere else in the world, is something that you need to do in order to get your fixed income strategy right. Joining me today is Devang Shah, the head of fixed income at Axis AMC. Devang, thanks so much for joining in. In my opinion, we don't speak enough about fixed income, so this is my attempt at trying to rectify that. Let me ask you first, though, there's a lot of developments in the fixed income space globally. And on the one hand, you have the US rating, credit rating, that has been marked lower by Moody's. You have, in the last week, you had an auction of bonds, the 20-year bonds in the US and in Japan, which have not done particularly well, and that has pushed bond yields higher in both of those economies. In the meanwhile, in India, you have bond yields that are falling because the RBI is cutting interest rates. How does this come to pass? What are the implications for us here in India?
Thanks, Alex. Thanks for bringing an important topic out. I think somewhere down the line, it's important to understand what's happening on global bond yields and the impact of that on Indian markets. How do we see it is, I think probably, first of all, it is important to assess that if you look at the last 2-3 years, the correlation between Indian bonds and developed market bonds, and specifically US, Japan, German bonds, have completely broken. Previously, we used to see that US Treasury yields go up, Indian bond yields also go up. But now if I actually see across the last 2-3 years, if you see since May 2022, US Treasuries are up by around 200 odd basis. And if you look at Indian bonds, which is Indian government bonds, are down from 760. Currently, they are trading at 620-25 levels. So the correlation is completely broken. That is because of genuine macro dynamics, changing dynamics and macro reasons. I think, first of all, the US is going through a different inflation and growth dynamics, as well as US fiscal is significantly higher. When it comes to India, I think we have taken a control on both these aspects. First, I think India inflation is significantly under control. Secondly, we have done a massive fiscal consolidation over the last few years. Coming specific to your question on what's happening on US and Japanese bond yields, I think with the tariff uncertainty getting settled, markets are getting now more and more confident about the fact that growth, which people were pricing in to be significantly lower, in fact, people had started pricing in more than 65% probability of recession in the US, they don't anticipate it anymore. And hence, now people are looking at the growth and inflation dynamics, where inflation might not cool off significantly. If inflation is not going to cool off in be it Japan, be it US, then somewhere down the line, Fed rate cuts will be limited. I think probably the pricing of Fed rate cuts, which markets started anticipating post the tariff announcement, was close to 100-125 basis in this year. Now people are not even anticipating 1 or 2 rate cuts. So that realignment of rate cuts, Fed rate cuts, should have happened, and that is leading to the bond yields going up. Our perspective is that if I look at the US Treasuries, which have inched up to 4.5, can they see some more pain? Probably yes. But for me, I think the impact of that on Indian bonds will be limited. Again, Japanese bonds have seen some pain in the last 1 month or so. The 30-year bond yields are up by 100 odd basis. Our perspective out there is that at this point of time, yes, Japanese bonds have gone up. They might have some impact on US Treasuries, but we see a very, very limited impact on Indian markets because the Indian macro, specifically CPI and growth, both are on the downward trajectory.
Okay, Devang, just to round off that point, because traditional understanding, or at least mine, of economics and of capital flows, you're the expert, so you tell me whether my thinking is right, is that when the risk-free rate, and here I'm talking about US bond yields, is inching higher, traditionally, there is a capital flow that moves out of certain assets and into the US bonds. Of course, in the current context, we've pointed out that the risk premium that is being
asked for by investors has gone up because of the various factors. And here we're talking about the fiscal profligacy, as they call it in the US. And so therefore, that is why this is happening. But the question is that if there are takers for US debt, and if there are takers for Japanese debt, then would foreign institutional investors that have moved into Indian bond markets of late, and of late I mean the last 1 year, 1.5 years, does that money move out, and will there therefore be an implication for our markets?
Right. Fair question, Alex. Again, you're right that at times when we have seen developed market bond yields significantly attractive, and when they've seen some blown up, people prefer to invest in developed markets, and probably there is an outflow from emerging markets. That's been the case traditionally. But let's look at, I think, first of all, I explained that the sell-off in bond yields globally is because of the growth inflation dynamics, as well as the increased fiscal deficits, specifically in US. So there are specific reasons. Now, coming to a specific question, will we see outflows from Indian bonds to US treasuries? I think first, at this juncture, we still believe that Indian central banker will be looking at some rate cuts. Our expectation is that if I look at the near-term inflation for India, which is next 3 to 6 months, the inflation print will be below 3.5 average. If I look at the growth number, I think growth number which gets released at the month end probably will be upwards of 6.5. But next year's growth trajectory to me looks lower than 6.5. This is a perfect recipe for RBI to continue to remain dovish and probably deliver more rate cuts. Secondly, I think it is important to understand that the spread which you explained about, that Indian and US treasuries are at lowest spreads, and that is why probably we might see outflows. First of all, the money which came in last year was a replication for JP Morgan index. And that is more of passive money which needs to be replicated with certain weights where we have got added in that index. So overall FPI ownership in government bonds still remains below 3.5%. So I don't see a significant outflow on account of this rise in bond yields in developed markets. In fact, I would say that in the near term, because there are some rate cut possibilities in India, and we are already in a banking system liquidity environment, we are flush with positive liquidity, I don't envisage any big outflows from FPIs.
Okay. And incidentally, that last point that you mentioned, Devang, you've written a report about that, and I was going through it. It's fine. It's quite interesting. It's an interesting read because you speak about the implications of the shift in the policy of the Reserve Bank of India to keep the system flush with liquidity. Because ultimately, and again, this is old monetary policy theory, the only way that you can ensure transmission of monetary policy changes in the form of interest rate cuts is to ensure that there is enough liquidity in the system so that that gets transmitted through. But this will also have a bearing on the yield curve. And what I mean by the yield curve, for everybody that's tuning in that doesn't know what I'm talking about, is that if you look at the way that interest rates are, the longer the bond, the higher the yield. That's normally how it goes. So with that context, Devang, how is it affecting the way that bonds are getting priced and the yields that they're getting?
So a couple of questions you raised. I think probably the shape of the yield curve and all about the banking liquidity. First of all, if you ask me, I think it was important for RBI to acknowledge the fact that the economy is slowing. Last year, I think probably thanks to a couple of reasons, lack of government spending, we had these US elections which led to significant dollar appreciation, and to ensure rupee stability at that point of time, we intervened a lot in FX market, which lead to significant liquidity deficits. We moved from a 2 trillion positive liquidity early last year in April, June 2024 to approximately minus 3 lakh crores of liquidity deficit by Jan 2025. So there was a significant outflow or tightness in the banking liquidity, which actually ruptured the credit growth, which significantly impacted the economic cycle. And that is why I think RBI had to step in. RBI has done a superb job in the last 4 or 5 months of infusing more than 10 lakh crores of liquidity through various tools. Currently, now we are talking about is that RBI's or the banking system is currently positive to the tune of 1% of NDTL, which equates to 2.5 lakh crores or 2.5 trillion of positive liquidity. That's huge. When we have witnessed this kind of liquidity last in the last 15, 20 years, it is only two episodes. One during COVID, where it was emergency, and second during demonetization, where there was an influx of currency notes into the system. At this point of time, we saw huge positive liquidity. Both these time frames, if we look across in history, what we observed was that the yield curve, which is generally very flat in India, actually got significantly steepened. We actually saw the short end of the curve to significantly rally and the curve to get slightly priced, as well as the long bonds were not becoming so attractive. So our perspective is that, yes, there are rate cuts, but we have also witnessed more than 80 to 100 basis of rally in the last 12 months. So what we are telling incrementally markets is that because of this flush of liquidity, because generally we have seen when liquidity gets so positive, the yield curves get steeper, we are now advising clients that both long and short-term bonds can actually perform similar in this kind of markets. And in fact, the short end of the curve, which is 2 to 5 year corporate bonds, can outperform even long government bonds. So that is how the shape of the yield curve behaves in a significantly positive liquidity environment.
Okay, so there are specific fixed income funds that have this orientation and play that duration strategy, but also your hybrid funds, Devang. So is that something that you've done in the hybrid funds that have fixed income exposure as well? Have you shifted portfolios?
Yes, so at Axis, what we do is follow a fixed income strategy across all funds. Okay. So last year, we have been long across all our funds, including our hybrid funds. So in the hybrid funds also, our debt allocation was significantly biased towards government bonds and having a duration of 5 to 7 years. Now, with this, as I explained, that we have already witnessed 50 basis of rate cuts. Secondly, it's also important, Alex, to understand that it is not only 50 basis of rate cuts. The total financial easing has actually 100 basis, because we have moved from MSF 675 to now standing deposit facility 575. So it's actually a transmission of close to 100 odd basis. And we have seen more than 80 basis of rally in long bonds in the last 1 year. After capturing this rally, now what we are advising clients, or what we have done in our portfolios also, we have shifted from long bonds, a large part of our portfolio, to short to medium term corporate bonds, which is 3 to 5 year duration. And that is what we are incrementally advising. This includes even balanced funds or hybrid strategies.
Okay, just a quick, very simple question, Devang, and this might be a little too simplistic, but then you try and give me an answer. In terms of as obviously when yields fall, prices go up in bonds, and so therefore you earn money when the yields are falling, and what you're suggesting is a duration strategy on account of that. But how much of an increase in capital gains can you expect per fall in yields? Can you explain that?
So I'll explain you with a more like an example of a generic bond, and that is how probably we can explain how does the capital gain function in a bond markets. So example, if bond markets or any kind of coupon bearing instruments have two kinds of returns, or the income is made on account of two perspectives. One is the coupon, which is the yield on the bond, and the second is the MTM, mark-to-market gain or loss, which you make on account of interest rate cuts or interest rate rise. If you are holding a 3-year corporate bond, example, today a 3-year AAA corporate bond, public financial institution, would be trading at close to 6.75 levels. You get the coupon of 675. Supposedly, if you are looking at a spread compression, or because of rate cuts, you are actually seeing the yields to fall. And let's take an example, in the next 12 months, we actually see yields falling by close to 50 odd basis. If the bond is holding, the 3-year bond generally will have a 3-year duration. So 3-year duration, if you multiply it with the 50 basis of rate cuts or rate easing, it actually translates into something like a 1.5 rupee of mark-to-market gain. This is in addition to the coupon or the yield which the bond gives. So the total return which a 3-year corporate bond, hypothetically, in an interest rate environment where we witness a 50 basis of rate cuts, will actually be 6.75 plus 1.5 MTM gain, which will translate something like into 8 quarter kind of return for the investor.
You've explained it fantastically well. Thank you so much, Devang, for joining in. And this is a fascinating conversation that we've just had. As always, pleasure.
Thank you, Alex.
There are a few schemes in the mutual fund space that have become household names, and one of them is Parag Parikh Flexi Cap Fund. And they hit a pretty important landmark in the month of May. That is an assets under management of 1 lakh crore rupees. And they've risen to this point very quickly. In fact, in December of 2023, their assets under management stood at 50,000 crore rupees. They've doubled since then. And they had 25,000 crore assets under management in just August of 2022. So that should tell you that along with the equity markets rising, they've gotten a significant amount of inflows, and that has resulted in a very significant rise in assets under management. How have they performed in that time frame? The last 1 year has been incredible. They've gained 13.3% compared with a category average of 6.2% and a benchmark increase of 6.9%. Significant beat on both those fronts. Even in the 3-year and the 5-year time frame, they've done better than the category average as well as the benchmark. Now, why has this taken place? If you study a ratio called the down capture ratio, this will make sense to you because their down capture ratio over the last 3 years stands at 35. What you need to understand is that a reading below 100 means that when the market is falling, they have fallen less than the market. And a reading of 35 is probably better than most of their peers. On the other hand, the up capture ratio, which studies the outperformance of a scheme in a bull market, is not as good as some of its peers. In fact, the last 3 years, the ratio stands at 80, which means that they have not risen as much as the market when the market has been on an uptrend. Why is this? It's because Parag Parikh Flexi Cap Fund has taken cash calls at very significant moments over the last 3 years. Take a look at where it stands right now. 13.1% as of the end of April was in cash and cash equivalents, and they had a further 9.7% in certificates of deposit. These are effectively short-term fixed income instruments. So nearly 23% allocated towards cash and fixed income investments. That's actually gone up from 13.3% in December 2023 and 9.6% in August of 2022. What's more, their international allocation has actually dropped quite dramatically because of the overall stricture or limit for the mutual fund industry. They haven't been investing fresh in international equity. That was a standout feature for them in 2022. They had 20.4% of their assets under management in international equity. That's fallen all the way to 10% in April of 2025. All told, they continue to run a pretty concentrated portfolio, and as of the end of April, they had 26 shares or stocks and 51% allocation towards the top 10. That has more or less stayed constant over the course of the last 3 years. So this is just a snippet of how Parag Parikh Flexi Cap Fund has behaved and why it has outperformed in certain respects. Most importantly, it has fallen less than the market when the market has gone down, and that's likely primarily because of its decision to hold cash at strategic moments. Now, there's another update for you, and this relates to the Employee Provident Fund. The government has ratified a rate of 8.25% for the financial year ending March 2025, and this means that all members of the EPFO will get that 8.25% interest on their balance in that one financial year. How does it stack up to the previous years? Well, it is the same as FY24, remains at 8.25%. It has actually risen from FY23 when it stood at 8.15%. It was 8.1% in FY22, which was the year just after COVID-19, and FY21 was 8.5%. How is this determined? Well, the return is based on a combination of both debt and equity. Remember that the EPFO can invest up to 15% of its assets under management into exchange-traded funds, equity exchange-traded funds, and as of December of last year, it stood at around 10% allocation. So that's how it manages to give you 8.25%. Now finally, on this episode of Your Money Matters, I want to bring to you a conversation that I had with Ramesh Damani about how to invest in the Indian equity markets and what his learnings were from Warren Buffett's teachings. Listen in. Let me ask you this. Of course, you've made mistakes over the years. Everybody has. Interestingly, right? So if you're doing value, there are a lot of people that have perhaps looked at the same company and said that it's not worth the money and I don't want to buy it for various reasons. So in a sense, you're doing the opposite of what they're doing, and there's a reason why you have to do that, right? So, but it takes conviction. So if you've made the wrong call, unfortunately, things can go very wrong. How do you pick yourself up? And have there been instances where you've done that? How have you done it?
Yeah, I think there are two kinds of mistake. One is, of course, you buy the wrong stock itself. But let me give you an example of one stock that I got wrong. We bought a company called MTNL, if you may recall. That was the fixed line provider, public sector stock in India. That stock went from, I don't know, 200 to 20 bucks or so. So I lost 90% of my money in that stock out there. But the thing is, there's a quote attributable to Peter Lynch, where he says that you should always water your flowers and cut your weeds. So while I lost 90% of my money, it was a loss I could avoid because I had 10x, 20x in so many other stocks. So I lost one part of my earnings in MTNL, but it more than made up by other stocks that went up 10, 20x. If you flip everything for $20 profit or 20% profit, you're never going to get rich. So Buffett also taught Lynch and taught us that you have to hold on to the great winners forever, because compounding will take you over time. But the other set of mistake, which Buffett calls thumb sucking, which are so important, that I think value investors broadly will get this part right. So, we'll buy good stocks, and even if you have a few losers, the winners will compensate for the losers. So there's nothing I worry about too much. But it's what we call not the errors of commission, it's the error of omission. I mean, for example, Bajaj Finance, the company in my backyard that, in Pune, I mean, it's in my circle of competences in finance. And for many years, I missed that. I mean, that's an error of commission, error of omission. Because how can you miss that? It's in your backyard, it's a business you understand, it's run by management you trust, how you do that. Again, I'm not recommending any of these stocks, but just to illustrate the point that these errors of commission, errors of omission that you make sometimes hurt your portfolio more. I think no one can point out, say, oh, you didn't buy this or you didn't buy that. I think that's what we should try and, if there's something within your circle of competence and certain something that you should understand, and if you didn't understand that, you should really punish yourself. And I think that's something that I think we all could improve, including Warren himself.
Okay, so a couple more things that would be very beneficial to people listening in, right? Warren Buffett has over the years had concentrated portfolios. So I think the question a lot of investors ask at the start is, how many businesses should you own? Is it okay to have very concentrated bets? What's the definition, in your opinion, of a concentrated bet?
I think, yes, Warren Buffett does believe in that. Charlie Munger does believe in that. Unfortunately, I'm not that good a practitioner of what Warren and Jai said. I run a more diversified portfolio, though I would say 50% is in the top 10, 15 holdings. The rest is white tail, because that's just the way I operate. I think it requires a lot of self-confidence and a lot of seasoning before you reach there. It's a goal you want to reach there, but it's not easy to reach there. So Warren Buffett has run a very concentrated portfolio. I think for most people, maybe you start off with diversified and then gradually move up the ladder.
Okay. Now, we've spoken a lot about which companies to buy, and you've said weed out the ones that don't work, right? And of course, margin of safety is something that Warren Buffett always speaks about when he invests in companies. But when do you sell is a question that a lot of people ask. Of course, you can aspire to hold forever, but if it's not doing well, how do you decide when to pluck the weed?
Well, if it's not doing well, then it's very easy. Then you know how to pluck the weed you want to do out there. But sometimes you have extraordinary winners in your portfolio, because stock goes up 30x, 50x. So you don't know when to sell. And there are very, very few businesses that you can hold through the business cycle. I think Munger was one person, Phil Fisher was one person who understood that they could hold the stock they bought. For example, Munger talked about a stock called Maotai, which is one of the Chinese famous liquor maker from China. And he's often told it was founded by Li Liu. And he said, we're going to hold the stock forever, because, liquor is never going to go out of fashion, and Maotai is going to be the most iconic brand out there. So they kind of find these businesses that they want to hold forever. So maybe a liquor business, a tobacco business, even in India, are businesses that you can hold forever. But the short answer to your question is that I bought a lot of stocks that have done very well in a bull market, up 20x, 30x in a bull market. So if you believe that the bull market is coming to an end, sometimes it pays heed to take some money off the table and sell those winners. and wait for a better investment opportunity in maybe other stocks or maybe in the same stock but at a different time. So occasionally the market will take and overvalue these stocks. And as an analyst, it is your job to be true to yourself and not say, oh, because I picked a 30x, I won't ever sell it. At least I have not reached the state to buy that businesses that I can hold those 5 businesses forever. Not that there aren't businesses like that, but it takes a huge amount of intellectual rigor to figure them out. So if you do a bit more loose, elastic analysis, maybe one way, if it doesn't work, obviously you want to get out of that. If your thesis is wrong, the faster you get out of it, the better. The other thesis, if you think the bull market is ending, because typically, Alex, when a bull market ends, all stocks will be down 30, 50, 70%. So might as well lighten up at that point. So that's what I use for myself.
Okay, last point that I want to ask. And we've spoken about Buffett using cash and dry powder. I'm wondering whether you do. And are there moments when you have probably wished that you had deployed earlier?
I do. In fact, this is a good current time that I'm thinking that. In September, October, when the market was wobbly, as you remember, and I was feeling very nervous for the market. So we took some cash out from the table and created a cash reserve for ourselves, which held us well through the correction in October, through the trade wars, through this Indo-Pak conflict. It has held me well out there. But generally speaking, I like to be well invested. I like to be, to use the word fully invested. I am not now, but I'm a bit of a slower investor that once I get into cash, it takes me time to get back into it and deploy the cash. I will ultimately, but, and as will Warren Buffett, but we need to find that those comparable values out there where you can put large sums of money to work. So it's somewhat of an intellectual effort to do that.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
We have a very special guest in our studios this wet, rainy Monday morning. Pranjul Bhandari, Chief India and Indonesia Economist, HSBC, joins us. Pranjul, pleasure to speak with you in our studios in person. Always great to have you on, and so let's just start off the conversation with what's on top of mind, I think, which is the RBI dividend, which came in post markets Friday was when the announcement was made. 2.7 lakh crore rupees, the highest ever bumper dividend. How did you look at that?
Yeah. So look, I think it's definitely higher than what was budgeted, which was closer to 2.3 trillion. It was higher than what the government got last year, which was 2.1 trillion. It might be a little lower than what markets had expected. Markets had expected more like 3 trillion, but I think the miss is not very much. I think overall, it's a good number. I like two things about it. One is that alongside this number, we have now put in more money for some of our risk buffers. So the risk buffer has been increased from 6.5% to 7.5%, which is a very good thing at a time of so much global volatility, right? You want all of these buffers. So we've actually built up that buffer. So that's great for macro stability. And the second, the fact that, it's about like 0.1 to 0.2% of GDP higher than budgeted, which basically means that the government can spend that much more without running a higher fiscal deficit, which will be good for growth on the margin. It will be good for liquidity on the margin. So overall, I would say, it's a good number at this point of time.
Also important to see perhaps from the point of view of what the RBI's perspective has been. It's not emptying out the accounts to give the government, the risk buffers have been kept high, as you said. In terms of government capex, how would you like to see this move forward? This is something that we've been waiting for since the budget. What do you expect happening in this direction, and what would be ideal?
Yeah, so the state's capex actually picked up in March, and I think that's one of the reasons why I'm seeing a lot of the rural spending, and I'm seeing informal sector consumption actually pick up a little bit over March and April. I think state capex has helped there. Central government capex, we are still waiting and watching. We don't have all the data for March. We'll get it in a few weeks. But overall, we should just take a step back and understand that this is a period of a lot of uncertainty globally. Generally, in years like this, capex and investment take a back seat. Already we are seeing FDI inflows around the world have, paused in a big way. Even India's FY26 FDI was not very strong. Sorry, FY25 FDI was not very strong. I think this is a year to focus on consumption. And I really wanted to actually bring out consumption because something interesting is happening there. I'm noticing that informal sector consumption, which is both rural and also urban informal, like small firms, like small shops, that consumption has picked up. One thing that's helping there a lot is inflation. Inflation is falling off, real purchasing power.
मन रुकने का नाम नहीं करता है. आज यहां विकास से जुड़े 50,000 करोड़ रुपए से अधिक के प्रोजेक्ट का शिलान्यास और लोकार्पण हुआ है. एक समय था पूरे गुजरात में 50,000 करोड़ की योजना सुनाई नहीं देती थी. आज एक जिले में 50,000 करोड़ रुपए का काम. साथियों, ये प्रोजेक्ट भारत को दुनिया की एक बहुत बड़ी और ब्लू इकोनॉमी बनाने, ग्रीन एनर्जी का सेंटर बनाने में भी मदद करेगी. मैं आप सभी को, मेरे प्यारे कच्छियों को, इन सभी विकास कार्यों के लिए बहुत बहुत बधाई देता हूं. एक बार तिरंगा फहरा करके जरा अपना आनंद भी जताइए, उत्साह भी जताइए. साथियों, हमारा कच्छ हरित ऊर्जा का दुनिया का सबसे बड़ा केंद्र बन रहा है. आप सुन रहे हो? क्या कहा मैंने? दुनिया का सबसे बड़ा. हो जाए एक बार.